Hello everyone and welcome to today's video where we would be discussing all other Ind AS apart from the major topics that we discussed in the first part. The link for the same we will share in the description box as well in case you want to refer. So in the earlier video we have covered all the important topics: share-based payment, financial instruments, business combination, consolidation with joint ventures, 115 and 116. That is approximately 50% of your course. The remaining 50% is widely dispersed among all the other Ind ASs. So again, what we will be doing, like we did earlier, would be discussing all the concepts pertaining to each of the standards and the theory topics, and also covering the questions from the Super 99 file that we have. So I hope this is again helpful for you. So we will get started. The flow of this would be, we would go first with the asset based standards, complete the asset based standards, then go to the other standards in a logical sequence. So first we will go to Ind AS 16, property, plant and equipment. It's a tier 1 category topic. This is a topic that you read along with Ind AS 38 as well as Ind AS 40 for intangibles as well as investment property. So all of these are quite strongly interrelated. So when we look at PP, to start with, PP covers the definition where PP is something that is held for the purpose of use. It is tangible in nature and has a life of more than 12 months. So these are the three essential ingredients. If the cost is measurable, the PP will be separately recorded. Now, when you look at the scope exclusions within PP, you will exclude items like exploratory and evaluatory assets which are linked to mining operations, because there's a separate Ind AS 106 for it. Non-current assets which are held for sale, for which a separate does Ind AS 105, and importantly biological assets which are held for agricultural purposes other than bearer plants. So over here bearer plants are something which will be covered under Ind AS 16. So we need to know what bearer plants are. Further, what you are excluding is only biological assets which are used for agricultural purposes. We will study separately in Ind AS 41. However, not every biological or living asset may be held for agricultural purpose. Like for example, a security dog may not be held for agricultural purpose, in which case it will not be covered under Ind AS 41, in which case it may come back, let us say, to Ind AS 16 as well. So when we look at biological assets, living animals and living plants, within living plants, if they are bearer plants, they will still be covered under Ind AS 16. What do you mean by bearer plants? These are plants which bear agricultural produce but are not agricultural produce themselves, like a mango tree, coconut tree, etc. is a bearer plant. However, if there are other than bearer plants, like you might have a bamboo tree which is itself the produce, or certain plants which have a life of less than 12 months, in which case they are also not bearer plants, that will be covered under Ind AS 41 if they are held for the purpose of agricultural. Further, when you look at living animals, typically if any type of living animal is used for agricultural purpose, like a milking cow, dairy cow, etc., will be covered under Ind AS 41. So generally the important part over here is understanding the treatment of biological assets, which standard it gets covered into, including the treatment for bearer plants. Bearer plants are plants which bear agricultural produce, have a life of more than 12 months, and the sale, etc., of these plants is incidental or ancillary in nature. So this is a brief introduction regarding PP. The standard has four main parts. First is initial recognition, second is subsequent expenses, third is subsequent valuation in the balance sheet, and lastly is depreciation. So first, when you look at initial recognition, it should happen at cost. Cost should include the purchase price, directly attributable expenses, plus non-refundable, non-creditable taxes. So this will be the general meaning of assets cost which you are purchasing. Over here, the refundable or creditable taxes will not be a part of cost because you are going to get credit for the same, and what you include is directly attributable expenses. Now these are expenses to get the asset in the ready to use condition. Further, you might also include borrowing cost if it is a qualifying asset, and you will also have to include the present value of site restoration obligation. So there will be a legal or a constructive obligation to restore. If such an obligation exists, then at the time of initial recognition, you will try to find the present value of the site restoration obligation and add it along with the cost of the asset. So discounts over here, typically trade discount would be deducted if there is a trade discount. So this is on initial recognition. If it is a constructed asset, then you will take the material cost, labor cost, etc. into the cost instead of the purchase price. Now, directly attributable expenses will not include inauguration expenses, employee training expenses, relocation or retraining expenses, and expenditures or losses incurred before commercial production. So this will not be a part of the cost. Further, even administrative and selling expenses usually are not a part of the cost of the asset. Abnormal losses will also be taken to the P&L and will not be capitalized along with the cost of the asset. If there are incomes which are directly attributable, we will say that incomes which are directly attributable, like sale of scrap on demolition for the purpose of a redevelopment project, then the sale of scrap is directly attributable to a construction cost and hence you will deduct it. However, if it is something like parking income on vacant plot of land, this will be taken to the P&L directly because it is not directly attributable to a cost of construction. Okay, a special treatment over here will be on provision for site restoration. The treatment over here is as per what is governed in Ind AS 37 for provisions and contingencies. If there is a legal or a constructive obligation to restore the site back in the condition it was, then you will have to recognize this provision on a present value basis. So you will recognize the provision for site restoration on a present value basis. The debit effect will go to the PP and the credit effect you will create a provision. Now this provision, for example, was 50 rupees expected to be incurred after 10 years. In today's terms, let us say it comes to around 20 rupees. Then slowly this 20 will proceed towards 50. That is due to passage of time and hence this is an unwinding cost which will be taken as a part of the finance cost in your profit and loss account. So in each year, your provision will be unwound. Your entry will be unwinding cost or finance cost account debit to provision for site restoration. Slowly your provision will increase and will proceed towards a 50 rupee value. Ultimately, once you pay, your entry will be provision account debit to bank. So initially at present value, you will increase the value of the PP. Subsequently at each balance sheet date, as time passes, you will unwind the provision and that will go to the present value of site restoration. Credit and the unwinding cost in the P&L as a part of finance cost will be debited. A very interesting adjustment over here is possible if there is a change in the estimate for site restoration. So if the entity is following the cost model and if there is a change in the estimate for site restoration obligation, we will say that that makes the asset more costly or less costly as the case may be. Again, this is a change in estimate and hence there will be no retrospective change. So over here, you will try to quantify the change. Let us say it's a 10-year, it was a 10-year estimate where you estimated 50 rupees to be incurred. 4 years, you keep on doing unwinding. After 4 years, you now believe that there's a change in the estimate. You now believe that a further 10 rupees will have to be incurred over and above what you expected. But this 10 rupees is to be incurred after 6 years. And hence you will try to find the present value of that 10 rupees to be incurred after 6 years. And that will increase your provision with a second effect again going against PP. So if you are following the cost model, you will credit the provision or debit the provision as a case, maybe depending on whether it is an increase or decrease, and then the second effect goes against the PP. You will study further, but if it is a revaluation model, then any change in the value of the asset, which may be for any reason, including a change in the site restoration obligation, will be adjusted against the revaluation reserve. However, if you are following the cost model, a change in the estimate for provision for site restoration goes against the cost. Okay, another special case, abnormal loss we have discussed, will go to the P&L. If nothing is given, losses can be assumed to be abnormal. Two special cases can be there in the initial recognition. One is on account of deferred payment. So if there's a payment which is deferred beyond normal credit terms, that is beyond 12 months, then we said that there would be a hidden interest involved, in which case you will recognize the asset at the cash price equivalent, or if that is not available, you can even find the present value of the cash flows. We will say that if you are told that you will pay 24,000 after 2 years for buying an asset, if in today's terms that asset is available, let us say 20,000, then you will record the asset at 20,000. Usually the question will give you an interest rate implicit, in which case you will try to find the present value, come to 20,000 and record the asset at 20,000. The remaining 4,000 is actually interest expense which will be taken to the P&L usually, because this is interest, and interest is not capitalized unless it is a qualifying asset. This special guidance for deferred payment is to be applied only if the payment terms are deferred at or beyond 12 months. If the payment terms are within 12 months, you will continue to do your regular accounting for a normal credit purchase where you are going to pay after 2 months. You don't need to do any present value working. Okay, then is barter. Barter is something which is quite important. Barter can lack commercial substance or can have commercial substance. A genuine barter where different assets are exchanged, where the position of the entity changes after the after the barter, would be a barter having commercial substance, in which case you will recognize the barter based on the fair value of the assets given up or the fair value of the assets received, whichever is more reliable. However, in a typical question, it is difficult to measure whatever is more reliable, and hence you will measure it at the fair value of the asset given up, first preference. If that is not available, then the fair value of the asset received, second preference, and third, if that is also not available, then the WDV. So this is the pecking order in terms of selecting at what value you should recognize the assets that you are receiving as a part of the barter. So your journal entry typically will be assets account debit, the new asset account debit to old asset. The old asset will be credited at the WDV and the new asset will be debited at the fair value of the old asset given up. If that is not available, then the fair value of the new assets received, and if that is also not available, then based on the WDV of the old assets given up. This is if the barter has commercial substance. If the barter lacks commercial substance, that is, it is a barter on paper only, where the position of the entity pre and post the barter does not undergo any change, in which case the barter will be recognized at WDV. This will be the WDV of the assets given up. If the question remains silent, we would see the nature of the assets. If the nature of assets are similar, then we can say that it is a barter lacking substance. But if these are different assets, then the barter has substance. If the question remains silent, it just says plant X is exchanged for plant Y. We don't know the nature of X or Y, in which case we will assume that the barter is a genuine barter and it does not lack commercial substance. That is, it has substance, and you will record it in the usual way. So this is your first part. Second part is subsequent expenditure. The general rule over here is subsequent expenditure which increases the life or efficiency beyond what is originally assessed will be capitalized. Otherwise, you will expense it to the P&L account. However, a special guidance over here applies for major replacements, major overhaul, and major inspections. So if you look at major, let us say replacement, in which case you will take the WDV of the entire asset, to which if there's a major replacement, you will add the cost of the new part, and then at the same time subtract the WDV of the old part. So basically, if there's a major replacement, major overhaul, or major inspection, you will add the cost of that major component and subtract the WDV of the old component. Further, if there was, let us say, a subsequent repair on a damaged asset, you will see whether the damage resulted in an impairment and reduce the value of the asset, in which case the subsequent repairs will be capitalized. However, if there was no impairment or loss due to the damage, then the subsequent repair cost will not even be capitalized. A further guidance for a major replacement would be that what happens in case you have to add the cost of the new part. That will be easily available, but how will you subtract the WDV of the old part? Well, we don't know the WDV of the old part, in which case we will take the notional value. So we will say that let us take the notional cost of the old part. So the notional cost of the old part would be based on the cost of the new part. So if you have a fair value, or if breakup in the supplier's invoice is available, nothing like it, but if not, then you will take the cost of the new part as a proxy for the old part. But the new part is purchased. Now the old part was purchased, let us say, a few years back, and hence you might have to do adjustments like a time value adjustment to find the value in the asset which is attributable to the old part, and then you further depreciate it down to find the WDV of the old part. Okay. Next, you look at subsequent valuation. This is the third part. Subsequent valuation can be using the cost model or revaluation model. Cost model will take the initial cost less accumulated depreciation less accumulated impairment, and that will give you the WDV. But if you were to follow revaluation model, which is an accounting policy choice, you can take the fair value, and this fair value can be determined at sufficient intervals, less depreciation till the time you again find the fair value on account of a revaluation. So basically, you can take the fair value. Fair value is to be done at sufficient intervals, and sufficient intervals are defined as annual intervals for assets which have volatile values, and it can be anywhere between 3 to 5 years for assets which have fairly stable values. So the selection of cost versus revaluation model is to be done for what we call as a class of PP. What do you mean by class of PP? Means assets having a similar nature and end use will have to follow the similar valuation model. So this is the valuation model to be similarly applied for a class or a category of PP. Different classes can have different valuation models, but within a single class, you will have a single valuation model. Further, when you are looking at a revaluation, if there is an initial upward revaluation, the gain will go to the revaluation reserve as a part of OCI. This is a part of a non-reclassifiable OCI. If it is an initial downward revaluation, then as per prudence and conservatism, the gain or loss will go to the loss over here will go to the profit and loss. What happens if there was an initial upward? So you took a land from 100 to 150, and there is a subsequent downward. You go from 150 to, let us say, 80, in which case you will first reverse the balance from the revaluation, and then excess, if any, will go to the profit and loss account. Further, if there is an initial downward, that is from 100 you go down to 80, so there's a 20 rupee loss, and then you further increase it all the way up to 150, in which case you will have a reversal. You will reverse the 20 first against the P&L, and excess, if any, will go against the revaluation. So this will be the treatment for revaluation. One needs to remember that revaluation reserve is a part of a non-reclassifiable OCI, which means on happening of certain events like a sale of an asset, the balance in the revaluation attributable to that particular asset will be transferred directly to the retained earnings and not to the statement of profit and loss. At the time of sale, the balance in the revaluation pertaining to that particular asset individually has to be transferred. It cannot continue in the revaluation. Further, this is okay, this was a mandatory treatment. Further, you are also optionally permitted to transfer the balance in the revaluation to the retained earnings in the ratio of depreciation. However, this is not mandatory. An entity, if it wants to, it can transfer, otherwise this is not a mandatory requirement. Okay, so this is pertaining to revaluation. Again, there may be certain cases where you are following the gross block method, where you're showing the asset at gross block less accumulated depreciation to find the net block. And in such cases, if you follow the revaluation model, there are two possible ways in which you can solve. You can proportionately change, let us say, the gross block and the accumulated depreciation in line with the fair value, or you can reverse the accumulated depreciation, find the WDV and then do the revaluation as the case may be. Okay, the last part over here is depreciation. Depreciation is due to passage of time, obsolescence, etc. And there are various methods like SLM, WDV, units of production, etc. which can be followed. For charging depreciation, you need to look at the residual value, the estimated useful life, which are accounting estimates, which the Ind AS wants the management to review on an annual basis. So you'll have to annually review your estimate of the salvage value, your estimate of the useful life, and accordingly figure out the depreciation. If there's a change in the useful life or the salvage value, it is a change in accounting estimate which has to be applied for prospectively and not retrospectively. Further, it is possible that there is also a change in the method of depreciation. So you decide to change from SLM to WDV or vice versa, which is treated as a change in accounting estimate. The selection of a method of depreciation is treated to be based on your estimate of the pattern of benefits an entity expects to receive from the asset, and hence if there is a possible change, that is treated to be a change in accounting estimate which has to be applied for prospectively and not retrospectively. Okay, then you have something like a component method of depreciation. A component method of depreciation refers to a method of depreciation whereby you will componentize an asset. So there is a possibility that an asset has major components. These major components may have a different useful life as compared to the life of the original underlying asset. Like you buy a furnished flat, in which case the flat might have a life of 50 years, but the furniture might have a life of 10 years. You will try to componentize. You will try to find how much of this total value that you are paying is attributable to the flat, building, and the remaining attributable to furniture. The furniture will then be depreciated over 10 years. The flat will be depreciated over 50 years. While doing a component method, one needs to remember that you will also try to componentize a possible inspection or overhaul cost. So if an asset is such which requires an inspection or overhaul, for example, every 4 years, then out of the initial value of the asset, we will say that some part of the asset will have a life of only 4 years. The remaining part might have a life of the remaining 10 years. So you will somehow try to find the inspection amount. If an amount is available, well and good. Otherwise, you can use, let us say, the cost of the inspection likely after 4 years as a proxy for finding the part of inspection cost which must be embedded within the overall asset. And you will try to componentize in a similar manner. So basically, the long story short, in case of component method of depreciation, you will try to depreciate the components over the life of the component or the life of the underlying asset, whichever is shorter. And component method is mandatory in case the asset has major components, and these components have life which is different from the life of that of the asset. So this is in case of a component method of depreciation. We have discussed the changes in the provision for site restoration under the cost as well as the revaluation model. So this kind of broadly reviews the major parts of this topic. We will do questions. There are two questions by and large. One is a question which is a study material question which has come in the exam. This is important. Another question from the May 23 material which is kind of an overlap over this question, but there are a few other adjustments as well. As we have done earlier as well, what we will do is we are not going to read through and solve each and every part of this question, but we will discuss the important adjustments as well as things that you need to remember. So over here, if you want, you have the questions in front of you. If you want to review a question properly, you can pause the video, read and proceed, but in my opinion that is not needed because you're not watching this or you're not studying this for the first time, hopefully, and hence you would have a broad sense of the question, and hence this will help you in refreshing your adjustments in general. Okay, so if you review this question, so on 1st April, Sun purchased some land for 10 million, including some legal costs. So the cost is already included and hence you don't need to separately add. So this is 10 million cost of the land to construct a factory. The work has started on 1st May 11. Okay, the land was purchased on 1st April, but the construction work started on 1st May, and Sun incurred the following cost. So preparation on leveling of land directly attributable will be added. Purchase of materials for construction, again material cost will be added. Employment cost is 2 lakh per month, but that is 2 lakhs into the period of construction. So that is starting 1st of May till the time the construction is completed. If you read below, it is told that the factory construction is completed on 30th November. So 1st May to 30th November, that is approximately 6 months. So this is into 6 months and you will add. Similarly, the overhead cost which is directly incurred for construction 1 lakh per month, again into 6 months. The ongoing overhead cost which is allocated, so these are general overheads which are merely allocated and hence these are generic in nature, will be taken to the P&L, not be added. Income received during the temporary use as a car parking, again not directly attributable, will be taken to the profit and loss. Cost of relocating the expenses, employees, remember relocation cost is not considered to be directly attributable and hence it will be taken to the P&L. Cost of the opening ceremony, inauguration expense will also be taken to the P&L. So these all expenses are not directly attributable. Incomes, if any, are also not directly attributable, which will be taken to the P&L. So the factory was completed on 30th November and hence it becomes ready for use on 30th November. It might be put to use later. Depreciation starts the moment it is ready for use. We are being told that this is considered to be a substantial period of time as per Ind AS 23 and hence borrowing cost, if any, will be capitalized during the period of construction, which is around 6 months. The production began on 1st February. That is fine. You will start depreciation from 1st of December. That is for 4 months. You will depreciate irrespective of when it is actually put to use. So the overall life of the building is 40 years and hence the depreciation will be over 40 years, but this is only on the building element. Land element, remember, is not depreciated. It is estimated that the roof will need to be replaced after 20 years and the cost of replacing the roof at the current prices would be 30% of the cost of the building. So we will first have to find the cost of the building and 30% of that will be attributable, let us say, to the roof, and hence there will be a component method of depreciation whereby once you find the total cost, you will componentize it. Land, no depreciation. Building element, you will say that 30% of that will have a depreciation over a 20-year life and the remaining 70% will have a depreciation over the 40-year life. Okay. At the end of 40 years, Sun is an obligation to demolish and restore. So there's a site restoration obligation which is estimated to cost 20 million. But in present value terms, the discount factor is at the rate of 8%. Present value is 0.046. So 20 million after, let us say, 40 years in today's terms will equal to what? Approximately 9,20,000. The construction was partly financed by a loan of 17.5 taken on 1st April. So the loan is taken on 1st April, but this was to finance construction. Construction started, let us say, on 1st of May and hence the commencement date as per Ind AS 23 will be the later of the date when loan is taken, expenditure incurred or activities commence. So over here we can clearly see that the activities and construction commence on 1st May and hence the capitalization will start from 1st May onwards and will continue till the time the construction is completed, that is 30th of November. So for 6 months you will have a capitalization. The loan had an interest rate of 6% and Sun received investment income of 1 lakh on temporary investment. We are assuming that this investment happens only during the period from 1st May to 30th November in line with the institute solution and hence your borrowing cost to be capitalized would be 17.5 million into 6% into 6 by 12, whatever the number you get, minus you will have 1 lakh which is income on temporary investment and hence the net borrowing cost will be capitalized as per Ind AS 23 principles. So over here compute the carrying amount of the factory as on the balance sheet on 31st March. Okay, so if you go to see calculation over here, we said includes the cost of the land, leveling, materials, employment costs, directly attributable overheads, site restoration and borrowing cost less income on temporary investment. So this is 1 crore 99 including the cost of land, out of which we can say 1 crore is attributable to the land and hence the remaining 99,12,500 will be attributable to building. Out of the total cost of the building, 30% is attributable to the roof. So 99.125 lakhs into 30%, let us say, will be attributable to the roof and hence the depreciation over here will be over 20 years. Remember, depreciation starts from 30th November and hence it will be over 4 months only. So this is 49,000 approximately for depreciation. For the other part of the building, 70% over here would be depreciated over the remaining 40 years and hence 57,000 will be approximately the depreciation and that will help you in calculating the carrying value. Okay, so this is question number 1. Question number 2 honestly is on largely similar lines. It is a paper exam question of 23. So there are a few other adjustments over here and hence I am again discussing this to give you a better perspective, though question 2 is a much more exhaustive question as compared to question number 1. So over here on 1st May, Sanskar purchased 42 lakh worth of land for construction of a new warehouse. So this is 42 lakhs for land. The land had an old temporary structure which had to be demolished, and for the construction, the salvage material was to be sold as scrap. The construction started on 1st June and the following costs were incurred by the company. So again, the construction is starting a month later. So legal fees for purchasing land, this will obviously be added separately. Architects and consultants fees will be added. Cost of demolishing, again this is directly attributable, will be added. Site preparation charges for the warehouse, again this will be added. The purchase of cement and other materials for construction including GST of 1 lakh, and GST credit is 50% of the payment. So there is 50,000 worth of GST which is creditable, and hence that will not be included as a part of cost, and hence we will remove 50,000 from this working. Employment cost for construction workers is 8 lakhs, will typically be added. General overheads, they are generic in nature and hence will be taken to the P&L. Overhead costs incurred directly for construction, okay, this will be added. Income received from temporary use for parking, this is also to be taken to the P&L. So over here you've been told that the receipt of 35,000 from the sale of salvaged materials from demolition of existing structure. So over here we'll say that the demolition cost is 1,35,000. However, 35,000 is directly attributable, it is income against this cost of construction, and hence this will be subtracted. Materials costing 40,000 was wasted, and further 1,20,000 was spent to rectify the wrong design work. Now here there is an interpretation issue, and hence institute has given you two alternative solution in the suggested answer. So materials costing 40,000 was wasted. So we are assuming there is 15 lakh of materials, will include the 40,000 of materials which have been wasted, but these are abnormal in nature, and hence one of the assumptions is you will subtract this because this cannot be capitalized. The GST impact on that has been ignored. And another 1,20,000 was further spent to rectify the design work. Now, is this 1,20,000 over and above the cost that has been mentioned in the table, or is it already included? We don't know. Institute has given you both the alternatives. They said that if you assume that this is over and above the cost that is given in the table, then you don't need to give any effect. However, if you assume that this is already a part, then you will have to give the effect. A similar sum is also there in the study material where they have assumed implicitly that this is a part of the cost, and hence we are solving it accordingly, where we are saying that okay, this 1,20,000 must be a part of the cost, and hence we are deducting. Having said that, in line with the institute solutions in the suggested answers, you can also have an alternative assumption for the same. The employment cost are for 10 months. This is for 10 months. However, we have to see when is the asset ready for use, because only that much of employment cost can be capitalized. The construction of the factory was completed on 20th February, which is a substantial period of time, which means the construction started from 1st of June, got completed on 20th of February, and hence the construction continued for I think around 9 months. So this would be 9 months. So when you look at your employment cost, you will say that this is 8 lakhs into 9 by 12. So basically 8 lakhs into 9 by 10. So this is for 10 months. We will only take the 9-month cost for the purpose of capitalization. The use of the warehouse commenced from 1st March. So there will be a 1 month depreciation. The overall life of the factory was 25 years from the date. However, the roof again has a life of 15 years. And the cost of replacement of the roof will be 25% of the total cost of the building. It is same as the last question, where you will try to find the cost of the building. To that, 25% will be attributable to roof, where you will have a 15-year life and a depreciation for 1 month during the current year. For the remaining part of the building, you will have a 25-year life and then again a depreciation for 1 month in the current year. At the end of the 25-year life, there is a demolition requirement, and the cost of demolition is going to be 80 lakhs on a present value basis, which is given at a rate of 0.092. So this is 80 lakhs into 0.092, and you will get the present value of site restoration. Okay, again you have raised a loan of 60 lakhs at 10% on 1st June. The building meets the qualifying asset, and hence for 60 lakhs into 10% into 9 by 12, you will capitalize minus the income on temporary investment of 25,000 you will deduct, and that is the net borrowing cost to be capitalized. Assume the cost of demolition of the old structure is directly attributable to the cost of the land. So we will take that along with the cost of the land. So the significance of this is when you are trying to find the depreciation, you have to segregate the land and the building element separately, and on the demolition cost of 1,35,000 including the 35,000 income, we are attributing it to the cost of the land. The company follows the straight line method, and you are required to find the cost of the warehouse. If I go to see in the cost of the land, there is a purchase price, legal fees for directly attributable, and the net cost of demolition. So 44,50,000 is attributable to land. Everything else is attributable to the building, as you see. And hence for the building there is 38,56,000, out of which one can say that 25% is attributable to the roof and 75% is attributable to the other part of the building. So over here 25% is attributable to the roof with the 15-year depreciation, 75% to the other parts with the 25-year depreciation. Okay, and accordingly you can find the carrying value. So this takes care of PP, one of the bigger standards. Based on PP, you have another standard which is Ind AS 38, which is on intangibles. So intangibles, if you do the PP, intangibles should be a fairly more manageable standard. So when you look at intangibles, Ind AS 38, a tier 2 category standard, first we need to figure out what is meant by an intangible asset. Well, under an intangible asset, there are three features. First, it should lack physical substance. That is, it is intangible in nature. Second, it should be non-monetary in nature. And third, it should be identifiable. Identifiability is important. Identifiability arises from either separability, which means you can separate it out and sell it separately, or it arises from a contractual legal license or a right that is given, like a telecom license. Even if you are not allowed to sell it separately, is a contractual / legal license. A patent, for example, is allowed to sell separately, in which case it is a separable item. So an intangible has to be identifiable. Items like preliminary expenses, deferred revenue expenses, etc. cannot be separated out and sold separately. Again, major advertisement expenses or major training expenses cannot be separated out and sold separately. Further, they do not give you a license or a right. They might give you future economic benefits, but not a license or a right. And hence, these so-called deferred revenue expenses, big advertisement expenses, big training expenses, preliminary expenses are not to be treated as intangibles, and expenses will be recorded in the P&L as and when they are incurred as per generally accepted accounting practices of accrual. Further, for you to recognize an intangible asset, an important point that you need to know is that obviously it has to be identifiable, it has to meet the conditions of intangibles. However, it is something where you should be capable of getting a future economic benefit. So if the future economic, so it should be controlled by the entity, like a human resource can give you future economic benefit, but it cannot be controlled by the entity in general, except if you have license on the right to use the players in case of, let's say, IPL or etc. Or when we look at, let us say, research and development expenses, they may not necessarily give you benefit. Like a research expense may not necessarily give you benefit. So for something to be recognized as an intangible, it has to meet the criteria of intangible. It has to be controlled by the entity. The human resources are not controlled in general, and is capable of giving future economic benefits. Usually research expenses may not be able to give you future economic benefits. And third, and the most important thing, is that the cost should be measurable. A lot of self-generated assets like internally generated brands, etc. may not have costs which can be determined reliably, and hence you cannot show that separately as per Ind AS 38. However, if you are acquiring them as a part of a business combination and they have a separate fair value as per Ind AS 103, then at the stage of business combination you can recognize them separately. So over here they should be something where cost is to be measured reliably, and it should be controlled by the entity and capable of giving future economic benefits. Okay, usually human resources are not controlled by the entity and hence cannot be shown. However, in certain cases, if you have contractual restrictions like licenses on players, where even if the player want, they cannot leave the club, in which case you can show that as an intangible asset, but again that depends on the terms and conditions of these licenses. Next, a couple of special cases involving research and development expenses. Research expenses during the research, that is the ideation phase, till the time there is no feasibility, etc., will always be expensed to the P&L, no questions asked. However, if you are in the development phase, that is, let us say you are no longer in the ideation phase, you have, let us say, you are trying to find a cure for HIV/AIDS, you are still in the research phase. You find a molecule which can cure the HIV or kill the HIV/AIDS virus, in which case you are now in the development phase. You will incur a lot of expenditures even during the development phase, doing clinical trials, getting approvals, etc. These expenses can be capitalized subjected to conditions. The conditions over here is that it should be technically possible to make this asset, should be legally permissible to sell this asset, there should be a market which is available, so financially feasible, and lastly cost is measurable. If these four conditions are satisfied, then expenditure during the development phase will be capitalized. If any of these are not satisfied, then even expenditure during the development phase will be taken to the profit and loss account. If the question tells you that the management is not sure whether it is in the research or development phase, Ind AS says you assume that it is in the research phase and hence expense it out. Further, if you are in the development phase, you will not amortize the asset because it is not yet ready for use. However, you are required to test it for impairment annually. Intangibles under development will be tested for impairment annually, and hence you will have to compare the carrying value of the intangible under development with the recoverable value, and if there is an impairment or write off the impairment, as the case may be. Okay. Further, a special case over here is on account of in-process R&D. Typically, your research expenses will be taken to the P&L. However, if you are acquiring, let us say, another company, and as a part of it, you are acquiring the research work done and you are paying something for that, Ind AS 103 applies and not Ind AS 38, and thereby you will take it over at fair value. However, your own research, you will take it to the profit and loss account necessarily. Okay, the next important principle over here is amortization, and within amortization, if intangibles have a finite life, which can be a legal life or the life over which you expect to receive benefits, if intangibles have a finite life, then you will amortize over the finite life on a systematic basis, and if there is no systematic basis clearly evident, then on a straight line basis. However, the standard very clearly tells you that a revenue based amortization is not permitted. It is not considered to be an appropriate base to amortize unless the intangible itself amortizes based on the revenue. Like a publisher, you have a publishing right based on the number 10 lakh copies sold. So till that, as each copy gets sold, you can amortize. But other than that, revenue based amortization is considered not to be appropriate. If an intangible has an indefinite life, in which case, as per Ind AS, there would be no amortization. There is no 10-year rule, etc. There will be no amortization. However, an intangible with an indefinite life will be tested for impairment annually. So this is a second point where you test for impairment annually. There are 3 points: goodwill under business combination, Ind AS 103, intangible with an indefinite life, and intangible under development has to be tested for impairment annually. Each of these items are not impaired. They are not amortized, but they will be tested for impairment annually. Okay, then you have some other accounting practices are same as that of PP. Initial recognition at cost, subsequent expenditure you will capitalize, major replacement, etc. you will capitalize. Subsequent evaluation can be using the cost model or revaluation model. When you are doing the revaluation model for Ind AS 38, revaluation model can only be done if the fair value can be found from an active market. So that is an additional thing, and otherwise your depreciation, instead of depreciation, you have amortization principles over here. So basically, the principles for Ind AS 38 are by and large similar to what you study for Ind AS 16. So if you do Ind AS 16 properly, Ind AS 38, at least the accounting elements, barter, deferred consideration, all of this can be fairly well sorted. So if you go to the questions over here, there is, I think, one question on Ind AS 38, which came in the January 21 paper. So if you just touch upon that question, you can go to question number 1 for Ind AS 38. So in this particular case, there are 3 circumstances. If you go to see, there is a company called as Super Sounds, and there have been 3 instances that have been given. First is the calculation of goodwill, where Super Sounds acquires a company called as Music for 1320, and the net assets were 10 lakhs, and as a result, there is a goodwill which will appear of around 3,20,000. Now this goodwill as per Ind AS, this is goodwill as per Ind AS 103, and this goodwill is not amortized. It is only tested for impairment annually. So over here we have been told that the life is 10 years. This is irrelevant. As per 103, you will not amortize the goodwill. It will continue to remain at 3.2 lakhs only. In the second case, on 4th May, there was a franchise which was obtained by paying 80 lakhs. Now ideally this will be a part of the cost. Let us say this is 80 lakhs. It will be a part of cost, and there is a 2% fee of the annual revenue. Now this is not a directly attributable cost of acquisition. It is linked to operations. So if you don't operate and generate any revenue, you don't have to pay anything regarding 2%. So what is directly attributable to acquisition is 80 lakhs, and this is incurred. So the franchise expires after 5 years, and the revenues are given to you, and even the projected revenues are given. So there are 2 ways in which you can amortize. You can either take the 80 lakhs. So basically the 2% fee will go to the PNL only. So if the revenue in the first year is 10 lakhs, 10 lakhs into 2%, that is 20,000, is linked to operation, linked to the revenue one, and hence it will go to the PNL. It will not be capitalized. However, when you are looking at, let us say, 80 lakhs, this 80 lakhs will be capitalized. Now this will be amortized over 5 years, either in the ratio of revenue, which is inherently not an appropriate ratio, or if there's no other systematic basis, then no straight line basis. So ICAI has correctly amortized this on a straight line basis. So over here, this is 80 lakhs. So this is 80 lakhs, and ideally this will be amortized over approximately 11 months. However, somewhere at the bottom you have been told that for this question, full amortization in the year of acquisition, you have been told that, and hence for simplicity you are taking the full amortization in the year of acquisition. So this is 80 divided by 1 by 5, this is approximately 16, and 80 minus 16 will come to, let us say, 64. So this is going to be your value of intangible. Franchisee rights. On 4th July you acquired a copyright, and for that you paid 2,50,000 to register the patent, and another 7 lakh to successfully prosecute an infringement suit. Now infringement suit protection is an expense which will go to the P&L. So over here the patent will be recognized at 2.5 lakhs. Again, this is acquired on 4th of July, so approximately a 9-month amortization. However, you are amortizing it for the entire year, and since the life is 10 years, this is around 0.25, and hence there is 2.25. So basically you will have a goodwill of 3.2, a franchisee right of 64 lakhs, and a patent of around 2.25 lakhs in your intangible section. And in the P&L within expenses you will have 7,50,000 legal expenses, as well as 2% of 10 lakhs, that is 20,000 as your other cost. Apart from that, there will be an amortization during the year of 25,000 plus around 16 lakhs, so 16 lakh 25,000. So basically if you go to see 3 lakh 20 for the goodwill, when you look at the intangible section, there's goodwill, as well as there is 66 and 2 lakh 25,000, that is 66 lakh 25,000. In the P&L there's amortization, annual franchisee fee, and legal expenses. So this covers a lot of aspects regarding intangibles involving the initial cost, amortization, etc. So this is by and large what we review for Ind AS 38. Then you go to Ind AS 40, which is investment property. Now investment property is something which is land or building or both, which is either owned by the SSE or held as a right of use asset, primarily for the purpose of earning rental income or capital appreciation or both, but not held for the purpose of your own use or for the purpose of held for sale. So if these conditions are met, it is an investment property. So there are these 4 conditions to be fulfilled. A few things for investment property. So if you're owning, or if you have taken a property on rent which you are giving out on, let us say, an operating lease, that will be taken as an investment property under Ind AS 40. However, if the property is still under construction, or if the property is vacant, that means the accounting initially will be dependent on what your intention is. So if it is a vacant property, or if it is under construction, if your intention is to give it out on rent, then it can be investment property. Otherwise, if your intention is to use for your own business, it would be taken as PP. The problem arises when the property is currently held but the usage is undetermined. You don't know what is the usage, in which case as per Ind AS 40 you will show this as an investment property. So property held for undetermined use will be taken as investment property. However, property held for sale in the ordinary course will be Ind AS 2 inventory. Property held for use in the ordinary course will be Ind AS 16 PP. And even if it is employee occupied property, a part of it is probably because you want to do employee welfare as a part of your business, and hence it will be accounted for under Ind AS 16, that is property, plant and equipment. So over here you will have various examples for investment property and things which are not even investment property. As we said, that if it is property under construction or for vacant, intention will be looked at. If it is own use, then PP. If it is rental or capital appreciation, that is investment property. If it is undetermined, it is investment property. Now sometimes what might happen is that the property can be held for dual use, which means it is held for the purpose of own use as well as rental. Like you might have a 4-floor building, out of which 1 floor is exclusively held for own use and the remaining 3 floors are given on rent, in which case you will proportionally separate and show the 1 floor as PP and the remaining 3 floors as investment property, because these elements can be separated out. So over here, if both parts are capable of being sold separately, remember you need not actually sell them. Even if they are capable of being sold separately, then we will proportionately recognize each of them as PP and investment property. However, if both parts are not capable of being sold separately, like you have a house, a 4-bedroom house, where one you are using for your own business and the remaining 3 you are giving out on rent, in which case you cannot separate out and sell, in which case we will treat the entire property as a PP unless the own use component is insignificant. So over here your entire working should be PP unless we have been told that own use component is insignificant. The percentage over here has not been defined, so unless otherwise given, we will always assume that the own use component has been significant. The important part. Now, why are we showing investment property separately? It is also land or building, so it can go in PP, okay, but it is to be shown as a separate line item. And the principles for recording investment property are slightly different as you compare it from PP. So a lot of them are similar, like initial recognition is still at cost, barter is still based on the fair values of given up, etc. Deferred payment, subsequent expenditure is still to be capitalized if it increases life or efficiency. Depreciation will still happen, at least on the building component. However, when you do the subsequent evaluation as per Ind AS 40, you can do subsequent evaluation only as per cost model. The fair value model as prescribed by the international accounting standard is prohibited. It is not allowed in India, and hence there is no concept of a fair value or a revaluation model under Ind AS 40 for the investment property. So when you look at investment property, you have to account it as per the cost model only. Revaluation is not permitted. Further, for the building component, you can still continue depreciating because building has a limited life. So even if it is investment property, building depreciation will continue in the usual manner. However, fair value of this investment property has to be disclosed in the notes. Along with the disclosure, you also have to give the disclosure regarding the methods used for fair value determination, the inputs and assumptions used. All of that has to be disclosed. So the two distinctive differences are your investment property has to be accounted for using cost model. It has to be shown as a separate line item in the balance sheet. Secondly, fair value of this property has to be disclosed in the notes. Under PP, if you are following cost model, you do not need to find the fair value or disclose it. And if you are following the revaluation model, you can recognize it at fair value for the PP. So that is the difference. So depreciation will be charged and fair value over here has to be disclosed. If you are unable to determine the fair value, then the reasons for the same will also have to be disclosed. Okay, reclassification, remember, can be done from PP to investment property or investment property to PP at the carrying value on the date of reclassification, but that reclassification can happen only if there is an actual change of use. Merely because if there is an estimated change, that there is a possible estimated change, that does not really matter. If there is an actual change of use, only then can you reclassify. So over here, reclassification can happen if there is an actual change in use. Mere intention to change usage is not sufficient grounds for reclassification, and the reclassification will happen based on the carrying value at the date of reclassification. So there is a possibility that the parent gives a property on rent to the subsidiary, in which case for the parent SFS it is investment property. Subsidiary's individual accounting will depend on what the subsidiary decides to do. It may be a right of use asset. If the subsidiary decides to use it at its own head office, it will be a ROU PP. If the subsidiary decides to sublet it, it will be a ROU investment property. But from a CFS perspective, in the consolidated financial statements, your ultimate decision will not be based on the fact that the parent is giving to the subsidiary. It is depending on what the group as a whole is doing. So if the subsidiary is ultimately using it for its own purpose, that is its head office, then it will be an PP. But if the subsidiary sublets it to someone, in which case it will be treated as an investment property for the group as a whole. The second special case over here is in case of companies which run hotels, for example, they are earning rental income from land or building. However, along with giving this hotel room on rent, you are providing substantial other services like housekeeping, catering, etc. And hence, for you, the income that is there is not just from purely earning rental income or capital appreciation. This is a kind of a business income, and hence the hotels in the books of these companies like Indian Hotels, for Taj Group of Hotels, will be shown as a PP and not as investment property because you are providing substantial other services as well. So over here, this takes care of your basic discussion regarding Ind AS 40. The questions over here are a little interesting, specifically if you consider this along with PP. So these are a few interesting questions. So you have a question where there's a company which is holding building A, which is for the purpose of earning rentals, and hence this is like an investment property. Now you are exploring the opportunities to sell the building if it gets a reasonable amount. Now this is not considered to be sale being highly probable. So merely because this sentence that you are merely exploring possibilities, no. For it to be Ind AS 105, sale has to be highly probable, which requires a lot of other conditions which does not seem to be fulfilled over here. So this building A is treated as an investment property only. When you look at the second information, okay, or further information, building A was purchased, let's say 6 years ago at 10 crores and the life of the building is 20 years. So basically, if I go to see, depreciation till now has been a 6-year depreciation in total. So this is 10 minus 10 upon 20 into, let us say, 6. So as of now, this would be around 7 that will appear at the end of the year. During the year, you also invested in B, again with the purpose of capital appreciation. So even B over here would be investment property. It was purchased at the start of the year at 2 crores and the life is 40 years. So this is 2 again minus 2 upon 40 into 1. So basically I think this will come to, if I'm not wrong, 1.95. So this is 1.95, and hence at the end of the year you will show the investment property at 8.95. This is at the end of the year. In this question you are also asked to prepare the entire schedule as if it is appearing in the balance sheet. So you are not just asked to find the carrying value at the end. If it was just a carrying value at the end, it would have been 8.95. However, if the entire investment property schedule is to be prepared, you will first find the opening balance of building A, which will be after 5 years of depreciation, and then you will charge 1 year of depreciation. Further, as you can see over here, you will charge 5 years of depreciation and then 1 year of depreciation. For building B, this is an addition of 2 crores or 200 lakhs during the year, and during the year 0.05 crores or 5 lakhs of depreciation, and that will give you the closing balance of around 895. So this is around 895 of your values which is appearing. Okay. Then during the year we earned or incurred the following direct operating expenditure. So all of this expenditure is linked to operations and none of this is linked to acquisition. For building A and B, so rental income, this will go to the P&L as income. All the other expenses, including the legal and professional and commission and brokerage, will be taken to the profit and loss because these are operating expenses. Okay. Further, you have been told that you have appointed an independent valuer who has used something like a discounted cash flow method, which is an internationally accepted method for evaluation, and he has used various inputs like the rent per square feet, discount rate, escalation, etc. And considering all of this, the fair value of these properties is 10.5. This fair value has to be disclosed. So in your notes to accounts, you will disclose the 10.5 crores of the fair value along with disclosures on the method used, the assumptions taken, etc. So this is regarding question number 1, where you need to show investment property by preparing a detailed note. After that, in your final balance sheet, investment property will be shown as a separate line item at around 895 lakhs or 8.95 crores as a case may be. And you will also give a note on the disclosure of this fair value along with the assumptions and methods used. Okay, so that takes care probably of question number 1. Next, you go to another question which is a fairly interesting question where you have 3 properties. So you have 3 properties, 1, 2 and 3, acquired on 1st April 2020. You have been given the fair values of each of these properties, and you have been told that property 1 and 2 are used for business purposes. So 1 and 2 will be PPE very clearly. Whereas when you look at property 3, the company is exploring the opportunity to sell 3 if it gets a reasonable consideration. Till the time it is not sold, it has rented it out, and hence this will be treated as an investment property. Sale does not appear to be highly probable here. So you have adopted revaluation model for all of these properties. Now that is wrong. You can follow the revaluation model for property 1 and 2, which are PP, but not for property 3, where you have to follow the cost model. So that is the first error. Second, the depreciation is charged on a straight line basis. That is perfect. However, the company has not charged any depreciation on property 1 and 3 for the current year since the fair value exceeds the carrying amount. That is wrong. Let the fair value exceed the carrying amount. That does not really matter. Depreciation will still be charged. So basically, if I go to see 7,50,000, the life is 10 years. So there will be a 75,000 depreciation, and the property will come down to around 6,75,000. Then you will have an upward revaluation of around 1,25,000, that is comparing it with 8 lakhs that will go in the revaluation surplus in OCI, but that does not mean you will not depreciate it. There will still be depreciation. For the second property, 10,50,000 divided by, let us say, 15, and this comes to around 70,000. This will still be depreciated. Here they have depreciated in 9,80,000, and there's a downward revaluation of around 30,000. This downward revaluation will go to the P&L, whereas this upward revaluation will go to the revaluation surplus. For property 3, you have to follow the cost model, and even if it is investment property, there would be a depreciation of around 80,000, and hence this will appear at around 11,20,000. Now you will compare this with 13 lakhs. No, there will be no comparison, and hence you will continue to show this as an investment property separate line item at 11,20,000, but there will be a disclosure of the fair value coming at around 13 lakhs for this property. Okay, what have they done? The difference between the fair value and the carrying amount has been recognized in the P&L. Now that is also another error. If it is an upward movement, like in property 1, it has to go to the revaluation surplus as a part of OCI. If it is a downward movement, like in property 2, it will go to the P&L. In property 3, it will not even be recorded anywhere. These properties are shown under the heading of PP in the balance sheet. That is also wrong. Property 1 and 2 can be shown in the PP, but property 3 has to be shown within investment property. Analyze whether the accounting policies are correct. The answer is no. So if I were to prepare the balance sheet, in my PPE, I'll have property 1 and 2. 1 is appearing at using the revaluation model at 8 lakhs. And 2 is appearing at 9 lakh 50. So this is 8 plus 9 lakh 50, which comes to approximately, I think, 17 lakh 50. And there is an investment property, that is property 3, which will appear at 11 lakh 20, with a disclosure in the notes that the fair value for the same is 13 lakhs. Apart from that, in your P&L, you will show a depreciation for each of these items. So will be 75,000 for one, I think 70,000 for the second, and I think 80,000 for the third. So there will be a total depreciation. So this is 8 lakh and 9 lakh 50, 17 lakh 50. Property 3 will be investment property, and you will also have a revaluation reserve, which will be shown as a part of other equity. P&L, we don't know all the balances, and hence they have not shown it separately. So that is about it. Okay, so these are the two questions which are quite important when it comes to investment property. So next you will go to another standard, which is Ind AS 36, which is impairment. So the first three standards, I would say, form a single bucket. Next you will go to impairment and non-current assets held for sale, which also form kind of a single bucket when you're revising. So when you look at impairment, impairment refers to the reduction in the carrying value of the asset. To which items will impairment standard Ind AS 36 apply? It will apply to PP, intangibles, investment property, and also investments in subsidiaries, associates and joint ventures if you were to show using the SFS. And you are recording at cost. So by and large, almost all your questions pertain to PP, but there can also be cases of intangibles or investment properties, etc. So how do you calculate impairment? Well, for impairment calculation, you will compare the carrying value, that is a ledger balance, with the recoverable value, and the recoverable value is calculated as a higher of the fair value less cost to sell, similar to net selling price, and the value in use, which is similar to the present value of the future cash flows. So while calculating net selling price, you will take the fair value as on the balance sheet date and subtract from that incremental selling expenses. So expenses which are incrementally to be incurred if there was a sale, you will subtract that to find the fair value less cost to sell, or value in use, which is the present value of future cash flows. While calculating cash flows, you will remember that you will take the cash flows before interest and before tax, and correspondingly the discount rate will also be the pre-tax WACC. For simplicity, it will be the discount rate which considers the risk of the asset, debt and equity both combined. So you will take the pre-tax WACC in general. Further, if there is any further restructuring, etc., that you are expecting, that the benefit of that restructuring should not be considered till the time you are committed to that restructuring. Also, if you have foreign currency cash flows, you will first discount these foreign currency cash flows at the foreign currency discount rate, find the value in use in foreign currency, convert it at the spot rate in rupees, and then do the comparison. So over here you will select whichever is higher, because that is what the asset is capable of giving you. Okay, impairment loss. When does impairment arise? Impairment arises when the carrying value is greater than the recoverable value. So if the carrying value is 100 and the recoverable value is 80, the difference between the two, that is equal to 20, will be impairment. Where is the impairment going to be taken? First, impairment will be adjusted against the existing balance in the revaluation reserve pertaining to that asset, if any, and excess, if any, will be taken in the profit and loss account. Okay. One should ensure that impairment can at best bring the value of the asset to zero. Beyond that, there cannot be any impairment if there is any further cost that will be accounted for as a separate standard, something like Ind AS 37 probably. Now, for impairment testing, you need to find a recoverable value. So do I need to find recoverable value every time? No. The standard says that for three items, that is goodwill, intangibles under development, and intangibles with an indefinite life, you'll have to check for impairment, that is recoverable value testing, annually. But for all other items, you will test for impairment only if the indicators exist. So if there are no indicators, then you don't need to go and check for the recoverable value calculation, because this is kind of time consuming as costly as well. So when you try to do the impairment testing, what are the indicators? The indicators over here can be external or it can be internal indicators. Indicators can involve introduction of a new technology or entry of a strong competitor, etc. Or a lockdown can be external indicators, or internal indicators like loss due to a fire or a flood, or maybe continued cash losses can be taken as indicators of impairment. If there's an indicator of impairment, then you will go ahead and do the recoverable value workings, and if the carrying value is greater than the recoverable value, then there will be an impairment loss. There are certain important pointers for value in use which we discussed earlier, like you have to take the pre-tax and pre-interest cash flows, and you take the pre-tax WACC for the purpose of discounting. Benefits of restructuring, etc. should not be considered till the time you are committed to the restructuring plan. Foreign currency cash flows to be discounted at foreign currency rate to find a value in use in foreign currency, which will be discounted or multiplied by the spot rate to find a value in use in rupees. And if there is a provision for site restoration attached to the asset, then you will usually try to find the net carrying value of the asset after deducting the site restoration provision and compare it with the fair value less cost to sell or the value in use, whichever is higher, after considering the site restoration. Like the buyer will typically give you the fair value after considering the effect of site restoration, and when you find the present value of future cash flows, one of the cash outflows can be also a site restoration obligation. So you ensure that you compare all of these numbers, ideally after considering site restoration cost or ignoring the site restoration cost, but you can't consider some of them before site restoration and some of them after site restoration. Again, while you are doing the value in use calculation, one needs to remember that you will consider the salvage value as well in the value in use calculation, and if there is any regular repairs or maintenance, that will also be considered. Inflation, if available, will also be considered. Generally, Ind AS 36 says that you should try to take a foreseeable future, that is at max around 5 years, unless a longer period can be justified for the purpose of value in use calculation. After that, the value in the form of salvage value, etc. can be considered. Okay, impairment once recorded, can it be reversed? The answer is yes, provided there is an improvement in service potential, that is improvement either in the value in use by improved cash flows or reduced discount rate, or improvement in the net selling price in the form of a higher net selling price. If there is an improvement in service potential, only then can you go ahead and do reversal of impairment. Reversal of impairment is possible for every asset except for goodwill, because this reversal might tantamount in creating what we call as a self-generated goodwill, and as a result goodwill impairment cannot be reversed under any circumstances under Ind AS. So over here you can reverse impairment if there is an improvement in service potential first, and for everything except for goodwill. While you are doing reversal of impairment, you can remember 5 steps. First, you can calculate the carrying value had there been no impairment. Second, the recoverable value, and select lower of the two. So this will be the ledger balance that you can record after recording the impairment reversal. Compare it with the actual ledger balance, which is after impairment, and the difference between the two is the maximum reversal possible. So over here you will find the maximum ledger balance possible after reversal. Compare it with the actual ledger balance, and the reversal will be the difference between step 3 and 4. Okay. Next, so all that you have studied till now is for a single asset impairment. Next, you go to something called as a cash generating unit. When do you go to the concept of a CGU? If the individual asset is not capable of generating a largely independent cash flow. Like when you look at a car can be given out on rent and can earn cab fare, so it can generate a largely independent cash flow. However, if you look at a production line, there is a line of machines that work together, and these machines work together to generate a cash flow. So, and a single machine does not generate what we call as a largely independent cash flow, and as a result, while you are doing this working to find the carrying value and compare it directly with the recoverable value, let us say there's a line of machines and one of them is impaired. If you want to do impairment testing on that one machine, you will not know how much is the cash flow that single machine generates, and as a result you will have to find the entire cash generating unit, and you will try to find not on individual asset basis but on a CGU basis. So what is a cash generating unit? It is the smallest group of identifiable assets which are capable of generating a largely independent cash flow. So there are 3 essential features. It is the smallest group of assets which are capable of, there might be a possibilities that there is output generated by a plant like a mine, and it is given it to a factory in the company only. Like iron ore which is extracted is given to the steel refining factory. So I'm not actually generating revenue, but if I want iron ore has an active market, I can sell the iron ore in the market, and hence I'm capable of generating revenue. And largely independent cash flows not dependent on other items. So that is what you mean by a CGU. How do you do impairment testing for a CGU? You will first calculate the carrying value of the cash generating unit, which includes the carrying value of the individual assets within the unit, plus the carrying value of allocable goodwill, plus the carrying value of allocable corporate assets. Corporate assets can be research and development centers, office buildings, etc., which are also a part of the entire cash generating unit. Compare that with the recoverable value for the entire cash generating units, which is still the higher of the net selling price or value in use, and record impairment. Now this is an impairment on the entire cash generating unit. However, CGU karke you don't have anything in your ledger. However, you have the individual assets. You will have to allocate that impairment loss to the individual assets. 3 sub rules that you need to remember. The first allocation will always go to the goodwill. Once the goodwill is fully impaired, excess, if any, will be attributable to other eligible assets. Eligible assets can include PPs, can include intangibles, etc. It will not be allocated to items like inventories, trade receivables, etc., even if they are a part of your CGU, because these are not covered by Ind AS 36. In the respective standards, whatever is the write-off will be recorded respectively, and hence no impairment loss can be allocated to a trade receivable, inventory, etc. So first you will allocate the impairment loss to goodwill. Then you will allocate it to other eligible assets in the ratio of their carrying values in such a way that the assets balance after allocating this impairment loss cannot fall below its individual recoverable value. So you have to ensure that if you allocate the impairment loss, you are allocating impairment loss to all the assets. If some of the assets can prove that we are capable of generating more, then they will not bear the impairment loss. So the rule over here that you need to remember is you will first allocate the impairment loss to goodwill, then to all other eligible assets, including corporate assets, in the ratio of their carrying values. But third, while doing so, you should ensure that the value of an individual asset does not fall below the individual recoverable value. So over here, so you will first adjust against goodwill, then against all other individual assets including corporate assets, and the allocation should ensure that the carrying values do not fall below the individual recoverable value if available. Okay, so this is your allocation. Further, there is an example here, reversal if any of the impairment loss in case of CGU. The principles are going to be the same. You will reverse if there is an improvement in service potential, and while doing reversal you should ensure that the value cannot go beyond the carrying value had there been no impairment, or the recoverable value on the date of reversal, whichever is lower. While doing so, one needs to ensure that the impairment on goodwill cannot be reversed. Goodwill impairment cannot be reversed. However, for other items where impairment was earlier booked, reversal is possible subjected to certain limits. Okay, so this is regarding reversal of impairment. Now regarding corporate assets have to be, a corporate asset can be allocated between various CGUs. So one office building may be used by 3 different divisions in a company. So how will you allocate this corporate asset? Well, if it is allocable, remember, if it is allocable, you can allocate it on a reasonable basis, and reasonable basis has not been defined. So from the institute's perspective, a reasonable basis is a basis that includes the carrying value and life both. So carrying value into life, you multiply that, considering both of them, you find the number, and you will try to allocate the corporate asset to each of the individual cash generating units in the ratio of the carrying value adjusted for life. If the data on life is not available, then you will allocate in the ratio of the carrying values. Remember, this can be done only if the corporate assets are allocable. However, what if the corporate assets, or even in some cases goodwill, is unallocable? In which case you will have to do a 2-tier impairment testing. A 2-tier impairment testing would mean that you will first calculate the carrying value of the individual smaller CGUs, including the allocable corporate asset, but not including the unallocable corporate asset, if any. So you will do the smaller impairment testing for the smaller CGUs. If there is an impairment, record the same, and then you will find the CGU values after impairment. However, you have not tested for the impairment possibility on the larger CGU, on the unallocable corporate asset. So the unallocable corporate asset can be a part of a larger CGU, which can be company as a whole. So you will again do impairment testing for the company as a whole, which will include the smaller CGUs, including the allocable corporate assets, and separately you will also add the unallocable corporate asset. That will totally give you the carrying value of the company as a whole compared to the recoverable value of the company as a whole. And if there is an impairment here, that impairment will be adjusted against the unallocable corporate assets only, because every other asset is already at their carrying value or recoverable value, whichever is lower. They will not bear any further impairment, and hence if there is an impairment for the company as a whole after doing a smaller impairment testing, that has to be attributable to the unallocable corporate asset or unallocable goodwill, as the case may be. Again, we'll do problems on this in today's session only to get a better clarity. And lastly, impairment in case of a holding subsidiary setup in the consolidated financial statements. So in CFS, if there is a subsidiary and you have prepared consolidated financial statements and there is an indicator of impairment on the subsidiary as a cash generating unit, you will have to do impairment testing for the subsidiary or its cash generating units as a case may be. While doing so, again, you will have to find the carrying value of the subsidiary's CGUs and compare it with the recoverable value for the subsidiary. While calculating the carrying value in the CFS, you will take the individual assets and liabilities of the subsidiary, but you will also have to consider the goodwill that was recorded at the stage of consolidation. Now, this goodwill can be of two types. It can be full goodwill, that is NCI at fair value, or partial goodwill, that is NCI using proportionate net assets method. If you had followed full goodwill method, you will find the carrying value, that is a carrying value of individual assets of the subsidiary plus the carrying value of the goodwill plus corporate assets if any, compare it with the recoverable value directly. Impairment will first be allocated to goodwill, then to other assets, and if you have to find how much of this is going to the parent and NCI, you will attribute impairment loss on both the goodwill as well as the other assets to parent and NCI both, because it is full goodwill. But if it is partial goodwill, there are two problems over here. First, the subsidiary's assets are consolidated 100% perfect, but goodwill, if you have an 80% stake, is only shown at 80%. Recoverable value is for the entire business. In full goodwill, you were comparing it with the carrying value of the entire business, but under the partial goodwill method, you are comparing it with the assets which are 100% but goodwill which is 80%, and hence to ensure a fair comparison, you will gross up the goodwill, the partial goodwill, and you will also record something called as an unrecognized goodwill. So you will take all the individual assets plus the goodwill including the unrecognized goodwill. So goodwill plus the unrecognized goodwill, that will give you the total value. Compare it with the recoverable value, find the impairment. Impairment is again attributable to goodwill and then to other assets. While you are allocating it to goodwill, a part of it will be parent, part of it is NCI. You will only recognize impairment loss attributable to goodwill of the parent, because NCI's goodwill is not recorded in the books. You can't book a loss on an unrecognized asset, and as a result, you will only allocate the loss. Again, we'll do a problem on this to the parent share of goodwill. For other assets, it is both parent and NCI, and hence the impairment loss will be shared by parent and NCI both. Long story short, if it is a full goodwill question and you are asked to do impairment testing, you will find the carrying value in the usual manner, no adjustment to be separately done for goodwill. Compared to the recoverable value, whatever is the impairment, attribute first between parent, then first to goodwill, then to other assets. All the impairment loss will be shared by parent and NCI in the ratio of their stake. Easy working. But when it is partial goodwill, two important differences. First, while recognizing the goodwill for the purpose of impairment, you will take the partial goodwill and then gross it up. Add the unrecognized goodwill, take the total goodwill value, and then do the impairment workings. Once the impairment is arrived at, that impairment will be allocated first to goodwill, which you have found out on grossing up basis, and then to the other assets. You can recognize only the impairment loss to the extent of the parent share, because NCI share of goodwill has not even been recorded in the books. Okay. So if we try to review a few questions over here regarding Ind AS 36. So if we go to Ind AS 36, this is okay. So this is one of the best questions that is there. The LIA limited question, a similar question has also been asked in the past in the exam. So we'll quickly review this. Then is the unallocable corporate asset question, and then is the unallocable goodwill as well as the holding subsidiary question. So three very interesting questions over here. So LIA limited over here is into cold drinks and has various plants. There's a machinery A and there is one more machinery B, which is used by clubbing it with machinery A. You have been told that machinery B cannot be sold in isolation without clubbing it with machinery A. Also, it is said that the company considers this group of assets as a CGU, and an inventory and goodwill are also included as a part of the CGU. This is 1.5 lakhs of goodwill also included as a part of CGU. So your CGU comprises of 4 items: machinery A, B, inventory and goodwill. Sir, inventory can be a part of CGU? Yes. If the management has decided it is a part of the smallest group of assets capable of generating cash flows, it can very well and it should be a part of your CGU. Okay. A was purchased on 1st April 13 for 10 lakhs with a residual value of 50,000. B was purchased on 1st April 15 for 5 lakhs with no residual value. So now you are doing impairment testing. If you read the entire question, you are doing impairment testing on 31st March 18. So from 1st April 13, 5 years have gone by, and hence for machinery A, if I do the working, this will be 10 lakhs minus 10 lakhs minus 50,000 divided by 10 years. That will give you a per annum depreciation into 5. So probably this will be around 4.75 lakhs, and hence your balance will be 5.25 lakhs for machinery A. For B, remember you have been given the useful life is 10 years. So don't go out and say no, B can be clubbed with A, so B's life will be shorter. No. After A's life is over, you can always buy a replacement machine for A and continue as a going concern. So you will have B, which starts, for example, at I think 5 lakhs, there is no salvage value, and over the 3 years that have gone by, 50,000 is the per annum depreciation into 3, that is 1,50,000, and hence 3.5 will be the carrying value. Inventory will be accounted for as per Ind AS 2, which is at 2 lakhs, and goodwill will be at 1.5 lakhs. So if I total all of this, I will get the total carrying value of this CGU, which is around 12.25. Achha, next you have been given the cash flows pertaining to machinery A. This will help me in finding the value in use for machinery A, not for the entire CGU, for machinery A. Okay, so you have been given cash flows in the last year excluding residual value. Why excluding residual value? If I want to find the value in use, even the residual value, salvage value should be a part of my value in use calculations. And the discounting rate is 10%. So if I were to discount this at 10%, you have the numbers, but it is around 4,89,000 and something. So if we go to see, somewhere it is given, it's a pure mathematical calculation, 489,705. So this is 489,705. This is, remember, the value in use for machinery A, not for the entire CGU. 12,25,000 is for the entire CGU. On 31st March 18, professional valuers have estimated the current market value is 7 lakhs. Okay, so this is for machinery A, 7 lakhs, and the valuation fee was 1 lakh. Now this is contentious. Valuation fee is a fee linked to valuation. It is not like brokerage. It is not an incremental cost, which means even if the sale does not happen, I will still have to pay 1 lakh rupees, and hence this cannot be called as an incremental cost to sell, and rightly so, institute has not considered this in the incremental selling expense calculation. So over here 7 lakhs is a fair value. There's a need to dismantle the machinery before delivering it to the buyer. The dismantling cost is 1.5, specialized packing is 25, legal fees is 75. These are all incremental expenses which will be incurred if the sale happens, which will be saved if the sale does not. But valuation fee is linked to valuation. Whether you make the sale or not, the fact that the 7 lakh fair value is determined, I'll have to pay the valuation fee. So 7 minus, you will have dismantling cost of 1.5, packing and legal fees of 0.75 and 0.25, and as a result this comes to around 4.5. Again, this is the net selling price only for machinery A. The inventory has been valued in accordance with Ind AS 2, and the recoverable value of the CGU is 10 lakhs on 31st March 2018. In the next year, so this is given for the entire CGU. So for the CGU, recoverable value is 10 lakhs, it is given, and hence there's a 2.25 lakhs impairment. What will you do with this 2.25 lakhs? Sir, we will first allocate it to goodwill. So out of this 2.25 lakhs, we will first allocate 1.5 lakhs to goodwill, and hence the remaining 75,000 will be attributable to the other assets. Which other assets? A and B. Inventory will not bear any share of this impairment loss, so A and B, and this will be allocated in the ratio of their carrying values. That is 5.25 is to 3.5k ratio mein you will allocate this impairment loss. Everything else which is given is for the next year. So if you go to see over here, you will have 12,25,000, 2,25,000, and goodwill is 1,50,000. The remaining is 75,000, which will be attributable to machinery A and machinery B in the ratio of their carrying values. Now if I don't check anything further, the value of machinery A after this adjustment would be 5,25,000 minus 45, and hence this comes to 4,80,000. But that is lower than the value that A can prove that it can earn. A can earn 4,89,000 or 4,50,000, whichever is higher. And hence A can earn 4,89,000, so A will say that I will not go beyond 4,89,000, and hence the maximum impairment that A will bear will be 5,25,000 can be taken down to 489,705, which means 35,295. But B unfortunately cannot prove that, and hence whatever is the remaining impairment of 39,705 will have to be borne by B. So over here you can say 35,295 and 39,705 will be your final impairment allocations, and after doing all of this you will see that machinery A will appear at 489,705, machinery B will appear at, let us say, 3,10,295, inventory will still continue to appear at 2 lakhs and goodwill will now be appearing at 0, and hence if I total up, I will see 10 lakhs as my value. Perfect. So this is going to be 10 lakhs as my value. Now if you read further, the question tells you that in the next year the company has assessed the recoverable value to be 11 lakhs. Now that can result in a further impairment or it can result in a reversal. We will come to know after you find the carrying value and compare it with the recoverable value. So you will try to find the carrying value. So this is based on the value on 31st March 18. 1 year later, what will happen? Well, these items will get depreciated. So there will be a depreciation on machinery A, which is 489,705. There are still 5 years remaining, divided by 5. However, there is also a salvage value. So this is basically 489,705 minus 50,000 divided by 5. And hence, you will have 87,941 as a depreciation. For example, 87,941 as a depreciation, and your carrying value will be 4,01,764. For machinery B, you are now at 3,10,000. Remaining 7 years. So divided by 7 and 44,000 will be the depreciation, and you are now at 265. So if I want to find the carrying value, I don't know about the inventory, so I'll assume a reasonable assumption that the opening inventory and closing inventory is the same, that is 2 lakhs. So my carrying value of the CG on 31st March 19 will be A, B, inventory is assumed to be the same, goodwill is 0, and hence this is 867. But the recoverable value is 11 lakhs, and hence, assuming there is an improvement in service potential, there is a possible reversal of impairment charge. But while you are doing goodwill impairment cannot be reversed, and hence the impairment reversal is only possible for machinery A and B. How will you do the reversal working? We will first find the carrying value of machinery A had there been no impairment. Had there been no impairment, you would be at 5,25,000. The annual depreciation was coming at around 95,000. So for one more year, 95,000, and this will be at around 4,20,000. Had there been no impairment, this would be at 3,50,000, another 50,000 of depreciation, and you will be at 3 lakhs. This is the carrying value had there been no impairment. Compare that with the recoverable value. After a year, A is still able to give you 4,50,000, and combined A and B is giving you 7,60,000, which means if A alone is giving you 4,50,000, combined I'm getting 7,60,000. That means the additional 3,10,000 is probably coming out of machinery B. So I will compare the carrying value had there been no impairment, that is 4,20,000 over here. So carrying value ignoring impairment, this is I think 4,30,000, sorry my bad, 4,30,000, bad maths, 4,30,000, and compared with the recoverable value, select whichever is lower, that is 4,30,000. Similarly 3 lakh or 3,10,000, select whichever is lower, that is 3 lakhs. So after reversal, you can take your ledger balance of A up to 4,30,000, ledger balance of B up to 3 lakhs. But currently what is your ledger balance? Sir, it is, if you see over here, currently your ledger balance is around 4,01,000 and 265. So basically the difference between these two, 4,30,000 minus 4,01,000 is the reversal. 3 lakh minus 2,65 is the reversal, and this reversal will be taken, let us say, to the profit and loss account. Okay, so this takes care of the all important LER limited question. It is question in its entirety or in its parts is very important from an exam perspective. Next you go to this question where a company has 3 cash generating units with values being given, carrying values and remaining useful life being given. But you have been told that there are 2 corporate assets with a remaining useful life. Now, these carrying values have been given before allocation of corporate assets. So you can see corporate asset X worth 600, and you have been told that the carrying value of X can be allocated on a reasonable basis. We don't know what the reasonable basis is, but you have been given the carrying value as well as the life. So you will have to take the product of the two, because the longer the life, the longer you can utilize the corporate asset. The bigger the size, more of the corporate asset you can utilize. So over here, I can say 5,000, 15,000 and 22,000. So basically X will be allocated to A, B and C in the ratio of 5:15:22. Y has been clearly told that it cannot be allocated, and hence it is an unallocable corporate asset. The recoverable amounts have been given for A, B, C, and then for the company as a whole, you are required to calculate the impairment loss. So first of all, this 600 you will allocate in the ratio of 5:15:22. That will give you, let us say, 71, 214 and 315. So basically, if I go to C, for A, 500 was its carrying value. For B, I think 750 was its carrying value, and for C 1100 or something what was its carrying value. So this was before corporate assets. After allocating corporate assets, this is 571, 964 and 1415. You will compare this with the recoverable value. The recoverable value over here is given as 600. So 571 compared with 600, there is no impairment. There was 964 compared with 900, there is a 64 rupees impairment, and there is 1415 compared with 1400, and there is a 15 rupee impairment. Now this 15 rupee and 64 rupees will be allocated to whom? Will be allocated to the corporate asset as well as the other assets in a proportionate way. So if I go to C, we will say that okay, 64 and 15 is the impairment. You will allocate it to the individual assets in the ratio of 750 to 964, that is 50, and the remaining will be attributable to the corporate asset X. Similar is the working for, let us say, CGU C. Now after all of this, what will happen is, if I go to C, your A including X will be at 571, B was earlier at 964, from which you subtracted 64, so this is coming at 900. C, which was earlier including X at 1415, you subtract 15, and hence this comes to 1400. Okay. However, for the company as a whole, you also have corporate asset Y. You have not considered the corporate asset earlier. You will have to now consider it. Sir, X, well, X is already added along with A, B and C. So if I add the corporate asset Y, which is 200, I will total up all of these to find the carrying value of the company as a whole. 571 plus 900 plus 1400 plus 200 comes to 3071. You will compare it with the recoverable value of ABC as a whole, which is 3200, and hence there is no further impairment. By the way, if the recoverable value was 3150, there would be a 21 rupee impairment, which will have to be absorbed by Y only, because everything else A, B and C is already at the lower of their carrying value or the recoverable value, and hence they will not bear any further impairment. So over here there would be no additional impairment in this particular case. Okay, next you go to question number 3, which is holding subsidiary case, and there is an unallocable goodwill using the partial goodwill method. So over here, Vision acquired 80% of Mission for 190, so this is like your PC. The fair values of the net assets of Mission in the CFS were 200 million. This is like your net assets. It is the group's policy to measure NCI at the proportionate share of fair value of the net assets, which means if I want to calculate the goodwill, this is PC of 190, NCI is proportionate net assets, that is 200 into 20%, that is 40, minus 200, and as a result your goodwill will be 30 rupees. Again, this is partial goodwill which is attributable to your 80% stake. Now there was no impairment on the first 2 years. We have been told there is no impairment. The review for assets into the 3 CGUs and value in use is given to you. So you have been given the intangibles PP and the total value for each of these units, and then the value in use. There's nothing given regarding net selling price, so we will assume that this is itself the recoverable value. If I were to look at the impairment, in the first case there is no impairment, in the second case there is 90 minus 66, that is 24 worth of impairment, in the third case no impairment. Now this impairment will be attributable to whom? Well, it will be attributable to the eligible assets, which are intangible assets and which are PP. Current assets will not bear any impairment loss, so this 24 will be attributable in the ratio of 1:5, and as a result, out of this I would say 24 divided by 6, I think 4 rupees will be taken from here, and I think 20 rupees will be taken out from here. So this is going to be 6, this is going to be 30, and the total comes to, let us say, 66. If I were to see, this total comes to 66. Fair enough. It was not possible to allocate goodwill on a consolidated basis, on consolidation to the individual CGU. So over here you had to do a 2-tier impairment testing, first for the individual assets, and then first for the smaller CGUs, and then for the company as a whole. The intangibles have no ascertainable market value, but current assets have a market value that is at least equal to the carrying value. It further substantiates that you will not bear any impairment loss to the current assets, and the value in use for the entire company is 350. So we have done the impairment testing for these smaller units. Now for the larger units, I would say that okay, for the larger units it comprises of A, B and C. A is worth 170, B is now worth 66, and C is now worth 100. Apart from that, there is goodwill. Now goodwill we have already calculated is 30, but 30 represents partial goodwill. So if I were to do the working, I would say that, well, you know what, 30 is the partial goodwill which is representing an 80% stake. So for an 80% stake, the goodwill is 30. So for the remaining 20% as well, so we'll say 30 divided by 0.8. So this is 20%, this is 7.5, and hence for the 100%, the goodwill would be 37.5 plus 170 plus 66 plus 100, and hence this comes to 373.5. Now 373.5 to be compared with the recoverable value of 350, and hence there's a 23.5 impairment. Now this impairment will first be absorbed by goodwill. In this case, every other asset is already at the lower of their carrying value of recoverable value, and hence 23.5 is attributable to goodwill. Now this 23.5 is calculated based on 373.5. 373.5 is calculated based on 37.5, and hence when I look at 23.5, this is 23.5 of impairment on the goodwill of 37.5, but 37.5 is 100% of the goodwill. So if I were to look at the impairment, this is 23.5, of which I would say 80% is attributable to the parent, the remaining 20% is attributable to the NCI. So over here 23.5 into 80%, and you come to 18.8. The remaining, if I go to see, the remaining I think 4.7 is impairment on this unrecognized part. So if this 7.5 is not recorded, 4.7, which is the impairment on that, also cannot be recorded. However, 30 was recorded, so 18.8, which is the impairment on that, 30 will very well be recorded. And as a result, if I look at the goodwill impairment over here is going to be 18.8, which is attributable to the consolidated profit and loss account. There would be no separate allocation to NCI. Technically 4.7 is attributable to NCI, but the fact that there is no goodwill corresponding to that recorded, you can't recognize an impairment loss on an unrecognized asset, and hence it is 18.8 to be adjusted against the consolidated profit and loss account. So that kind of takes care of question number 3 for Ind AS 36. Next, what you will do is you will go to Ind AS 105. This is also an extension, I would say, when we compare it with Ind AS 36. So we will go to Ind AS 105. This is non-current assets held for sale. So while doing the working for non-current assets held for sale, just a second, let me just reach that. Okay, you have three important terms to start with. So you have non-current assets, which are defined as every asset which is other than a current asset. Then you have a disposal group and a discontinued operation. So it is important to understand the differences as well as the overlaps between disposal group and discontinued operation. So disposal group refers to a group of assets and liabilities which are held for the purpose of sale. So like if I have 10 classrooms and if I want to sell one of them, that is a group of assets, the building, furniture, cameras, equipments, etc. together that I'm holding for sale. So that is a disposal group. What is a discontinued operation? A discontinued operation is a component of an entity, a part of the entity. So it's like a division, a segment of the entity, which let us say is held for sale, or which is kind of discontinued during the year, or which is disposed during the year. So it's a slightly wider term to that extent, where if I have 10 classrooms, a few other businesses as well, and if I intend to sell all the 10 classrooms, so it is a component or a part or a division of my entity which I intend to sell. So this 10 classrooms together will be a disposal group as well as a discontinued operation. However, if I have already sold those 10 classrooms, then it is no longer a disposal group, it is no longer held for sale, but these 10 classrooms have been sold, and hence this can still be treated as a discontinued operation because it has been sold. Sometimes what might happen is, let's say I'm operating in a geography like Ukraine and a war breaks out, I decide to discontinue my operations in that geography, in which case I'm not holding it for sale, I've not even sold it. However, I have discontinued operations, in which case that can also be treated as a discontinued operation. So sometimes what might happen is your group of assets may be a disposal group as well as a discontinued operation, like a 10 classrooms which is a part of the entity which is held for sale, it's a disposal group as well as a discontinued operation. If it is just one classroom out of 10, that is not a component of the entity, and hence it is just a disposal group, not a discontinued operation. If you are discontinuing your operations in a geography like Ukraine, for example, that is just a discontinued operation and not, let us say, a disposal group. So identification over here is slightly tricky, can be relevant for MCQs. Now when we are looking at the coverage of this standard, again like Ind AS 36, this standard includes intangibles, PP, then investment property, even goodwill. and even investments in subsidiaries, associates or joint ventures to be recorded in their SFS if they are recorded, let us say, using cost. What is not covered is every other items like biological assets, deferred taxes, etc. because financial assets, because there are respective standards which will cover them. Even items like current assets. Well, the heading of the standard is non-current assets held for sale, and hence current assets by default do not come over here, and so would liabilities not come in the impairment or a write-off provisions. Remember, in a disposal group, if you intend to dispose a group of assets along with the loans or liabilities, that will be a part of your overall disposal group. Are we clear with this? Okay. So this is the first part. Next, you go to the classification of non-current assets or disposal groups as held for sale. So when you look at classification, when will you say that these are considered as held for sale? Two characteristics have to be met. First, they should be available for immediate sale in the present condition, and second, sale should be highly probable. Available for immediate sale in the present condition means if your asset is still subjected to certain renovation and refurbishment before it is going to be sold, then it is not classified as held for sale because it is not in the condition to be sold. Second, available for immediate sale, which means the asset should not be critical for entity's ongoing operations. You should have arranged for a backup, or if a buyer is available, I should be ready to hand over the keys immediately. So it should be available for immediate sale in the present condition. Secondly, an exception over here is provided that if there is a delay which is arising due to legal or customary factors like a regulator's approval, for example, such a delay can be ignored and you can still say that the asset is available for immediate sale in the present condition. Sale should be highly probable. When is the sale highly probable? If it meets, let us say, 5 conditions. First, active process should be initiated. Second, appropriate level of management should be committed to the sale plan. Third, sale should be likely to be completed within a period of 12 months. Fourth, the sale should be marketed at a price which is reasonable. And fifth, the withdrawal from the sale plan is likely to be, should be unlikely. If all of these conditions are met, then sale is highly probable, and only then can you show something as a non-current asset held for sale. A few important points over here is, remember, abandonment or temporary stoppage is not treated as sale, and hence such items are not held for sale. Further, if there are events that have occurred in the post balance sheet period which show you that the asset is held for sale, then that is not an adjusting event. At the balance sheet date, you will still continue to show it as PP. If the renovation is completed in the post balance sheet period, it will become a non-current asset held for sale from the date the renovation actually gets completed, not before that. Sometimes what might happen is, usually the sale process has to get over within 12 months, but sometimes there is a delay beyond 12 months for factors which is beyond the entity's control, and the entity still continues to be committed to the sale plan, like there is a lockdown in the middle, then you will still continue to show the asset as a non-current asset held for sale in rare circumstances. Okay, if I were to show this as a 105 item, what are the accounting implications? First, you will have to show it as a separate line item, separate from the current, separate from the non-current assets, a separate line item, 0.3 in your Schedule 3 balance sheet, which is non-current assets held for sale or assets held for sale. Secondly, at the date when you classify it as held for sale, you will calculate the carrying value after applying all the respective Ind AS like depreciation, borrowing cost, capitalization, impairment under Ind AS 36. After applying all of this, you will try to find the carrying value and then compare it with the fair value less cost to sell, select whichever is lower. Why? Well, earlier you are holding this asset for use. Now you are holding it for sale. The moment you are holding it for sale, it is like inventory. I will not show it as inventory because I am not selling it in the ordinary course of business, but it is like inventory. And because it is like inventory, I will compare the carrying value with the fair value less cost to sell, something similar to NRV, and select whichever is lower. If the fair value less cost to sell is lower, there is a write-off which will be expensed to the profit and loss account. This is similar to an impairment under Ind AS 105. You can use other words as well, though Institute uses the word impairment. Secondly, after you classify it as held for sale, it is no longer held for use primarily, it is held primarily for the purpose of sale, and hence in line with inventory principles, depreciation would stop. So this is a very important thing. If an asset gets impaired under Ind AS 36, you will still continue to depreciate the asset even after impairment. However, the moment it is classified as Ind AS 105, you will stop depreciating the asset because it is now held for sale, and hence the valuation will be similar to that of inventory, that is lower of cost or fair value less cost to sell at the date of classification as held for sale and also at each subsequent balance sheet date, and there will be no further depreciation. So you will compare the carrying value with the fair value less cost to sell, depreciation will stop, and the assets will be showed and disclosed separately. Okay, Next, what if there's a change in the plan to sell? You classified something as held for sale, and then at a later date you decided that you don't want to sell it, in which case you'll have to reclassify it back to PP. And while reclassifying it, you will try to take the carrying value had there been no held for sale classification, compare it with the recoverable value. Acha, earlier you were going from PP to held for sale, so you are comparing it with the fair value less cost to sell. Now you are going from held for sale to PP, and hence you will compare it with the recoverable value. Select whichever is lower, and the difference between your existing ledger balance and the lower of the carrying value had there been no held for sale classification, or the recoverable value, whichever is lower, that difference will be taken as a gain or loss on reclassification, which will be adjusted against the profit and loss. Next, what if it is a disposal group? The accounting over here will be very similar to what you do for cash generating unit. That is, you will first try to find the carrying value of the disposal group. That includes the carrying value of the individual assets. That includes the carrying value of the individual assets and liabilities, plus the allocable goodwill, plus everything else what you intend to sell. Compare it with the fair value as cost to sell. If there is an impairment under Ind AS 105, it will first be allocated to goodwill and then to all other eligible assets like PP, investment property, etc. PP, investment property, intangibles, etc. You will attribute it to other assets in the ratio of their carrying value in such a way the value for the individual asset cannot go below its individual fair value as cost to sell. Exactly similar to what you do for impairment, just that one needs to remember that even after impairment, you continue depreciating. Like when you did the LR limited question, in the next year you depreciated the asset, but the moment it is classified as held for sale, depreciation would stop. Lastly, discontinued operations. In case of a discontinued operation, you will give a separate disclosure for this discontinued operation in your profit and loss account, a separate line item for the gain or loss on discontinued operations along with the tax impact to be shown separately. Such a disclosure is not required if it is merely a non-current asset or a disposal group held for sale. This is needed only in case of a discontinued operation. Okay, considering that, there are a few questions that we will try to address for Ind AS 105. So the first question: on 1st June, we plan to sell a group of assets and liabilities, which is a disposal group. Very clearly told to you, it's a disposal group. On 31st July, the board approves and becomes committed to the plan to sell. So this commitment comes on 31st July. Earlier, you were just planning. Now you are committed by entering into a firm purchase commitment with entity Y. So maybe a buyer has been identified. However, since a manufacturing unit is regulated, the approval is needed, and the approval is customary, highly probable, and is going to come from on 30th November. So because it is customary, this delay will be ignored. You will not consider it. The sale is expected to be completed by 31st March 12. That is within 12 months. X follows the December year end. So over here, when is the sale considered to be highly probable and the asset considered to be held for sale? This is 31st July 11 when the entity becomes committed to the sale plan. The delay up to 30th November is to be ignored because this is a customary delay and hence it can be ignored. The assets and liabilities are given to you, so you have been given the carrying value on 31st December 10. Honestly, this is not required because you are classifying it as held for sale from 31st July, and you have been given the carrying value on 31st July, which is around 2,600. The fair value of the unit on 31st December 10 is 2,000. We don't need to see that. Well, because it was not classified as held for sale then, and there was no indicators of impairment as well, no recoverable value workings. And as on 31st July 11 is 1850. The cost to sell is 100 on both the dates. So if I were to compare this with fair value as cost to sell, this is 1850 minus 100, that is equal to 1750. And hence if I take the difference, probably this difference comes to 850. This 850 will first be written off against goodwill. So this goodwill will become 0. And the remaining 350 will be attributable between plant and building in the ratio of their carrying value. So basically, the remaining 350 will be attributable between plant and building in the ratio of their respective carrying values. Okay, the disposal group is not sold till 31st December 11 and the fair value on 31st December 11 is lower than the carrying value as on that date. So there would be a further write-off. We have not been given the fair value as cost to sell on 31st December 11 and hence we are just going to give a theory answer over here that we will compare the carrying value with the fair value as cost to sell, and there would be the further write-off which will be adjusted against the plant and building again in the ratio of the revised carrying values. So over here, if I were to see, we are saying that it is classified as a held for sale item on 31st July. 850 impairment to be allocated 115 to the plant and 235 to the building, and 115, 235, and then you will total up. So this will come to around 1750. So this is regarding so over here you have sub point 3. This is regarding question number 1. Next you go to question number 2, which is kind of a much more numerically intense version of question number 1, where you say that you have the CFS and you have the carrying value of all of these items. This is the carrying value on, I think, 31st March 11. Acha, next you have been told that on 15th September 11 A decided to sell the business. So this business A decided to sell on 15th September. It is noted that it meets the condition of disposal group which is held for sale as per 105. It does not meet the condition for discontinued operation. Fair enough. So on 15th September you have been given all of these data points, and thereby you have been given 2160 in thousands is the carrying value. You propose to dispose at 1900 in thousands, and the cost to sell is 70 in thousands. So this will come to 1900 minus 70. So this is probably 1830. 2160 minus 1830, and this comes to, let us say, 300 and 1900 minus 70, that's 1830, and 2160 minus 1830, and it comes to 330. So there will be a write-off of 330, which will first be adjusted against goodwill, and the remaining 130 will be adjusted against other eligible assets, that is intangible assets and PP. Everything else like financial assets, deferred tax, current assets, liabilities will not be covered under the impairment provisions of 105, though for the purpose of disposal group, if you are disposing of everything, the buyer is going to pay you for everything, and hence it will be a part of the disposal group carrying value. Okay. At 31st December 12, there has been no change in the plan to sell the disposal group, and entity A still expects to sell it within 1 year, and you have been given certain values of assets and liabilities, but you have not been given all of them. Well, probably you have not been given the value of goodwill, intangibles and PP, because the remaining 130 has to be attributable between these two in the ratio of 930 is to 1020. So you will say that 330 is the impairment, 200 goes to goodwill, and the remaining 62 and 68 goes to the others. So over here you will have minus 62 minus 68, and hence 930. So this is, I think, 868, and this is 1020 minus 68, which is 952. Okay, now going further, intangibles will not be amortized and your PP will not be depreciated. So this will continue to remain at, I think, 868 and 952. Goodwill is 0, and hence at the end of the year this is 410 plus 230 plus 400 minus 900 minus 250 plus 868 plus 952, and hence this is 1710. Okay, at the end of the year you will compare this with the fair value as cost to sell, that is 1650, and hence there is a impairment loss of another 60, which will be attributable again to the intangibles and PP in the ratio of 868 is to 952. So if you go to C, we will have 60, which is going to go in the ratio of 868 is to 952, that is 28.6 and 31.4. Okay. Next you have another question which is now pertaining to discontinued operations. So over here you have quarterly financials ending 30th June. On 1st April 18 we decided to sell one of the divisions as a going concern, which means this is like a discontinued operations. The proposed sale involves the buyer acquiring all non-monetary assets including goodwill, and we will collect all the trade receivables etc. and pay the current liabilities. So on 1st April 18 the carrying amount includes goodwill, PP with the remaining life of 2 years, and inventories. Debtors and payables have not been considered over here because we are going to collect them and we are going to pay for them, and hence if I total this, the carrying value comes to around 30,60,000. The company started to actively market the division on 1st April, and on 1st April we estimated that we'll receive 32 lakhs. So if I were to compare this with 32 lakhs, I will say that there is no further write-off. You might be showing this as assets held for sale whose carrying value is 30 lakh 60, and you are expecting to receive 32 lakhs, and hence there is no write-off. From 1st April the condition has improved, and on 1st August you are selling it at 33 lakhs. So you have been clearly told that on 30th June you can assume that 33 lakhs is a reasonable value. With the carrying value, okay, if nothing is there, your goodwill will remain the same. Acha, koi bolta hai PP there is no impairment, but sir, depreciation, okay, there will be no depreciation on the PP, primarily because from 1st April 18 you are classifying it as held for sale, in which case depreciation would stop. During the period 1st April to 30th June, division inventories costing 8 lakhs were sold for 12 lakhs. So that is resulting in a profit possible. Maybe you have purchased some more inventories, and hence this is 9 lakh, which is the cost of these inventories. So if I were to total all of this, this is probably 29 and 60. So this is 29 lakh 60,000 compared with 33 lakhs. There is further no impairment. All of these inventories have an NRV which is in excess of the statements. Operation, the profit of 4 lakhs will be shown separately in the income statement as gains from discontinued operations. So over here there would be 4 lakh rupees to be recognized separately in the income statement. Other sorry, I think I lost the audio there. So that's about it for Ind AS 105. Next we will go to the other asset linked standards. We will go to Ind AS 23, which is on borrowing cost, or we'll first finish up Ind AS 41, which is on biological assets, and then go to, let us say, borrowing costs. So Ind AS 41, which is on biological assets or agriculture. So the standard over here covers 3 essential parts. First is biological assets held for agricultural purposes other than bearer plants, because bearer plants go under Ind AS 16. Second is agricultural produce only at the point of harvest, and third is government grants which are linked to these biological assets other than bearer plants. So these are 3 things included. What is not included in the standard are bearer plants, Ind AS 16, agricultural produce after the point of harvest, typically this is Ind AS 2 inventory, and government grants which is linked to bearer plants or other items which will be covered under Ind AS 20. Other supplementary assets which do not have life, that is agricultural land or intangibles like licenses for the purpose of certain farming operations, will be covered under the respective standard like Ind AS 16 and 38. It will not be covered under Ind AS 41. There are only these 3 specific items which are covered. For you to have a clear understanding, we need to know that what is meant by an agricultural activity. Agricultural activity refers to the activity whereby biological assets are either held for the purpose of sale, or for the purpose of converting them into agricultural produce, or for the purpose of breeding, that is converting them into additional biological assets. So if these are the 3 items, then we can say it is an agricultural activity, provided you are managing their biological transformation, that is growth, degrowth, reproduction, etc. So you should be managing biological transformation merely. If you go and do ocean fishing, it cannot be taken as an agricultural activity because you're not managing the biological transformation for the fish. However, you're doing fish breeding, then it will be considered as an agricultural activity. So it is a necessary requirement for you to managing biological transformation, and then you can do harvest. So for you to be covered under Ind AS 41, you should be, let us say, a biological asset or an agricultural produce, or there should be a government grant. For biological assets, you should be holding the biological assets either for sale or for the purpose of converting to agricultural produce, or for additional biological assets, and you should be managing their biological transformation. So this is regarding agricultural activity. So there are 3 things that we will study over here for the purpose of our accounting. First for biological assets, then for agricultural produce, and lastly for government grants. Biological assets at initial recognition should be at fair value less cost to sell. Now this is one of the very few places where you are permitted to show something at fair value less cost to sell. Secondly, when you are looking at every subsequent balance sheet, at every subsequent balance sheet as well, the recognition will be at fair value less cost to sell, not at cost or NRV, whichever is lower. It will be at fair value less cost to sell, which means if you were to buy a biological asset at 100 and it becomes 120, then 20 rupees will be recorded as a fair value gain and will be credited to the profit and loss account. So unrealized gains or losses will be taken into the profit and loss account, and there will be no further depreciation for these items. So these are the 4 key principles. While doing so, a couple of special cases that need to be remembered. What if you are having a newborn asset, in which case you will record it at fair value. So your calf account debit to, let us say, fair value gain in the profit and loss, or you have an asset of 100 and there's a cost to sell of 10, in which case you will recognize it at 90. So asset account debit, let's say cattle account debit 90 to bank 100, and hence the balancing figure will be loss on initial recognition. One needs to remember that this is a loss on this is a cost to sell. There can also be a cost to purchase. Let's say there is a 5 rupee cost to purchase, then that will not be adjusted in the cattle value, but you are paying it. So your entry will be cattle account debit 90, loss on initial recognition as per ICI language of 15 to bank 100 plus 5, that is 105. Further, while you are giving a disclosure, for the changes, you will have to give a disclosure due to price and due to physical change, that is age. So if you are moving from 100 to 120 and a change of 5 rupees is due to price, that is age remaining constant, still there is an increase of 5 due to price, and the remaining 15 is arising due to physical change, or let us say age. Okay. In cases where fair value is not determinable, in which case you will show the working at cost, do the depreciation, and give a disclosure on reasons why fair value is not determinable. Okay. Next is agricultural produce. At the point of harvest, you have to recognize it at fair value less cost to sell. Remember, before the point of harvest, it is a part of the biological asset. So when you are harvesting the milk from a cow or wool from the sheep, at the point of harvest, you will apply Ind AS 41 and you will recognize that wool or milk, as the case may be, at fair value less cost to sell at the point of harvest, with the corresponding credit going to the profit and loss account. This will be treated as deemed cost for subsequent accounting, which may be as per inventory. So let us say Ind AS 2, subsequent accounting as per inventory will be done as per Ind AS 2. So this will be like your deemed cost. So over here, Ind AS 41 will apply at the point of harvest only, that is at the time of detachment, which you will measure at fair value less cost to sell. Subsequent accounting will be at the lower of this, or lower of this value determined at initial recognition, or NRV, as per Ind AS 2 principles. And lastly, there is government grants. Usually government grants are governed as per Ind AS 20. However, for government grants on biological assets, you will apply Ind AS 41, and for that you will see whether the grant is conditional or unconditional. So if the grant, let us say, is having no conditions, then the grant for a biological asset will directly be taken to the profit and loss account, that is, it is non-refundable, no further conditions to be fulfilled. However, if there are certain conditions, then the standard says that the grant will be recorded as and when the conditions get fulfilled. So if the conditions are fulfilled at one shot in the 5th year, then you recognize a grant in the P&L in the 5th year. Till that time it will be in the deferred grant. Or if the conditions get fulfilled over 5 years, then 1/5 of the grant keeps on getting recorded in each of the years, and this is how your accounting would be. However, if the grant is for a biological asset, which is like a bearer plant or a biological asset recorded at cost, then Ind AS 20 principles will apply, that is asset linked grant principles will apply. So this kind of takes care of the broad theory when it comes to Ind AS 41. If we go to the questions on this for Ind AS 41, a couple of questions. First, over here, this is a type of a question which the institute loves to ask, has come in the past in the exam as well. So you are preparing finance statements for 31st March each year, and you have done the following transactions. You have purchased land at 50 lakhs. This is as per Ind AS 16, will be shown at 50 lakhs. Purchased 200 dairy cows for 10 lakhs. So this is on 1st April 11. You will initially show it as a biological asset at 10 lakhs. And received a grant of 1 lakh towards the acquisition of cows, that is biological asset, and the grant is non-refundable, which means this grant of 1 million or 10 lakhs will be taken to the profit and loss. There would be certain expenses of 6 lakhs which will be taken to the profit and loss. 4 lakhs for breeding fee to a local farmer, also taken to the profit and loss. On 1st October 11, 100 calves were born, and there were no changes in the number of animals during the year. So on 1st October 11, these newborn calves will be recorded at fair value less cost to sell, that is 1100 rupees. So 100 calves into 1100 will come to probably 1,10,000. So this is calf account debit 1,10,000 to gain on initial recognition at 1,10,000. Okay. On 31st March 12, Moon had 3,000 liters of unsold milk in inventory. This will be recorded. This is agricultural produce to be recorded at fair value as cost to sell at the point of harvest. Harvest must be somewhere at the end of the year, and hence at 24 rupees per liter. So 3,000 into 24 will probably come to around 72,000. So this will be milk which is recorded at, let us say, around 72,000. Okay. Information regarding the fair values are given. You are required to prepare extract of the balance sheet and the P&L as for the finance statements. So when I look at the balance sheet, I will show the land. Now there are fair values of land given. Now if you assume the revaluation model, then the land will be revalued up to 70 lakhs and 20 lakhs will be shown in the revaluation reserve. If you follow the cost model, then the land will appear at 50 lakhs only. ICI has assumed the cost model, and hence the land appears at 50 lakhs. Now for these dairy cows, which were 200 cows, of 2 years, by the end of the year, these will be 3-year cows and they will be having 5,500 value. So there's a fair value appreciation of probably 500 rupees from 5,000 to 5,500. This is 500 rupees. So 500 rupees into 200, that is equal to 1 lakh rupees. This will be fair value gain on these cows, which will go in the profit and loss. You will show a breakup of this between price and age. So when I show these workings over here, I would say that there is a fair value gain on the cows of 1 lakh, out of which maybe 200 of gain is arising due to price and the remaining 300 is arising due to age. In a similar way, for the calves, I will recognize, let us say, the fair value gain on the calves when they are born. This is at, let us say, 1 lakh 10,000. This is gain on the birth of the cows. Fair value gain in the next 6 months, your price of the calf increases from 1100 to 1300. A part of this increase, that is 1100 to 1200, that is 100 rupees is due to price, and the other 100, that is 1200 to 1300, is due to age. So again, you will show a breakup due to price as well as due to age. Even over here, due to price and due to age. Apart from that, there is a government grant, and on milk, you will recognize 72,000 as gain. Other than that, there will be certain expenses which are recorded in the profit and loss, and in your balance sheet, you will show the land as a part of your PP at 50 lakhs. In your biological assets, cows will appear ultimately at 11 lakhs, that is 5,500 into 200, and calves will appear at 100 into 1300, that is 1 lakh 30. Apart from that, unsold milk is actually inventory for you, and hence this will appear at inventories in current assets at 72,000. Okay, so that is question number 1. Another interesting question over here is question number 2, where you are purchasing, as the question says, 100 beef cattle. Beef cattle is purchased for the purpose of slaughtering, and hence, like dairy cows are for the purpose of use. They are similar to inventory. Sorry, they are similar to PP. Like in question 1, dairy cows were there, so they are similar to PP. However, beef cattle is similar to inventory because you are holding it for the purpose of either sale or slaughter, as a case. They are purchased for 1 lakh rupees on 30th September, and subsequent transportation costs were 1,000. That is similar to the cost that will be incurred even if I were to sell the cattle. So there is 1,000 transportation cost at the time of purchase, and if you want to sell, there is another 1,000 at the time of sale. Additionally, there is a 2% selling fee on the market price to be incurred by the seller. So initially, this cattle will be recorded at fair value, that is 1 lakh minus 1,000 cost to sell minus 2%, that is 1 lakh minus 2%, I think this is 2,000, and hence 97,000 is the initial recognition value for this cattle. So if I were to pass the journal entry, it is cattle account debit 97,000 to bank. I am paying 1 lakh plus another 1,000 for transporting the cattle, that is 1 lakh 1,000. So there will be a loss on initial recognition to the extent of 4,000. Okay, cattle will be at 97,000. On the reverse March 12, that is in 6 months, maybe you are doing half yearly reporting over here. The market value of the cattle increases to 1 lakh 10. Transportation cost is still 1,000 to be incurred to get the cattle to the relevant market, and there's a 2% auctioneer fee. So this is 1 lakh 10,000 minus 2% auctioneer fee, that is 2,200, and minus 1,000. So this probably comes to around 1 lakh 6,800. Earlier you were at 97, and hence there is an increase of around 9,800 cattle account debit to fair value gain, which will be taken in the profit and loss account. So this is gain on remeasurement, which will be taken into the profit and loss. Okay, on 1st June 2012, X sold 18 cattle for 20,000 and incurred transportation cost of 150. In addition, there was a 2% auctioneer fee on the market price of the cattle. Now, typically an easier working over here would be directly to say bank account debit, whatever is the net sale proceeds you get, to cattle. Well, each cattle, maybe there is 100 cattle with you, 1,06,800. So per cattle it is around 1068. So we can say, okay, bank account debit whatever you get to cattle to gain on sale. That would reflect the entries that you were to pass if this was a dairy cow which is held for the purpose of use. However, a beef cattle is actually held for the purpose of sale, and hence the representation over here should more appropriately be that similar to that of an inventory. So there are multiple ways in which you can solve, but what the institute has done is over here they have shown this as a sale. So you can say bank account debit, let us say 20,000 to let us say sales 20,000. Apart from that, like a COGS, I mean, they have remeasured and shown. I'm saying that even if you don't remeasure, because one of the parts in the question at the end says remeasurement is done only on the reporting dates, that is 30th September and 31st March. So we are skipping the remeasurement, though institute has done the remeasurement. Like a COGS, sales will go to the P&L. In a similar way, you will have COGS, which will go to the profit and loss account to, let us say, cattle. You have recorded cattle at 1068 each into 18 cattle being sold. So in your ledger, each of the cattle, 100 cattle is worth 1068. So this is probably 1068 into 18 and comes to 19,224, the proportionate value of the cattle which is being sold. But other than that, you are also having incurring certain expenses like transportation cost, like auctioneer fee. When you are looking at I'll just write it a little fair. So auctioneer fee, transportation cost. So when you're looking at inventory, you will show all the cost separately. So this is going to go in the P&L. 2% of 2000, that is 400, and another 150 as transportation fee, let us say, to bank. So when I go to see, this is 550. Typically my net entry would have been, I'm selling at 20,000, incurring a 550 cost, so I'm getting 19,450. And that is 19,450 for a cattle, which in my books is 19,224, and as a result 19,450 minus 19,224, which will come to around 226, that will be gain. Now rather than showing gain directly in the P&L like you do for fixed assets, you will prepare it in a way like you do for inventory, like you will show the sales of 20,000 separately, the cost of 19,224, 150 and 400 separately, which will ultimately still result in you getting a 226 gain in your P&L. This is what the institute has done and seems to be appropriate as well, which is to be done for beef cattle. If this was dairy cattle, you could have directly done the way you do sale of fixed assets, that is directly find 226 as a balancing figure on gain. On 15 September, the fair value of the remaining cattle was given. Again, we are not remeasuring, because when you will read further, the question will tell you that the remeasurement is to be done only at the half yearly reporting dates. So you are still on 15 September. 42 cattle were slaughtered on that date with a total slaughter cost of 4,200. Now this is a cost which is to be incurred for getting the what you call as carcasses, slaughtering. The total market price of the carcasses was 48,300, and the expected transportation cost to sell these carcasses is 420, which means we will record inventory. Agricultural produce is now the carcass. Biological processes have ended, so inventory will be recorded at 48,300, which is the market value of the carcasses minus the cost to sell, that is 420, and hence 48,300 minus 420, and this comes to 47,880. So this is your inventory. However, you will record the inventory, but now this 42 cattle will no longer appear in your books. In your books, cattle was appearing at around as a biological asset at 1068. You were not remeasuring. So over here, you will have inventory account debit. Let us say inventory is 47,880 to cattle, which was earlier in your books. So there were 42 cattle, beef cattle, each at 1068, which you will derecognize. So 42 into 1068, and you get 44,856. But to get this carcass, you also have to incur certain slaughtering cost, and hence there's a 4,200 cost. Cost to sell is the cost that is yet to be incurred. 4,200 is already incurred, and hence there will be a balancing figure, which is a loss, which will be taken to the profit and loss account. So the balancing figure over here would be around 1176, which will be taken to the profit and loss. So if you see the solution over here, this is 1176 to be taken in the profit and loss. For this first June entry, you will refer the alternative presentation that we have given in the notes. That is what the ICAI has done, the alternative presentation. We will also do this. Over here, again, we have done it the way ICAI has done, where you have shown 1176 as a loss. And after this, you are left with what? You are left with 100 minus 18 cattle sold and 42 cattle slaughtered, and hence you are left with 40 cattle. So on 30th September, the market price of the remaining 40 cattle was 44,800, and the expected transportation cost is 400. There would be a 2% auctioneer fee on the market price. So basically 44,800 minus 2% minus around 400, and this comes to 43,504. So there would be 43,504, which is your fair value less cost to sell for the remaining biological assets where live processes are still there. You will compare this with 1068 into 40, which will come to, let us say, 42,720, and hence there is a 784 gain. So over here you will have a 784 gain, cows account debit to gain on remeasurement, which will be taken to the P&L. So this is a fairly daunting adjustment, I would say. So question 8 is a fairly tricky question over here. So this takes care of agriculture. Next, you will go to Ind AS 23, which is on borrowing cost. Now, this is one of institute's favorite standards, but they don't usually ask you necessarily a full-fledged question. They can ask you along with the PPE question as well. So, what is the purpose of having a borrowing cost standard? Well, if there is a borrowing cost which is incurred for a qualifying asset, then what do you do with that borrowing cost? As per Ind AS 23, the borrowing cost for a qualifying asset will be capitalized during the period it is getting ready for use. Once it is ready for use, further borrowing costs will be taken to the profit and loss account. However, if the asset is not a qualifying asset, like you take a ready to move house on loan, the house is ready to use and hence any interest, if any, will go to the profit and loss. However, if you purchase an under construction property, in which case that under construction property is not currently ready for use, and as a result, if it takes 3-4 years, you don't have money, you borrow money and you pay interest, that borrowing cost is to be capitalized as per Ind AS 23. So the general principle, accounting for borrowing cost, if it is for a qualifying asset, the borrowing cost during the period of construction will be capitalized. For other than qualifying asset, the borrowing cost will be taken to the profit and loss. Now, what is a qualifying asset? Qualifying asset is an asset which ordinarily takes a substantial period of time to be ready for its intended use. Substantial period has not been defined, but if nothing is available, then you can take 12 months as a substantial period of time. However, if the management has clearly said that 6 months is a relevant period, then even if it takes more than 6 months, it can be taken as a qualifying asset. If nothing is given, you can write a note and assume. In general, at least for borrowing cost questions, we will assume that assets which are being constructed are qualifying assets. For other questions like big PPE questions, usually data will tell you whether they are qualifying assets or not. Otherwise, we can take the 12-month rule, and if it is less than 12 months, we can assume it is not a qualifying asset. If it is taking more than 12 months, you can assume that it is a qualifying asset. It should ordinarily take a substantial period of time, so it should be something which necessarily takes. So if it ordinarily takes 6 months and you took 16 months because of your inefficiency, that is not a qualifying asset. The asset should ordinarily take a substantial period of time to be ready for their intended use. Scope exclusions, there are a couple of things that are not covered under this standard. First is assets which are recorded initially as well as subsequently at fair value, like biological assets, in which case you will not apply Ind AS 23 principles for biological assets because fair value is all inclusive. You don't have to separately add anything. For inventories, usually Ind AS 23 will apply, because if inventory is taking a substantial period of time and you have taken a borrowing cost, that borrowing cost will be capitalized. However, if inventories are manufactured in large quantities using a largely repetitive process, the standard allows you an exemption from capitalizing of borrowing costs, like wine, for example, you can be exempted. However, for items like aircrafts for Boeing or flats for a real estate company, they're not mass produced using a largely repetitive process, and hence in such a case, your borrowing cost capitalization can still continue even if it is inventory. Remember, it is a concept of qualifying asset, not just qualifying PP. It can be any qualifying asset. Can be PP, can be intangible, can be inventory, can be any asset which necessarily takes a substantial period of time to be ready for its intended use. However, financial assets are generally ready for their intended use from the very first day, and hence financial assets will not be qualifying assets and borrowing costs cannot be capitalized along with the financial assets. Okay. Now, what is borrowing cost? Borrowing cost refers to interest cost, which is calculated using the effective interest method as per Ind AS 109. The effective interest method considers everything. It includes the coupon, it includes the premium or discount on redemption, it includes the transaction cost or processing fees, all of them considered. So it includes the interest under the effective interest method as per Ind AS 109. Further, finance charges in case of lease liabilities will also be included over here because it is similar to a borrowing only. The third part is a slightly important part where they say exchange differences on the foreign currency borrowings. Ideally, exchange differences is covered under Ind AS 21, but exchange differences on foreign currency borrowings, okay, to the extent they are considered as adjustment to interest costs, will also be treated as borrowing costs. Now, what does this mean? Well, there are a few steps that you need to apply. In such cases, we kind of say that usually if you have studied AFM, foreign exchange, interest rate parity, inflation rate parity theory tell you that there's a relationship between the exchange rate and the interest rate. So I might borrow in the US at a lower rate of interest. So that actual coupon that I pay is definitely my borrowing cost. But is that it? Is that it my borrowing cost? No, the answer is no. Beyond that, also, it is likely that if since the US interest rate is lower as compared to the Indian interest rate, probably the Indian currency will depreciate, and hence when I go to repay the loan, I will have to pay more, because I might have borrowed when the rate was 70 and 75. When I go to repay, the rate might be 80 and 85. In which case, what I'm going to pay more on account of exchange rate differences, a part of it is due to interest rate differences. This is the logic behind this entire adjustment. So how do you incorporate exchange differences? How do you say that these are exchange differences which are considered to be adjustment to interest cost? First, you will say that there are around 5 or 6 steps. Step number 1, you calculate actual interest. Actual interest is on the foreign currency loan. So if there's a $100 loan, into 2% is a coupon, so that is $20, and $20 into whatever is the rate on the date when coupon is paid. So that is $20 into, let's say, 50, that is equal to 1000. That will be, let us say, your actual interest. Second, you will compare this with the notional interest. Notional interest means this is the interest that will be charged. Notional interest means this is the interest that will be charged had the loan notionally be taken in India. So had the loan been taken in India, I would probably not take a $1000 loan. I would take a loan which is, let us say, in India, let's say the rate was 40 rupees when I took the loan. So I would have taken a 4000 rupee, for example, loan, 40,000 rupee loan. And the Indian rate of interest is 10%. So what would have been the interest I would have paid in India? Okay, 40,000 into 10%, maybe 4,000. However, how much am I paying in the US loan? Well, I'm paying 1000. And hence the difference, that is equal to 3000, is the interest saving. So interest rate parity theory says that what you save in interest, you will actually compensate by paying higher exchange losses. So over here, you will have an interest adjustment and forex loss. Forex loss is a dollar loan into the closing rate minus the opening rate. So you will take the lower of these two, exchange differences, that is step 4. To the extent they are considered as adjustment to borrowing cost, that is step 3. Lower of the two will be treated as borrowing cost. Why? Because sometimes it might happen that the forex loss might be higher. Now everything, the entire forex loss is not attributable to, let us say, changes in interest rates. Some of this may be interest, some of this may be other factors. So foreign exchange loss, or let us say interest adjustment, whichever is lower, will be treated as adjustment to the borrowing cost, and the remaining, if any, will be treated as forex loss. So over here, your forex loss will be the borrowing cost, which is a lower of forex loss or interest adjustment, and the balancing figure will be attributable to forex loss. So there's a lot of theory. Remember, all of this will be done if there's a forex loss. If there's a forex gain, you will ignore all of these principles, and you will take initially the foreign exchange gain directly to the profit and loss account. All of this applies only if there's a forex loss. I think that's quite a lot of numericals. What you will try to do is, you'll probably try to do a sum. I guess this would be one of the important questions. Let me just refer this once. So if you look at Ind AS 23, yes. So we'll apply this in question number 1 so that you understand this better. ABC has taken a loan of $20,000 for constructing a plant at 5% rate of interest. So 20,000 into 5% comes to probably $1,000 of coupon. On 1st April 11, the exchange rate was 45 and at the end of the year was 48. So when I pay, the rate is 48. So my actual coupon is 48,000. But what if my loan was taken in India, $20,000? I would have taken the loan in India. When I took the loan, the rate was rupees 45 per dollar, and hence that would be a notional 9 lakh rupee loan, which would come to me at the rate of, so you have been told that you can borrow in India at the rate of 11%. So this would be at the rate of 11%, and hence 99,000. So had I taken the loan in India, the interest would have been 99,000, but I'm actually paying a coupon of 48,000. That is $1,000 into rupees 48, and hence the interest adjustment or the savings that I'm having, interest adjustment or the savings, is a difference between 99 and 48, which comes to around 51,000. Okay, if I go to see the foreign exchange loss, $20,000 into 48 minus 45, that is equal to 60,000, will be the forex loss. Typically this forex loss would be taken to the P&L under Ind AS 21. However, a part of this forex loss is attributable to borrowing cost. So we will say out of the 60,000, we can say attributable to borrowing cost will be the lower of the forex loss, that is 60,000, or the interest adjustment, which is 51,000, whichever is lower, that is 51,000. We are saying that the exchange rates change due to various factors. interest rate is one of the factors, and quantifying the impact of interest rates would be 51,000. The remaining is actual forex loss, which is 9,000, which will go to the profit and loss. So your total borrowing cost to be capitalized would be 48,000, the actual coupon that you are paying, plus 51,000, that is exchange differences, to the extent they are considered as adjustment to borrowing cost, and hence 99,000 will be treated as your total borrowing cost to be capitalized. So this is in your question 1. A few additional workings over here can also be done, that what will happen in the subsequent years if there is a further forex loss, that is the rate goes from 48 to 50, then you will follow the same steps and do the workings. But what if there is a subsequent foreign exchange gain? If there is a subsequent foreign exchange gain, then that is treated as first a reversal of the borrowing cost already capitalized, because you thought that you would have to pay 51,000 more because the exchange rates would have moved in a particular way. However, if the exchange rates move back from 48 to 46, there's a foreign exchange gain. Sir, we take the foreign exchange gain to the P&L. Typically, yes, initially foreign exchange gain is to be taken to the P&L. But if there's a subsequent foreign exchange gain, we will say that you will first treat it as a reversal of borrowing cost. This is calculated as a foreign exchange gain, or the borrowing cost earlier capitalized under this adjustment, that is 51,000. Select whichever is lower. So if your foreign exchange gain in the later years is 40,000, you will say, okay, 40,000 is ideally should have been taken to P&L. However, in the past you have capitalized 51,000, saying that I will have to pay more when I repay. Now I don't have to pay that more to the extent of 40, and hence you will reverse it. So Institute has not asked you any full questions on this, but if it comes in the subsequent years, if there's additional foreign exchange loss, you will repeat the same steps. But if there's a subsequent foreign exchange gain, you will treat it as a reversal of borrowing cost, which is lower of foreign exchange gain or the borrowing cost which was earlier recorded in step 5 in the earlier years. Additional, if any, will be treated as foreign exchange gain. So this is a slightly advanced working, just in case it comes. Now there are a few important dates in the borrowing cost chapter. First, there is something called as commencement date. This is the date which is later of the date when loan is taken, expenditure incurred, or activities commence. Later of these three. Activities commence does not necessarily mean that physical construction should commence. Even technical site planning evaluation can also be considered as commencement of activities. Further, the capitalization will continue till the time the asset is ready for use, or substantially all the activities to get the asset in the ready to use condition is completed. Some minor incidental ancillary activities, administrative activities remaining is still fine. You can cease capitalization the moment substantially all activities to get the asset in the ready to use condition are completed. However, in the intermediate period, what if the work on the asset has active development of the asset is interrupted? Should you suspend capitalization? Well, you can suspend capitalization if active development is interrupted for an extended period. Extended period has not been defined, but it can be inferred based on the facts of the case. If active development is interrupted for an extended period of time for factors which are beyond the entity's control, in which case that is abnormal factors, in which case you will suspend capitalization during that period. Okay. Next is capitalization of borrowing costs in case of specific borrowings, like a housing loan is a specific borrowing for the house. So the standard says actual borrowing cost, actually what you are paying from the commencement date, will be capitalized. It may be that you have taken a loan of 100, you have started work on the asset and you have spent only 40. Still, if you have taken a loan of 100, actual borrowing cost from the commencement date will be capitalized, but you are allowed to subtract the income on temporary investment of the surplus fund. So if you have 60 rupees surplus for some time and you have deployed that, income on temporary of investment on surplus funds can be deducted. So the net borrowing cost to be capitalized will be the gross borrowing cost from the commencement date less income on temporary investment from surplus funds. The net borrowing cost can be capitalized. One needs to remember that what you are capitalizing is only borrowing cost. So equity, KE or a WACC should not be used as a base for the purpose of capitalization. This is in case of specific borrowings. More important is general borrowings. So when you're looking at general borrowings, these are borrowings which are generic in nature. They're not taken exclusively for the purpose of qualifying asset, but money is fungible. You cannot determine that the money is exactly used for what. And hence, if there is a general borrowing, then what do you need to do? Well, the standard first says that you will have to find that how much of, is there any specific borrowing? If yes, then you'll do the working similar to what you discussed earlier. However, if there's no specific borrowing, then you will look at the general borrowing. There may be multiple general borrowings for which you will have to calculate what is called as a weighted average borrowing rate, where you will take the actual interest on the general borrowings in the numerator and divide it by the weighted average borrowing amount in the denominator. So that way you will find the weighted average borrowing rate. So for every rupee that you have taken out of the general borrowings, what is the average rate? Then in step 3, step 1 is the specific borrowing, step 2 is the calculation of weighted average borrowing rate. In step 3, you will find the eligible borrowing cost to be capitalized. So you will multiply the expenditure incurred out of general borrowings. So if there are specific borrowings, you will first subtract the expenditure that is financed out of the specific borrowings. So expenditure from the general borrowings into the weighted average borrowing rate into the time period till the end of the year or the cessation of capitalization, as the case may be, and that will give you the eligible borrowing cost to be capitalized. As long as it is within the actual borrowing cost, you can capitalize the eligible borrowing cost. Again, this is a lot of numericals. There is a sum over here, example over here as well, but if we were to kind of apply this through a numerical working, so there is question number 2 which we can review over here. On 1st April 11, entity A contracted for the construction of a building at 22 lakhs. So in thousands, if I go to see, this is 2200 in thousands. The land is a separate asset and is not a part of the qualifying asset. That is fine. The building was completed by the end of March. Okay, you started work on 1st April and it got over by the end of March. So it took a full 12 months. And during the period, the payments were as under. So you have been given various payments on various dates. The entity's borrowings at the end of the year are as follows. So if I go to see, you have been given details of expenditure incurred. 10% 4-year note with simple interest which relates specifically to the project. So this is a specific borrowing, and what are we taught regarding specific borrowings? You will take the actual borrowing cost, actual whatever it is from the commencement date minus income on temporary investment. If you read further, they have given you 7 lakhs is the amount of borrowing, 65,000 was incurred. Now we don't know when the borrowing amounts were actually drawn down, but at the end of the day 65,000 was the actual borrowing cost. Maybe 2, 3, 4 lakhs were taken on the first day, the remaining amount is taken on the later dates, whatever it is. 65,000 is the actual borrowing cost, and the interest income of 20,000 was earned on these funds. So this is income on temporary investment, and hence one can say 45,000 is the net borrowing cost on specific borrowings which you will capitalize. The total loans are 7 lakhs which is used for the qualifying asset. Okay, next you have 12.5% 10-year note. Debt outstanding amounted to 10 lakhs and remained unchanged. 10% loan with simple interest, debt outstanding at 15 lakhs and remained unchanged. This is not for the specific purpose, and hence both of these can be taken as general borrowings. What is the borrowing cost to be capitalized? So if I do the working, I will say that first on specific borrowings 45,000 is to be capitalized, and then for the general borrowings you will find the weighted average borrowing rate which is 12.5% of 10 lakhs, that is 1,25,000, and 10% of 15 lakhs, that is 1,50,000, divided by, let us say, 1000 and 1500. If I am doing everything in thousands, this is, let us say, 275 divided by 2500, and hence the weighted average borrowing rate probably comes to 11%. So even a single penny which comes out of the general borrowings will cost you 11%. So 200 which is spent on 1st of April is first assumed to be met out of specific borrowings, and hence nothing is met out of the general borrowings. So ideally this will be 200 minus 200 into 11% into 12 by 12 for the entire 12 months. In the second case, out of 600, the remaining, let us say, 500. So 600 minus 500, that is equal to 100 into 11% into, let us say, this is 9 by 12. Okay. Now entire 7 lakhs or 700,000 has been exhausted, which means whatever is remaining will come out of the general borrowings only. So this is on 31st December for 3 months. This is on 31st March. Let us say this is into 0 by 12. So this is, if I go to see the eligible borrowing cost, this is 0. This is, let's say, 100 into 11%, that is 11 into 9 by 12. That comes to around 8.25. 1200 into 11% into 3 by 12 comes to, let us say, 33, and 0. So if I total both of these, this is what? This is probably 41.25. If I compare it with the actual borrowing cost of 275, that is within the limit, and hence 41.25 is the general borrowing cost to be capitalized. So if I go to see the borrowing cost to be capitalized on specific borrowings is 45, general borrowings is 41.25, and hence 86.25 of the borrowing cost will be capitalized. So if you go to see 41.25 and 45, so total is 86.25 will be capitalized over here. Okay. Next, you go to the section which is involving expenditure incurred on a qualifying asset. Now, an expenditure incurred on a qualifying asset includes what? The expenditure includes the cash payment. It also includes assets which are transferred, but it also includes the borrowing costs already capitalized. This will only come in a multi-period question where you have capitalized the borrowing costs. See, at the end of the day, where you are spending money for the qualifying asset, when you're spending money for the qualifying asset, that money can be spent for paying salaries, for laborers, for materials. It can also be for paying the bankers if you are capitalizing. That will also be a part of your borrowing cost to be capitalized. Less grant received and progress payments received, if any. So if there's a grant or money that you are receiving as a part of the construction, you will net that off, and that will give you the expenditure incurred. Like in the sum that we just did, you were told 200 is incurred, 600 is incurred. What was included in that 200 and 600? All of these items: cash payments, assets transferred, etc. But it will also include interest already capitalized. Also, a special guidance over here is that when you look at borrowing costs capitalized, you will look at the actual cash payments, not just expenditure that is accrued, because you might have to pay some amount to the builder for the construction, but if you have not paid it, none of the borrowing is actually used. So over here, if there is expenses accrued and expenses paid, the expenses for the purpose of borrowing cost capitalization will be based on expenses paid. Okay. So again, there is a very interesting problem over here which was there in the RTP May 23, also came in the MTP of May 24. There was a slight difference in the solution in the MTP. However, earlier the institute has rectified it to bring it in line with the solution in the RTP, and I guess we should follow that only. So this is a fairly complicated question. LT is in the process of construction. It is expected to take around 18 months from 1st January to 30th June, and the following are the expenditures. So you have been given 520 and then total expenditures. On 1st July, LT issued 10% redeemable debentures of 50 crores. This is on 1st July. Remember, money started being spent from 1st January 11, 30th June 11. At this point, if you read the question entirely, there were no borrowings. However, the standard does not ask you to do a one-to-one correlation. It says, okay, for these 6 months, that is from 1st January 11 to 30th June 11, if there were no borrowings, there cannot be any borrowing cost to be capitalized. However, if later a borrowing is taken on which a borrowing cost is incurred, you will attribute a part of that borrowing cost to the qualifying asset. Koi bolega, sir, but you have already incurred the expenditure. It does not matter. The standard over here believes that if you did not incur that expenditure in the past of 5 and 20, you may not need a borrowing of 50 crores. You might have only taken 25 crores because this 25 crores, had you not incurred over here, you would have had surplus, and hence you did not need the borrowing. So a part of the borrowing cost is still attributable to the expenditure incurred. That is how the institute solves, and rightly so. The proceeds for the debentures form a part of the general borrowing, very clearly told, which is used for the construction of the qualifying asset. The proceeds form a part of general, which it uses to finance the construction of qualifying asset, that is building. LT had no borrowings. General was specific before 1st July and did not incur any borrowing costs before that date. But LT incurred 25 crores of construction costs before obtaining the general borrowing. So this is at 25 crores, 5 and 20. And another 25 crores after obtaining the general borrowing. This is at 25 crores. Okay. For each of the years, 31st March 11, 12 and 13, calculate the borrowing cost. So if I look at the year 10, 11, during the year 10, 11, you started incurring expenditure, but there was no borrowing, and hence there is no borrowing cost. In the year 11, 12, for the first 3 months, there was no borrowing, and hence there cannot be any borrowing cost. However, from 30th June onwards, we have taken a borrowing, and one can say that there is total 25 crores of expenditure already incurred into, I can say, 10% into 9 by 12. So whatever is the borrowing cost, 25 into 10% into 9 by 12, that is around 1.875. Acha, there is a further expenditure incurred, but that is on the very last day, and hence there is no further borrowing cost attribution to that. So one can say that, okay, 1.875 of that actual borrowing cost, that is 50 crores into 10% into 9 by 12, is attributable to the qualifying asset, and hence it will be capitalized. Now when you go to the year 12, 13, what is your expenditure incurred? Well, we will say the expenditure incurred till date was 25, on which the interest meter will continue, but a further 20 was incurred, and as a result 20 plus 25, so this is 45 crores. But is it only 45? No, expenditure incurred includes cash payments, that is still now 5, 20 and this 20 plus borrowing cost already capitalized, this is 1.875. In some of the institutes MTPs, if you see in the older versions before rectifications, you might not have seen this addition. Now there is an addition, so this is into 1.875 plus 1.875 into 10%. The asset gets ready for use on 30th June. So it is only 3 months ka period where the capitalization will happen. So 46.875 into 10% into 3 by 12. So this comes to around approximately 1.172 or something, which is a borrowing cost to be capitalized. Beyond that, 5 crores is incurred, the asset becomes ready for use. Any further borrowing cost after the asset is ready for use is to be expensed to the P&L. They're just asking you how much is to be capitalized. So in the first year, nil. In the second year, if you go to see in line with the institute solution, 1.875, and in the third year, you will have around 1.17. Okay, so this will be your overall working. So this kind of takes care of this section. There's also one more section regarding borrowing cost capitalization in case of a consolidated financial statements. In CFS, one needs to remember that while you are doing consolidation and you are preparing a borrowing cost capitalization, you will capitalize based on the expenditure incurred and qualifying asset appearing in the CFS. Like for example, there may be some intercompany profits. If they are eliminated, then your capitalization will be based on the expenditure incurred for the qualifying asset after eliminating the unrealized profit. There may be some intercompany loans. These intercompany loans give and taken will be eliminated in consolidation, and hence your borrowing cost, your WABR, will be based on the rate which is from the outside community only. So there are a few things that you will have to consider. Again, company to company we will not check, we will check for the group as a whole and do borrowing cost capitalization as per Ind AS 23 accordingly. Okay, so this takes care of Ind AS 23. Next we can go to Ind AS 20, which is on government grants. We will do that. So over here you will have a few key terms like government. Like government includes a state, national, international, local government authorities, but it does not include government companies. It includes government departments but not government companies. There is grant and there is assistance. Grant is something which is measurable, like a subsidy, which has to be accounted, whereas assistance is something which is not measurable and hence it has to be merely disclosed. Ind AS 20 will apply in general to government grants which are in the nature of grants. It will not apply to loans which are given at market rates, because this is a loan, it is to be returned. Grants are not to be returned. Or equity investment, that is investment for the purpose of return, or even income taxes, for which there is a separate standard, Ind AS 12. There is a special clause like we just studied for Ind AS 41, grants on biological assets, for which Ind AS 41 will apply and not Ind AS 20. So these are the scope exclusions. Other than that, if there is a grant given by the government, then Ind AS 20 will apply, and initial recognition for this grant will be based on the fact that if you expect the grant to be received, so if the grant is receivable and you are reasonably certain that the conditions attached will be fulfilled, you don't need to wait till the time the grant is actually received, otherwise it is cash system of accounting, and you don't even need to wait till the time conditions are actually fulfilled. If you have a reasonable assurance that the conditions attached will be fulfilled, you are allowed to recognize the grant. Now, how will you recognize a grant? Well, depending on the classification, you can classify the grant as grant linked to assets or grant linked to income. A grant linked to asset can be a monetary grant or a non-monetary grant. A monetary grant is received in money value terms like a reimbursement. A non-monetary grant is getting the asset at a concessional price. In either case, you have two options. You can either show the asset net of the grant value, so you can have an asset of 300 and a grant of 200, in which case you can show the asset net directly at 100 and the future depreciation etc. will also be based on 100. Or you can show the asset at the full value, that is 300, and show a deferred grant of 200. Now this asset now will be depreciated over the remaining useful life. 300 worth of asset will be depreciated, and hence the deferred grant balance will also be depreciated over the remaining, amortized over the remaining period in the ratio of depreciation. So in case of an asset linked grant, if you follow the method of showing a deferred grant, that deferred grant will be amortized to the P&L in the ratio of depreciation. Okay, so these are the two possible methods. The 2 or 3 special cases over here would be that if you decide to follow the method to show the asset net of the grant, and let us say the asset is received free of cost or full amount of the asset is received in the form of a grant, then asset will technically come down to a zero balance. However, standard says you'll have to show the asset at a nominal value for namesake, 1 rupee, 10 rupee, 100 rupees, etc. in the books of accounts. So nominal value will be shown if your asset comes down to a zero balance. Second, if you show a deferred grant method and this is a grant on land, and ideally you have been told that you will amortize in the ratio of depreciation, but the thing is land does not get depreciated, and because land does not get depreciated over here, this grant would be appearing as it is. How will it be deferred? Well, in such cases the standard says you defer based on an appropriate ratio. Appropriate ratio can be the ratio based on the life of the project or other expenses that are incurred to fulfill the conditions of the grant, but you will have to defer it. You can't take it to something like a capital reserve. Third, there can be a grant which is non-refundable, it is unconditional. Still, you will not take it to the P&L. You will still follow the same approaches if it is an asset link grant. If it is an income link grant, the treatment is slightly different. And lastly, if the asset is still under construction, you can't currently deduct it from the asset, in which case you will park it in the deferred grant account, and once the asset is ready for use, then you will net it off from the asset, or you will continue it in the deferred grant as the case may be. So these are the few important notes. Second is a grant linked to income. So if the grant linked to income is defined as a grant other than a grant linked to asset. A grant linked to asset is a grant which is specifically for the purpose of acquisition, construction or purchase of a specified asset. However, if it is other than a grant linked to asset, it is treated as a grant linked to income, and a grant linked to income will be, if it is unconditional, it will be taken to the profit and loss account immediately, or if it is, let us say, linked to past losses which the government is compensating for you, it will again be taken to the P&L immediately. However, if this grant has certain future expenses like training expenses, etc. to be incurred, then this grant will be parked in the deferred grant account and then amortized in the ratio of the expenses to be incurred. If the ratio of expenses is available, you take that. Otherwise, you will record it on a straight line basis over the time, that is time basis. Okay, so this is grant linked to income. Basically, a summary for amortization would be, if it is a grant linked to asset and you are following a deferred grant method, you will defer it in the ratio of depreciation for depreciable assets. If it is a non-depreciable asset like land, you will find an appropriate ratio to defer it. If it is a grant linked to income and if it is unconditional in nature or linked to past losses, there is no deferral, you take it to the P&L immediately. However, if it is linked to some future expenses, you will defer it in the ratio of those expenses if available, or in the ratio of time. Now, there are a few special cases, but before that, how do you present this grant? The grant is presented in the balance sheet as a deferred grant within the non-current or the current section, depending on the time it is taking. In the P&L, if it is an asset linked grant, then the depreciation will be shown in the expense and the grant amortization will be shown in other income. You cannot net them off. However, it is an income linked grant. You are given two choices. You can show the training expenses in the expenses, and you can show, let us say, the grant amortization as other income, or you can show the training expenses and from that subtract grant amortization and thereby show the net expenses only. So either of these approaches are permitted, either of these approaches kind of work. So this is regarding, I think at the end you have the presentation in the balance sheet. The grant is in the deferred grant is in the liabilities, can be current or non-current as the case may be, and in amortization, asset or income link grant, asset link grant, the grant has to go to the other income. You can't net it off from depreciation. In an income link grant, you can either take it to other income or reduce it from the expenses. Okay, next, a few special cases. If it is a forgivable loan or if there is a loan waiver, then it will usually be taken, it is taken as an income linked grant, because a loan waiver is usually not for the purpose of acquisition of an asset, and hence it is other than that for assets. So it is an income linked grant and it will be accounted typically in the P&L unless conditions are attached, in which case you will record it depending on the type of conditions or expenses to be incurred. Second is an important thing, which is a lump sum grant in the nature of promoter's contribution. So if you are given a grant to set up a unit in a backward area or start your business in a backward area, the government gives you just a lump sum grant which you can use for whatever purpose you want, not necessarily for the asset. You can use it for any purpose, in which case this is not a grant linked to asset. So this is a grant linked to income. Under AS, it was shown as a separate promoter contribution capital reserve. Ind AS does not have that, and hence this is a grant linked to income. If there are certain conditions or expenses to be incurred, then you put it in deferred grant and amortize in the ratio of expenses. And if there are no expenses, you will take it to the P&L immediately. EPCG. Now this is a special case for EPCG. Usually this is a import duty, concession or a waiver given, drawback given by the government for importing capital goods provided you are manufacturing output which is going to be exported. So the primary objective of an EPCG scheme is typically to encourage exports, and hence it is more appropriate to treat this grant in the nature of income and amortize it in the P&L over the ratio of expenses being incurred. So this is how you will account for the EPCG scheme. And one of the most important things of this chapter is if the loan is given at a concessional rate. In this case, there is an overlay of Ind AS 20 and Ind AS 109 financial instruments. So if the government gives a loan to you at a concessional, or let us say a 0% rate, it's a 5-year loan of 100 rupees given at a 0% rate, the market rate of interest on similar loans is 10%. So if you go somewhere and say I'll repay 100 rupees after 5 years, please give me an X amount today, they will give you the present value of 100, that is around 62.1. However, the government has given you 100 rupees and hence the remaining 37.9 can be treated as a hidden grant. So this 62.1 will be recorded as per the amortized cost method as per Ind AS 109, and the 37.9, which is a grant, will be recorded as per Ind AS 20 principles. That is, you will either reduce it from the asset or show it as deferred grant if it is asset linked, or take it to the P&L or show it as deferred grant and amortize it in the ratio of expenses depending on whether whether the conditions are there. So over here, first you will have to find the fair value of the loan. Grant is the difference between the loan proceeds and the fair value of the loan, and the grant should be accounted depending on the nature of the loan. The purpose for which the loan is taken is not relevant. It should be accounted based on the loan tenure is irrelevant. Why the loan is given? Is it for the purpose of acquisition of an asset? Is it for helping you to meet over your past losses? Is it for helping you to train your employees? You will look at the purpose of the loan and then accordingly decide. Okay, refund of grants. Remember, refund will be adjusted from the same amount. And when will there be a refund? There will be a refund provided you thought that the conditions of the grant will be fulfilled and hence you recognize the grant. However, at a later date you think or you see that the conditions are actually not fulfilled and hence you have to give the money back. In which case there is a refund of the grant, and if there is a refund of the grant, then you will adjust it from the same account where the grant was originally taken. Like if it was an asset linked grant and you had taken it into the deferred grant account, then you will first adjust the refund from the existing balance in the deferred grant, and excess, if any, will be taken to the P&L. Similarly, if the grant had been taken from the asset, you will again proportionately adjust it from the asset, because the grant was originally adjusted from the asset and the difference in the cumulative depreciation can be adjusted in the P&L. If it was a grant linked to income which was taken to the P&L account, then you will reverse it against the P&L. If it was a grant which is a deferred grant, which was, let us say, taken into, which was a deferred grant, which is, let us say, in the ratio of expenses, again you will first adjust it from the balance of the deferred grant, and excess, if any, will be taken to the profit and loss account. Okay, so this kind of takes care of your grants and their refund. Possibility at the time of refund, there can also be a penalty. So while you are considering the refund, you will also consider the payment of penalty for finding the gain or loss at the time of refund. Okay, so we will try to discuss a few questions on this. So if you go to questions on the government grants, there is a fairly detailed question from the RTP of May 2022. It's a fairly important question, and there is a deferred grant question. So let us quickly review this. So is manufacturing certain chemicals and some wastewater is getting generated to reduce the pollution. The government has introduced a scheme where if the manufacturer installs certain wastewater treatment plant. So this is for you if you were to install a plant. So this is a grant linked to asset. Then the government will provide an interest-free loan up to 50% of the cost of the plant. So there is a loan which is interest-free, but that is provided you are installing a plant. So it is a grant linked to asset. Loan is repayable to the government in 5 years from the date of disbursal, and the manufacturer availing the benefit of this scheme must treat the wastewater using the specified plant before releasing it into the river. If this condition is violated, the entire loan shall become immediately repayable along with the penalty of 10 lakhs. Okay, so there is a 5-year loan, interest free. The cost of the plant is around 50 lakhs. Acha, 50%, that is 25 lakhs, will be given by the government in the form of a loan, interest free loan. So A decided to utilize the scheme, and the market rate of interest on similar loans is 12%. So there is a hidden grant. Accordingly, A got a loan of 25 lakhs and purchased and installed the plant which became ready for use on the same day. Okay. So A's policy is to recognize a grant in relation to depreciable assets in the proportion of depreciation expense. So this is probably you are recording it in the deferred grant account and then you will amortize it in the ratio of depreciation. So a plant has a useful life of 5 years, so you will defer it over the 5 years. And in the month of March 23, that is 2 years later, the government officials did a surprise visit and found that A was not using the wastewater plant as prescribed, and hence the government required you to repay the loan with penalty. A repaid the loan along with penalty on 31st March 23. So what are you supposed to do to measure the amount of grant as on 1st April 21, for which you will have to measure the fair value. So the loan proceeds at 25 lakhs, fair value is 0 into 25 lakhs into the present value factor at the rate of 10% for the fifth year, sorry 12% for the fifth year. If I do this working, this is probably 0.567 and as a result this is 14,17,500. So your grant value will be around 25 lakhs minus 14 lakh 17,500. So the difference between the two, 25 minus 14 17,500, which is around 10 lakh 82,500 will be the grant. What will be the journal entry? Bank account debit, let us say 25 lakhs, to loan 14 17,500, to let us say deferred grant 10 lakh 82,500. This will be in deferred grant. What will you do? Well, you will depreciate the PP over 5 years. In a similar way, this deferred grant will be amortized over 5 years. So this is 1082,500 divided by 5. That is 2,16,500 will be the amortization in the first year, also amortization in the second year, and hence the balance in the deferred grant on 31st March 23 after 2 years of amortization would be, let us say, around 6,49,500. How did you get that? 10,82,500 minus 2 years of amortization. Acha, but what will be the balance in the loan? Well, loan will be recorded using amortized cost method. So this is 14,17,500 plus EIR at the rate of 12%, you will get a closing balance, plus again EIR at the rate of 12% and you will get a closing balance. So this is 14,17,500, 14,17,500 at 12% and another 12%. So your loan will also appear in your books at 17,78,112. Okay. Now what is happening is, due to the inspection you have to repay, and hence a student typically says that, okay, if I have to repay, I will debit first the deferred grant and take everything else in the P&L, which is not correct over here, because when you repay, the grant is gone, but at the same time the loan liability which was there in your books is also gone, and hence you will pass the entry, well, the loan is extinguished. Loan account debit 17,78,112, deferred grant account debit 649,500 to bank. Acha, to bank you can say 25 lakhs or 35 lakhs including the penalty, or you can pass a separate entry for penalty. So if you go to see over here, in this particular case, you will say 1778 of loan will be extinguished, 649 of the grant will be extinguished, and then 25 lakhs ka payment. Acha, plus another 10 lakhs ka separate payment. So 72,338 will be taken to the PNL, and additional 10 lakhs will also be taken to the PNL. So basically what is happening over here is, in this question you are studying refund of grant, you are also studying about amortization of financial liabilities, deferred grant amortization. So it's a fairly interesting question. Please do ensure that you do this properly. Okay, another question is a slightly controversial one, where the institute has made certain changes in the new study material, and this is according to that only, where you have been awarded a grant of 60,000 receivable over 3 years, that is 40,000 in the first year, 10,000 in the second and the third year, contingent on you creating 10 new jobs and maintaining them for 3 years. So this is a grant which is not linked to acquisition of an asset. The earlier grant was linked to acquisition of an asset. This is not a grant which is linked to acquisition of an asset. This is probably a grant which is linked to you creating new jobs and then maintaining them. The employees are recruited at a total cost of 30,000. That is the cost to create the employment, and the wage bill for the first year is 100, increasing by 10,000 in each year. So 1 lakh increasing by 10,000 in each year. Calculate the grant income and deferred income to be accounted in years 1, 2 and 3 under the two situations. The first one is the logical and the important one. There is a reasonable assurance that the entity will comply with the conditions attached to them and the grant will be received. If that is the case, your overall 60,000 worth of grant would be recorded, irrespective of whether you have received 40,000 or 60,000. So basically, if I go to see, this is a grant linked to income and it has to be recorded in the ratio of the expenses. So the expenses incurred in the first year are likely to be 130, that is 100 plus 30. In the second year is likely to be 110 including the 10,000 increment, and in the third year are likely to be 120. So out of the total 360 of expenses, 130 in the first year, 110 in the second year, 120 in the third year. So your grant income would be based on 60,000. 60 into 130 by 360. Second year would be again 60 into 110 by 360, and third year will also be 60 into 120 by 360. And accordingly you will find the grant income. So this is, let us say, 38,000, sorry, this is 21,667 for the first year, 18,333 for the second year, and 20,000 for the third year. Your deferred grant balance will be based on the entire 60,000. So 60,000 minus 21,667, which is amortized in the first year. So this will be around 38,333. Second year you have 38,333 minus 18,333, and hence you will have 20,000 remaining. And last year 20,000 minus, you have received 20,000, and hence it will be 0. Now the problem is arising in the second subpart, where you have been told that there is no reasonable assurance that the grant will be received. So if there is no reasonable assurance that the grant is to be received, as per ICI solution, what they have done is a slightly inconsistent working. What they have done is, and at least that is what we are going to do if it comes in the exam, they have done the grant amortization based on the entire 60,000. So your grant amortization numbers continue to remain the same, 21,000, 18,000 and 20,000. However, while calculating deferred grant, they have taken based on what is the amount received. So 40,000 is received. So they have calculated 40,000 minus 21,667. But that is a little inconsistent, but that is a discussion for some other day. From an exam perspective, if I were to see in the second case, I will say that okay, the grant amortization remains the same, but the deferred grant balance is 40,000 minus 21,667, that is 18,333. If there's no reasonable assurance, then till now what has been received is 40 plus 10 in the second year, that is 50,000 minus 21,667 amortized in the first year minus 18,333 amortized in the second year, and so on also for the last year when it becomes 0. So this is what you need to do if the question specifically tells you that there is no reasonable assurance in line with the institute solution to maintain peace. Though alternative treatments can be debated and argued, at least in the second part, the first part is very logical and correctly applied. Okay, so that takes care of Ind AS 20. And the last standard which we say from an asset perspective is Ind AS 2, which is on inventories. After that, all your asset link standards, the important bucket of your syllabus, asset link standards get done. So we'll go to inventory. Inventory is as per Ind AS 2. Now inventory is something that you hold for the purpose of sale in the ordinary course of business, or for the purpose of consumption in the ordinary course of business. So what all is included within inventory? You will have raw materials, you will have finished goods, you will have work in progress, stock in trade, even loose tools, spares will also be a part of your inventory. Sometimes stores and spares may be in PP if they have PP characteristics, that is they fulfill the 12-month criteria. Now inventory has three main sections over here. Inventory recognition first at cost initially, then at how will the cost flow, like FIFO weighted average, and then how do you value. So initial recognition for inventory will happen, let us say, at cost. How do you measure cost? Similar to that of PP, purchase price plus non-refundable non-creditable taxes minus trade discounts plus directly attributable expenses to get the inventory in the location and condition as decided by the management. If it is a self-constructed inventory, material cost, labor cost, overheads, it will definitely include variable overheads, and even fixed overheads will be included using absorption costing method. Fixed production overheads. Remember, administrative overheads, selling and distribution overheads usually are not included in the inventory calculation. Again, you can add the borrowing cost if the inventory is taking a substantial period of time and it is not manufactured using a largely repetitive process, and if there is any site restoration obligation which is arising because of the manufacturing of inventory, even that can be separately added. So over here, the cost of the inventory will not include administrative, selling, abnormal loss and storage cost unless it brings a necessary change as desired. Usually administrative costs should not be added in my opinion, but there has been a November 23 RTP question where the institute has specifically said that the company believes that a part of the administrative cost is attributable to inventory and hence they have added, but in general other than that you should not be adding it separately. Okay, abnormal loss will be taken to the profit and loss, normal loss will be added. Now how do you add the normal loss? When you calculate the cost per unit, you will take the total price or total cost for the purchase and everything for the inventory divided by the normal units or actual units, whichever is higher. So usually in case of abnormal loss, your units are lower, that abnormal loss has to go to the P&L. So for calculating the cost per unit, you will take the total purchase price divided by the normal units. In case of abnormal gain, actual units might be higher. So normal units or actual units, whichever is higher. Okay, fixed production overheads. Over here, usually when you calculate absorption rate, you will take the budgeted overheads and divide it by the normal output. However, what if the actual output is different? If the actual output is lower, that is a case of abnormal loss, and hence you will continue to show the overheads as your budgeted overheads or your actual overheads, whatever it is, divided by the normal units, so that abnormal loss does not separately get adjusted into the cost of the inventory. However, if your actual output is greater than the normal output, then it is like an abnormal gain, and hence the institute takes the overheads divided by the actual output. Again, the rule is the same. Long story short, wherever you are going to do for overheads, you will take the overheads divided by the actual or normal, whichever is higher. In case of joint products and byproducts, you will first try to find the net joint cost. The net joint cost is calculated as the total joint cost minus the NRV of the byproducts. You will get the net joint cost, and this net joint cost will be allocated to the main products in the ratio of the sales value at split off point. Now, whether a particular product is a main product or a byproduct is based on the seriousness of the management. How serious is the management in selling them, maintaining inventory records, etc. If the management is serious, it is treated as a main product. Otherwise, it is treated kind of as a byproduct. Okay, then you go to the second part, which is the cost flow assumptions. Usually, if inventory units are not interchangeable, like paintings, artifacts, etc., then you follow the specific identification method. However, inventory units are interchangeable, then you are allowed in general to follow FIFO or weighted average. LIFO is not permitted. In special cases like a retailer, you have been optionally allowed to follow retail sales price method, that is the total selling price minus the gross margin can give you the notional cost of the inventory. Or in case of a manufacturer with a clear history and reliable determination, you are allowed to even follow the standard cost method, which is available, let us say, to the manufacturers. Okay, next, when we are looking at valuation, inventory is valued at, for finished good and WIP, it is valued at the lower of cost or NRV. How do you measure the NRV? NRV, remember, is based on the estimated selling price. It is not based on the fair value. It is the estimated selling price minus the estimated selling expenses minus estimated cost to complete. There's a subtle difference between the fair value, which is the value if the sale were to happen on 31st March, with the estimated selling price, which is the actual price at which the inventory actually gets sold after the balance sheet date. So as per Ind AS 10, the actual selling price of that inventory in the post balance sheet period is an adjusting event for you to determine the estimated selling price. Remember, for the estimated selling price determination, you will consider the actual sale price of the inventory in the same condition. Remember, if there was a change in the condition of the inventory, like there's a fire, etc., which is in the post balance sheet period, that is due to a physical change in the inventory, you will not consider that. But if the inventory remains the same, but there is some fall due to a lockdown or due to a introduction of a new model or due to pollution control norms, the inventory condition remains the same. But if it is going to fetch you lesser at a later date, you are going to do the inventory valuation based on the estimated selling price, which is a little confusing for students as compared to the fair value. So you will do some problems on that in Ind AS 10 as well. So it is cost or NRV, whichever is lower. NRV, remember, is based on the estimated selling price, which is slightly different from the fair value. Usually fair value and estimated selling price can be the same if on 31st March, the inventory is sold at 100. I'm expecting to sell it in the future also at 100. However, if there's a price escalation or a price reduction in the subsequent year, then that is the base for the estimated selling price. Inventory and inventory only is based on estimated selling price. Everywhere else, you take the fair value concept. So this is based on the NRV. NRV is the estimated selling price minus the estimated cost to complete and estimated selling expenses. This will give you the NRV. But this is for finished goods and WIP. For raw materials or consumables, you will look. Ideally, you are not holding these raw materials for the purpose of sale. You are holding it for the purpose of consumption in the ordinary course of business, and hence, when you try to measure the raw material cost, it should be at cost only. Let the NRV fall. How does it matter? I don't want to sell the raw materials. So the general principle for measuring raw materials should be at cost only. However, if the finished goods in which these raw materials are going to be used are being sold below cost, so the cost of the finished goods is greater than the NRV, NRV is lower, then this is a loss-making finished good. So the general thought process is raw materials will be used, and hence you don't need to compare their selling price. But if the finished goods in which the raw materials are going to be used is actually a loss making finished good, you might not make that finished good, in which case you'll have to sell the raw materials, and hence the measurement of raw materials over here is at the lower of cost or replacement cost, whichever is lower. You don't use the words NRV over here because NRV is based on estimated selling price, and in raw materials you're not selling, so you might not know the estimated selling price, but raw materials you are buying, and hence you will know the price at which you buy. So you are assuming the price at which you are buying will be same as what you will get if you were to sell. So the measurement of raw materials or consumables will be, if it is a profitable raw material, then the measurement of the raw material will be, if it is a profitable finished good, then the measurement of raw material will be at cost only, no comparison with the replacement cost. But if it is a loss making finished good, then the comparison will happen and you will measure the raw materials at the lower of cost or replacement cost. Replacement cost is a proxy for NRV, it is for the raw material perspective. So over here there is a guidance on replacement cost, and there is a subsequent reassessment of NRV. It is possible that you have measure the inventory at cost, that is 100, or NRV which is 80, and hence you write it off and bring it down to 80. Now in the later years, if the inventory is unsold and the NRV climbs up to, let us say, 105, can you bring the inventory back? Acha, you cannot take it up to 105, you can't go beyond cost, but can you take it up to 100? The answer is yes. Sir, why? The inventory is measured at lower of cost. Cost is 100, 80 is the carrying value. Cost is of the inventory is still 100, or NRV which is 105, whichever is lower, that is 100. So in your ledger, if the inventory is appearing at 80, it can be taken up to 100, can't go up to 105. So there is a subsequent reassessment of NRV, which is very much possible. And then there's a difference between NRV and fair value less. So NRV is based on the estimated selling price and not based on fair value. Estimated selling price is the price which the seller expects to sell the inventory in the future, whereas fair value is the price which a willing buyer is ready to pay on the valuation date. So this is something which can be a little tricky. Okay, so there are a couple of questions pertaining to inventory. So let us review that. Question number 2 is actually not just inventory, it is inventory, lease, investment property, etc. Question number 1 is pure play inventory. So over here you have inventory, various data points are given, opening for finished goods and raw materials. So if I go to see for raw materials, the cost per unit in the opening inventory is probably 10 rupees. Purchases, again you are purchasing raw material unless otherwise given, again the cost per unit is 1 lakh divided by 10,000, that is around 10 per unit. Overheads which are fixed, sales, and you find closing inventory, raw materials and finished goods. The expected production for the year was 15,000 of the finished product. Due to fall in the market demand, the sales price of the finished product was 20 and the replacement cost of the raw material was 9.5. You are required to calculate the closing inventory. Now how do you do that? Well, raw materials will do later, because for that you need to figure out whether the finished good is profitable or loss making. So we need to find the cost for the finished goods. You can do it on a totality basis or on a per unit basis. So over here we can say that how much are the raw materials consumed. So if I were to find the raw materials consumed, I will say opening I had 1100 units plus 10,000 units were purchased minus there are 900 units in the closing raw material, and as a result the raw material consumed are 10,200. Okay. It may be from opening, it may be from current year, either ways the cost is 10 rupees, so 10,200 into 10 will be 1,02,000 will be the raw materials consumed for the finished goods manufactured. Similarly, the finished goods produced, if you want to find, how will you find that? Well, usually your COGS or units sold, you have been given the units sold which is 10,000. So basically your units sold is 10,000, which will be the opening units. So COGS, so units sold is 10,000, which is equal to the opening finished goods, which is I think 1,000, plus finished goods produced, which I don't know, minus the closing finished goods, which is 1,200. So if I do this working, your X, that is the finished goods produced, is also 10,200. So your finished goods produced are 10,200, whereas the expected production was 15,000, and hence this is an abnormal event. You are expecting in normal course 15,000, you are producing only 10,200. So if I were to find the total cost, let's say on a per unit basis or on a totality basis, whatever is comfortable, for the raw materials, we'll say per unit raw materials costing 10 rupees, you are manufacturing 10,200 units, that is 1,02,000 in total. If you look at your labor cost, again labor is assumed to be variable, and hence your labor cost is 76,500. Now this is 76,500 for the actual output produced divided by 10,200, and hence 7.5 per unit. Now the problem is fixed overheads. When you look at fixed overheads, your total fixed overheads is 75,000, but that is fixed. Even if you produce 0, that would have been 75,000. When you calculate the per unit, this will be 75,000 divided by the normal or actual, whichever is higher, that is 15, and hence this is going to be 5. But did you make 15,000 units? No, you made only 10,200. So 10,200 into 5, that is 51,000 is absorbed. The remaining 24,000 will remain unabsorbed. So if I go to see, your total cost comes to around 22.5, and if I total it up on totality basis, 1,02,000 plus 76,500 plus 51,000. If I total up, this is also 2,29,500, which is nothing but 22.5 into 1,02,000. So now if I look at the cost of the finished goods, the cost of the finished goods is higher than the NRV of the finished goods. So you will measure the finished goods at lower of cost or NRV, that is 22.5 or 20, whichever is lower. That is, you will measure the finished goods at 20 into 1200 units, and hence 24,000. Raw materials typically measured at cost only, that is 10. However, because this finished good is a loss making finished good, you will measure it at the lower of cost or replacement cost, that is 10 or 9.5, whichever is lower, that is 9.5, and 9.5 into 900, that is equal to 8550, will be the measurement base for the inventory of raw materials. So this is a fairly interesting question covering the cost calculation, absorption, cost or NRV, whichever is lower, raw material measurement, everything covered over here. So something which is definitely important. Now in question 2, what is happening is, you are in the construction industry and on 1st April 13 you purchased a property which is land for 2 crores and immediately began to lease the property. So this is land which is given out on rent. If it is given out on rent, this land will be treated as an investment property which will be accounted for using the cost model under Ind AS 40 on an operating lease. Annual rentals were 20 lakhs. Where will this go? P&L. On 31st March 17, that is around 4 years later, the fair value of the property was 2 crore 60. Does not matter. Why? Because this is investment property, and investment property cannot be revalued. It will be shown at cost because it is land. There will be no depreciation, and hence it will continue to appear at, for example, 2 crores only. Under the terms of the lease, Y was able to cancel the lease by giving 6 months notice in writing to X. Y gave this notice on 31st March 17 and vacated the property on 30th September 17. So till 30th September, remember, this property was being used as a rental unit only. The actual change in use will happen from 30th September 17 or 1st October 17, as the case may be. So in the first 6 months, 20 lakhs into 6 by 12, 10 lakhs will be the rental income which will go to the profit and loss. On 30th September, the fair value of the property was 2 crore 90. Okay, but in my books, investment property is still going to be shown at cost only. On 1st October 17, X immediately began to convert the property into 10 separate flats, which of equal size, which it intends to sell in the ordinary course of business. In hence, you are moving from investment property to inventory from 1st of October. Are you allowed to reclassify? Yes, as per Ind AS 40, you can reclassify if there is an actual change in use. There is an actual change in use happening on 1st October 17, and hence you will reclassify. At what value will you reclassify? At the carrying value. The carrying value is 2 crores, not 2 crore 90. You will reclassify at 2 crores. X spent a total of 60 lakhs on the conversion project between 30th September to 31st March, and the project was still incomplete, so it is work in progress on 31st March, and the directors estimated that they need to incur a further 40 lakhs to complete, after which each flat could be sold at 50. So now on 31st March 18, this is inventory, work in progress, which is measured at cost. The cost is 2 crores or 200 lakhs plus another 60 lakhs actually incurred, so this is 260, and you will compare it with the NRV. NRV is 50 lakhs. Okay, 10 flats, that is 500, but to get that, I'll have to incur another 40 of cost, and hence the NRV is 460. So you'll measure whichever is lower, that is 260. So what do you have to do during the current year? There's a reclassification from investment property to inventory. This reclassification happens at 2 crores. Before that, there is a 10 lakh rupees rental income which will go to the profit and loss account, and later this becomes inventory. Subsequent expenditure to get the inventory in the condition as desired will be added. So this is 260, compare it with the NRV, that is 460, select whichever is lower, and hence your inventory will be measured at 260 as on the balance sheet date. So this is around 260 as on the balance sheet date. Okay, so that takes care of inventory and all of your asset link standards. Next, we can go to a standard which is kind of slightly connected with them, because you need to find a lot of fair values. So small standard we can do Ind AS 113, which is on fair value measurement. After that, we can go to other standards which are linked to disclosures, liabilities, etc. So Ind AS 113 on fair value measurement. Ind AS is kind of obsessed with fair value and there is so much fair valuation everywhere. So what are the principles that you should remember for fair valuation? First, 4 principles are there. First, fair value is the exit price, the price that you will get if I were to exit, that is sell an asset or discharge a liability. So that is an exit price. Second is that it is the fair value in the appropriate market. Now the appropriate market over here can be the principal market or the most advantageous market. The principal market, if it is there in any product, would be the market where there is a large volume of trading that happens, large number of buyers and sellers, which is greater than every other market. If such a market exists, the price in that principal market you will take. But if there is no such market, that is a product is or an entity is operating in multiple markets, each of them are bigger, like BSE and NSE are 2 big markets, in which case over here you will take the most advantageous market, that is the market where you get the highest net proceeds after deducting the transportation cost as well as transaction cost both. That is what you call as your that is what you call, let us say, as your most advantageous market. Remember, the assessment for most advantageous market is only done if the entity does not have a principal market. If there is a principal market, you will take that market only. So the exit price in the appropriate market between market participants. Again, over here, the price is what the market participant would be willing to pay. There may be certain entity specific restrictions. So you might have a plot of land for commercial or residential purposes. The entity cannot construct commercial buildings. However, someone else can construct, and hence the price that is relevant is not what an entity can do. It is like value in use. It is what a market participant can do. So that is the third thing. In an orderly transaction at the valuation date. So an orderly transaction means it is not a transaction under distress, or it is a transaction where the parties have adequate information and accordingly transacting. So this is your fair value. 5 important ingredients: the exit price in the appropriate market, between market participants, at the measurement date, in an orderly transaction, where the appropriate market can be either the principal or the most advantageous market. And the most advantageous market, if required to be determined, is a market where you will get the highest net proceeds after deducting both transportation and transaction cost. Once you decide the appropriate market and you want to find the price in that appropriate market, there are various valuation methods, rules and techniques. But when you want to find the price, what will be the price? The price will be the appropriate price minus the transportation cost, but you will not deduct the transaction cost. One needs to remember, this is a little confusing. So the fair value of the price will be after deducting the transportation cost, but you will not deduct the transaction cost. If you deduct the transaction cost, it will become fair value less cost to sell. So if a standard requires you to deduct the transaction cost as well, then it will become the fair value less cost to sell. But the word fair value itself means the value after considering the transaction cost, after considering the transportation cost, but before deducting the transaction cost. Okay. Next, if there are non-financial assets which have multiple uses, then which is a fair value you should take? Well, you should take the fair value from the highest and the best use. Highest and the best use can be derived by looking at the current use. If nothing is given, that can be assumed to be the highest and the best use. So you can compare the current use and potential uses which a market participant in your locality will possibly consider. You will not take notional hypothetical uses which market participants would usually not consider. So you will take the fair value as the highest and the best use from the current use or possible alternative uses. While considering the fair value under possible alternative uses, you will also include or deduct the expenditure which is necessary to bring the asset into the condition for the alternative use. Like I might have an industrial mill, the fair value will be the value as an industrial mill. However, if in the recent vicinity you have constructed residential towers, if I want to take the value as if I use it for a residential tower, then I will take the value of a vacant plot of a land for a residential tower. But to find a vacant plot, I will have to incur certain demolition expenditure, which I will deduct. So I will take the highest and the best use, considering the current use and the possible potential uses which the market participants will consider. And while taking the potential uses, I will also consider the expenses which may be necessary to get the asset which is ready into the alternative use condition. Okay. Next, you have the fair value hierarchy and selection of the valuation method. For fair value hierarchy, the golden rule is you will select the valuation method which maximizes the use of observable inputs, that is level 1 category inputs, and minimizes the use of unobservable inputs, that is level 3 category inputs. What do you mean by observable inputs? These are inputs which you are taking directly from an active quoted market. There's no discretion that you are applying. However, unobservable inputs are like your forecast, like the growth rate, cash flow forecast. These are your forecasts which cannot be traced back to an observable data. So the standard further segregates these inputs into 3 levels. Level 1 would mean the quoted market price of an identical asset in an active market. Quoted market price, like you have a 24 karat gold in the MCX, quoted market price of a 24 karat gold biscuit, identical asset. That is level 1 category. Level 2 would mean quoted price of a similar asset, not identical. Like for example, you have a 23 karat gold, but MCX quotes the price of only 22 karat and 24 karat gold. So you will have to make certain adjustments. So this is the quoted price of an similar asset. You will have to make certain adjustments. So this is level 2 category, and level 3 means, well, let us say there is no quoted market price, in which case you will have to make certain forecasts. Like a private company, there is no quoted market price. You will have to make certain forecasts, and that will be level 3 category. So if I am a company like SpiceJet whose shares are quoted, my valuation will be based on SpiceJet's actual quoted market price, irrespective of whether I think it is right, wrong, higher, lower, it does not matter. However, if I'm a company like Air India whose shares are not quoted, I can take a similar comparable like Indigo or SpiceJet, and based on that I can arrive at the value probably. That is level 2 category. However, if I'm in a completely new industry, like if I'm SpaceX, space programs, I don't have any company which is listed which is into space programs, in which case level 1, level 2 not possible, in which case I'll have to use the level 3 category valuation. Remember, whenever you are having a level 1 category price like a market value, you don't need to apply any valuation method. You will directly take the quoted market price without any adjustments for the purpose of valuation. However, if level 1 category quoted market price is not available, then you can use various valuation methods. For example, you can use a market approach. Like you can in market approach, you will take the EPS of your company into the comparable P multiple of a comparable company, usually level 2 category. Or an income approach, where you will try to forecast income like dividend Gordon model and try to find the value. That is typically level 3. Or an asset based approach, like in mutual funds you might sometimes find the NAV. Depending on the data available, it can be level 2, level 3, etc. Okay, so these are the various valuation theory. So if you go to the questions over here, so question 1 is easy and an interesting one. So an asset is sold in 2 different active markets, and so they have defined what an active market is at different prices. Okay, so there's market A and B at different prices. An entity enters into transactions in both markets and can access the price in those markets at the measurement dates. Okay, so in market A, the price is 26, transaction cost is 3, and cost to transport is 2. Okay, in market B, it is 25, the transaction cost is 1, and cost to transport is 2. Find the fair value of the asset if market A is the principal market. If market A is the principal market, I don't even need to look at market B. I will directly say, and I want to find the fair value, that is 26 minus the transportation cost, that is 2, and hence this is 24. That's it, that is a fair value. So over here your answer is 24. The fair value if none of the markets is principal, in which case I'll have to find the most advantageous, but for finding the most advantageous market, I'll have to find the net proceeds after deducting both transportation and transaction cost. So net proceeds over here is 21. In B is 22, and hence B refers to the most advantageous market. And if B is the most advantageous market, the fair value over here for B would be 25 minus the transportation cost, which is 2 rupees, and hence this is 23. So in the second case, for market B, this is going to be 23. We have first determined what the most advantageous market is, and then the fair value is to be determined. This is question number 1. The next question is an interesting question in the RTP, where you are trying to find the value of a decommissioning liability. There's one point in the question which results in a slight confusion, but otherwise the question is fairly consistent. So over here you have taken over on 1st January 11 a decommissioning liability in a business combination. You'll have to measure it at fair value. This liability is going to be after 10 years. Okay. Now, if A was allowed to contractually transfer this liability to a market participant, we are saying market participant, what would they consider? Then market participant would use all of the following inputs. First, the market participant would say that in order to dismantle, there would be certain labor cost which is incurred. Now, the labor cost can be 100, 125 or 175 with different possibilities. So, if I consider the probability based weighted average, they have considered probability based. So the question has told you probability based weighted as appropriate. So if I do the working, this is 100 into 25%, 125 into 50%, and 175 into 25%. So if I total up, this is around 131.25. So I'll say on an average, the labor cost expected are 121.25. A market participant would say that okay, what is to be paid for labor only is 131.25. Apart from that, there's 80% which is attributable to overheads. 80% of the labor cost, that is around 105. So I will also need machines, and hence if I go to see the total over here is going to be 236.25. But that is provided if I sit and dismantle. Probably I would say that if I were to appoint a contractor, the contractor will have to incur these costs. But will he recover only these costs from me? No, he will recover his profit margin as well. The compensation that a market participant would require for undertaking this activity and for assuming the risk, it is your burden. I am taking it over. Why would I take it over only at 236? I would say, by this is a cost that I will incur, but the headache that I have to incur, I'll need a compensation for that. So that will be profit on labor and overhead cost. That is a 20% markup. Markup is on cost, which is consistent with the rate that a market participant would require as compensation. So this is 236 plus 20% over here will be, let us say, 47.25, and over here the risk that the cash flows may differ from those expected. Okay. So A estimates that the premium will be 5% of the expected cash flow. See, the expected cash flow over here, if I were to approach to a contractor, would be 283.5. But on that I will add a 5% premium as well. So this, and to this I will have a 5% premium. So this will be probably around 14.175. So if I total up, this is around 297.675 or 68. The question over here tells you that the expected cash flows are real cash flows, that is cash flows in terms of the monetary value today, which means inflation has not been considered. In the first point, there is some language which can result in some confusion, resulting into saying that labor costs may include inflation. But if this line clearly says that the expected cash flows are real cash flows, that is excluding inflation, we will consider in line with the institute solution that this is excluding inflation. The effect of inflation on the expected cost is 4% unless otherwise given. This is 4% per annum. So this is into 1.04 raised to 10. So this is, let us say, 1.04 into, probably this is around 1. Just a second, this is 1.48, yes, 1.48 or something. So this is 1.48 into around 297.68 will come to around 440. So this is your 440.64. This is your number that is typically given in the questions of PP, which says that the entity expects that 440 million of costs will be incurred to dismantle. This is how that 440 would have been arrived. Okay, but this is to be incurred after 10 years. The effect of inflation, the time value of money is represented by a risk-free rate of 5%. Okay, this will help you in calculating the discount factor. But is a site restoration obligation a risk-free obligation where I will require only 5%? No, it is a risky, and hence there will be a risk premium. So the risk premium over here is 3.5%. A lot of literature is written, but we mean that 5% is risk free plus the risk involved over here is 3.5, and hence 8.5% will be the discount factor. So over here, if I want to find the fair value of the obligation, I will say that okay, at the end of the day, 440 is something that I am expected to incur after 10 years. The discount factor over here is going to be at the rate of 8.5% for 10 years, and hence in present value terms 194.97 will be the present value of this site restoration obligation. So this takes care of the fair value standard as well. So we will next go to the other liability linked standards like Ind AS 37, Ind AS 19, Ind AS 12 on income taxes, and foreign exchange maybe if possible, and then we'll do the disclosure and other related standards and theory probably separately. So over here, if you go to Ind AS 37, now we are done largely with the assets and the allied standards which is pertaining to the assets. We'll go to the liabilities, we'll go to Ind AS 37, the general standard which pertains to the liabilities. So the standard first starts with defining what is meant by a liability. Liability is basically a present obligation which is arising out of a past event for which an entity will have to entail an outflow of economic resources. An asset is usually a resource which is controlled by an entity which gives future economic benefits. Here there will be an outflow of resources. This is a liability. Within liability, there is something called as a contingent liability. Like in a liability, you have a present obligation. Present means the existence of an obligation, whereas when you look at a contingent liability, there is a possibility over here. So there is a possible obligation that can possibly arise. So over here, in terms of liabilities and contingent liabilities, you will have, let us say, a possible obligation which will be resulting in, let us say, a contingency. So when we look at a possible obligation, there can be a contingency which may or may not arise. But each of these obligations arise from something called as an obligating event. What do you mean by an obligating event? An obligating event is an event which gives birth to the obligation. This obligating event may arise due to the past legal or constructive obligations. Like a legal obligation is an obligation that arises out of a law, like a gratuity, or a contract, like a salary, or it can be constructive, which can be arising due to past practices or published policies, which give rise to expectation in the minds of the affected parties. Like a Diwali bonus, for example, can be a constructive obligation. You will create a liability in general due to both legal as well as constructive obligations. Okay. However, what happens in case of a contingency? In case of a contingency, if it is a contingent liability, you will create a provision if it is probable. Probable means more likely than not. That is a more than 50% chance of this liability possibly having been paid or having been to paid. So if there's a more than 50% chance, then as per prudence and conservatism, even if it is a possible obligation, you will create a provision, that is P&L account debit to provision, for example. However, if it is uncertain, that is equal to 50-50 chance or less than 50% chance, then you will give a disclosure in the notes. However, if it is remote, that is less than, let us say, 5 or 10% chance, then you will ignore it altogether. This is for contingent liabilities. For contingent asset, you take a step backwards when it comes to prudence and conservatism. You will say that contingent asset, if it is probable, then you will merely give a disclosure. If it is uncertain, you will ignore it altogether. However, if it is virtually certain, that is without any kind of ambiguity, if you believe that you are going to receive it, only then will you recognize the asset. Virtual certainty usually arises from facts where you get formal confirming evidence that you are going to receive, like when in a pending lawsuit where you are going to receive the compensation, if a judge gives the verdict that you have won and they announces the compensation, that is what you call as virtual certainty. Or if there's insurance and an insurance company gives you written formal confirmation of the insurance proceeds being received, that is called as virtual certainty. And if it is virtually certain, only then can you recognize the asset. So over here, you have been defined on what is probable and virtual certainty. Virtual certainty, remember, arises from facts which arise from formal confirmations and not just estimates or experts' opinions. Sometimes there is a reimbursement asset. If you are going to receive a reimbursement and it is virtually certain that the reimbursement is going to be received, in which case you will recognize expense as net of the reimbursement amount. So let us say your obligation to pay is 700 rupees of expense on account of compensation, out of which 50% is a compensation that someone else is going to be paying to you, and this is virtually certain that you will get that, in which case for that 50% of the compensation you will recognize what we call as a receivable, and the expense will be recorded only to the extent of your share. Remember, insurance is not a reimbursement contract, it is an indemnification contract, because it is your loss that you have to bear and the insurance gives you an indemnification. Okay. Next you have, let us say, data regarding, let us say, certain adjusting events which might happen in the post balance sheet period. Remember, if virtual certainty arises after the balance sheet date, you will not record an asset on account of that, because till the balance sheet date it is not virtually certain. Now when it comes to the measurement of provisions, there are 3 or 4 principles that you will have to remember. The first is your measurement is to happen based on the best estimate. Now that best estimate can be calculated as the expected value method, that is probability based weighted average, or using the most likely value method depending on the facts and circumstances of the case. But you will record the provision based on a pre-tax basis, not on a post-tax basis. Secondly, if the effect of time is material, that is the amount is likely to be paid at or beyond 12 months, that is when it is considered the effect of time is material, in which case you will create a provision on a present value basis. And lastly, pertaining to risk and uncertainty. So if there is some uncertainty, like we just did some time back, that site restoration obligation, we said by the amount might change and hence you are putting a 5% buffer or premium, then you will make an adjustment depending on the data given in the question. And lastly, if you are expecting to get some proceeds from sale of certain items, you will not include that in the measurement of provision. Or measurement of provision will be based on the amount that you will have to pay. Any cash flows that you are getting in inflows should not be considered. Okay. Sometimes what might happen is you have a obligation to pay. However, you are unable to measure it reliably and hence you are unable to record it. So in such a case, you will have to give a disclosure in case you are unable to measure it. Further, if you are able to measure provisions, then once you measure the provisions, does that mean that it will remain the same? No, provisions are something which will keep on changing based on the revised facts at each balance sheet date. This is not an equity item, it is a liability item and hence you will have to reassess for these provisions at each of the balance sheet's date. So the provision should reflect the current best estimates. Further, when the discounting is used, the carrying amount of the provisions increase in each year to reflect the passage of time. Like in case of site restoration, as each year passes, you will unwind to find the closing balance of the provision. This is finance cost, which is called as unwinding, which you have done in the site restoration cases. Two special cases in this standard. First, there is something called as onerous contracts. Onerous contracts means the unavoidable cost of fulfilling this contract is going to be greater than the benefits that you are going to get from executing the contract. Like for example, you have entered into a contract to buy these goods at 50 rupees. However, now the market is dried up and the best place where you can sell is at 40 rupees, and hence there's an unavoidable loss of 10 rupees that you are going to get on this contract. So this is an unavoidable cost. However, you can cancel the contract, but if you cancel the contract, there will be a penalty of, for example, 12 rupees that you have to pay. So the unavoidable loss is a lower of 10 or 12 and hence that is 10 rupees. So the standard requires you to create a provision for the onerous contract. The moment the contract becomes a burden or onerous, you will create a provision at a lower of the amount that will be incurred to execute the contract or to cancel the contract, whichever is lower. Remember, if the contract becomes onerous, then the assets that are going to be dedicated or used for that contract also have an indicator of impairment. Now, one needs to be able to distinguish between an onerous contract like you had in your CA Inter AS7. If you take a construction contract whose construction revenue is 1000 and estimated cost is, let us say, 1200, then the contract is burdensome and you create a provision for 200 rupees, the expected loss. That is an unavoidable loss. However, you need to distinguish this from future operating losses. Like you are a startup and you expect that in the next 3 years you are going to incur future operating losses. These are not arising out of a contract. This is losses that will arise from your day-to-day course of your operations. This is not called as an onerous contract and no provision is needed for future operating losses. You will record the losses as and when these losses are actually incurred or happening. Last, you have the provision for restructuring. What do you mean by restructuring? Restructuring refers to closure of a line of business or geography, or termination of a line or changes in management. So this is a restructuring exercise. Now, the guidance over here is, when will you create a provision for restructuring? That is the timing. Depends on whether it is a legal obligation. You will create a provision for restructuring when the court order comes for restructuring, or it is a constructive obligation, in which case you will create a provision when you create a detailed formal plan for closing, and that formal plan creates expectation in the minds of the affected parties. When will it create an expectation in the minds of the affected parties? If the formal plan is communicated to the concerned parties like employees, customers, etc., or you start dismantling and implementing the restructuring plan. So basically, you will create a restructuring provision in case of a legal obligation at the time of the court order, or in case of constructive obligation if a detailed formal plan is placed and this plan is either communicated to the concerned parties or you have started implementing that plan. That is when you create a provision. Now, what all will be a part of this provision for restructuring? You will include the direct expenditure or cost which is linked to restructuring or closure. More appropriated, what is linked to closure? So what is linked to closure? Something like legal fees, bankers fees, or termination. You might have to relocate certain employees and you might incur relocation costs. That is not linked to closure, that is linked to continuance, and hence that will not be a part of the restructuring provision. Future operating losses, not be a part of the restructuring provision. Maybe in the new center you are setting up, let us say, distribution or other information technology networks, not a part of the restructuring provision. You will include the legal fees, banker fees, termination fees, but you will not include relocation costs, retaining costs, cost of making new equipment, future operating losses, etc. Okay, if there are levies, you will recognize it as and when the obligations for those levies are arising. So basically, this is regarding Ind AS 37. If you go to the questions, I think there is one question that we have taken over here. This is from the RTP of November 2023. It is an improvisation of a detailed question which was earlier there. So let us review this once. On 1st January 2012, the directors decided to terminate production at one of the company's divisions. So this is the directors deciding on 1st January. The decision was publicly announced on 31st January. So this is the date when one can say that a constructive obligation arises. So a formal plan must be made on 1st January, but it is communicated on 31st January 12. So this is the date when you will create a provision for restructuring if applicable. The activities of the division were gradually reduced from 1st April 12 and the closure is expected to be completed by 30th September 12. Okay, so that's fine. At 31st January 12, the directors prepared the following estimates. So there is a redundancy, that is a closure termination cost, initially estimated at 2 million. The expenditure of 8 lakhs will be necessary to retrain the employees who are affected by the closure but will be remaining with Johansson. The retraining will begin in July 12 and the estimates of the redundancy cost will be 1.9 million. Latest estimates with retraining cost at 8.5. So if you were to create a provision for the retraining, you will not create any provision because you are going to do it from July 12. It is not a part of the provision, it is linked to continuance. However, for redundancy, you will create a provision of 8.5. Initially, you must have created a provision of 8. However, the provision will be remeasured to reflect the latest estimates, which is based on 8.5. So that is 8.5 will be a part of your provision. Plant and equipment having an expected carrying value of 8 million will have a recoverable value of 1.5 million, and hence there is a possible impairment loss of around 6.5 million. This is an impairment loss. So this will be recorded as a part of your impairment loss. Okay, division is under contract to supply goods to a customer for the next 3 years at a predetermined price. You have to pay a compensation of 6 lakhs to this customer. Compensation is actually paid on 31st May at 5 lakh 50. Now, we don't know when the directors are signing the accounts. If the directors are signing the accounts on or after 31st May, you can actually take 5 lakh 50 because that is an adjusting event. It gives you additional information of the compensation payable, which was payable. The contract was onerous as on the balance sheet date, and as a result, we will see when the directors are signing the accounts. If you go to see, have we been told? Okay, let's see about that. So this is provision for an onerous contract. So this is a case of, let us say, onerous contract, and over here you will have provision for restructuring. This is a part of a restructuring provision. Okay, point 4, the division will make losses of 3 lakhs per month for the first 3 months, 2 lakhs per month in the next 3 months. This proved accurate for April and May. So probably you are still not finalizing the accounts till May. So over here, this is provision for future operating losses for which you will record it in the year 12-13. There will be no effect in the year 11-12 for the same, and as a result, over here there will be no effect for this. The division operates from a leasehold premise and the lease is non-cancelable, operating with an unexpired term of 5 years from 31st March 12. Okay, so this is a non-cancelable lease and the annual lease rentals payable in arrears are 1.5. The landlord is not prepared to discuss an early termination. Following the closure, Johansson estimated that it will be able to sublet the property from 1st of October 2012, and Johansson could recover a rental of 3 lakhs for 6 months from 1st October and then annual rentals of 5 lakhs for the remaining periods. All the rentals will be received in arrears. So basically what you will have is a provision again for an onerous contract, unavoidable loss. On fulfilling the contract, probably you will have a 1.5 million cost for 5 years. So you have been given the present value from years 1 to year 5. This is 4.32. So this is 1.5 into 4.32. This you will have to incur. Apart from that, you will also probably get 3 lakhs. So this is 0.3 million. This you will get at the end of the first year into 0.95. And you will also get 5 lakhs. Let's say 0.5 for the next 4 years. So this is, let us say, year 1 to 5. So this is into 4.32 minus 0.95, and hence you will do this math and you will get the provision for an onerous contract. So over here nothing is given, so let us assume that the financials are not yet signed, in which case for the onerous contract you will create a provision, for example at 5.5 lakhs. Okay, so if you go to see for the first case, is there anything else remaining? Okay, I guess that's it. So for the first case, you will create a provision for the latest 1.9 million. Impairment in the second case is 6.5 million. Compensation is 5,50,000, that is 0.55 million. No charge for the fourth case, and in the last case, you will create a provision at 1.5 into 4.32 minus 0.3 for the 1 year and 0.5 for the remaining 4 years. This is a provision again for an onerous contract. So this kind of takes care of an important question covering restructuring provision, onerous contracts, etc. pertaining to Ind AS 37. Okay, next you will go to another liability based standard, that is Ind AS 19, which is employee benefits. Now when you look at employee benefits, it is a special case of a liability which is payable, let us say, to the employees. So Ind AS 19 covers all types of employee benefits. It will include all types of employee benefits except share based payments, because that will be covered under Ind AS 102. So the employee benefits over here will be segregated into 4 categories. There will be short term benefits, benefits which are payable in less than 12 months, like salaries, wages, bonus. Short term compensated absences, like leaves carry forward for 1 year, less than 1 year, let's say. These are short term benefits. Second is post employment benefits, benefits which are payable at or after retirement, like gratuity, pension, provident fund, etc. Termination benefits, which are on account of a sudden termination, like a VRS or a retrenchment on firing. And last is other long term benefits. So every benefit which is not covered under either of these items will be covered under, let us say, other long term benefits. So over here, something like a silver jubilee bonus is neither post employment nor is it short term, in which case it is going to go under other long term benefits. So how will the accounting happen? In case of a short term benefit, you will record the expenses on an undiscounted basis, because the effect of time is not material. For something like salaries and wages, you will record the expenses as and when they are incurred. If you have not paid them, then you will create a payable. If you have paid them in advance, then you will create an advance salary asset, for example, or a prepaid salary. For bonus, it depends on the type of bonus. Like if it is a performance bonus, you will record it as an expense and an obligation only once it is declared. If it is a statutory bonus, you will have to record it as and when it accrues. Retention bonus as and when a specified time period passes. Or you might have a profit sharing plan, like an MD, you are going to pay 5% of the profits, in which case as and when profits are earned, 5% of that you will create, let us say, a provision. Now an important thing over here, in my opinion, is compensated absences. Now compensated absences are leaves which you were entitled to, let us say 30 days of leave in a year, but you did not take. So let us say out of 30 days you took only 15 days, which means what happens to the remaining 15 days? If these remaining 15 days can be encashed, then you will create a provision for these 15 days, because you can either carry it forward and utilize it, or you can encash it, which means for the entire 15 remaining you will create a provision. These are called as vested benefits. If these leaves can be carried forward and utilized, or it can be encashed, in which case you will create a provision for the entire unutilized leaves. So if it is vested, employees can claim encashment for the unutilized leaves. You will create a provision for the unutilized leaves always. However, it is non-vested, which means the employees can carry it forward, utilize it, let us say within a year. However, they cannot claim encashment, in which case you can create a provision if you can carry forward for the leaves that are expected to be utilized. If you had 15 days, but you are expecting that only 10 days will be utilized, then the provision will be created only for 10 days. This is provided the leaves can be carried forward, but not be encashed. In cases the leaves cannot be carried forward, they cannot be encashed at all, then no provision is to be created. Yes, you worked hard, you should have taken leaves, you did not take leaves, in which case you can carry forward the leave. No, you cannot. You can encash the leave. No, you cannot, and hence you are under no obligation as an entity to pay anything to these employees. So over here, if you have accumulating, that is leaves that can be carried forward, non-vested leaves, that is you can carry forward but you cannot claim encashment, in which case provision will be made for leaves which are expected to be utilized. But if it is non-accumulating, that is you cannot be carrying forward, non-vested leaves, no provision to be made for the unutilized leaves at all. In my opinion, within the short-term benefits, this is the most important part. Okay, next you go to post-employment benefits. Post-employment benefits can be segregated into 2 types. There is a defined contribution plan and a defined benefit plan. A defined contribution plan is a plan like a recognized provident fund or a statutory provident fund, where the amount of contribution is fixed. Once you do the contribution, then you have no further liability. So your accounting will be based on the contribution which is payable. That's it. However, in case of a defined benefit plan, the benefit formula is fixed. That is, you will have to pay a stated amount of benefit irrespective of whether you are contributing somewhere or not. Like a gratuity is 15/26 into last one salary into completed years of service. So if suddenly the last one salary goes up, you will have to pay gratuity based on that revised salary amount. You cannot just hold your hands up and say that, well, you know what, I'm not going to kind of pay this because I contributed assuming some other salary. No, your formula, that is the benefit, is defined. So over here, you look at the defined contribution plan, the amount of contribution is defined. In a defined benefit plan, the benefit amount is defined. So in case of a defined benefit plan, your liability measurement will be based on a projected unit credit method where actuarial valuation is recommended, though it is not mandatory. A defined contribution plan is where the actuarial, that is a liability risk, or investment, that is the asset risk, is not on the entity. That is a defined contribution plan. If the investments fall short, that is a provident funds lookout, not the entity's lookout. If the liability changes, the interest rate changes, that is a provident funds lookout, not my lookout. My obligation is just to make the contribution. Or a group medical claim plan, my obligation is just to make the contribution. If it's a defined benefit plan, on the other hand, in case of a defined benefit plan, my obligation is to pay whatever is promised. So if the liability suddenly increases or if your assets fall short, it is my responsibility. So the accounting for defined contribution plan is fairly easy. If a contribution is paid, that will be the expense. If the contribution is payable, you show it as a payable with an expense being recorded. You don't have to measure the liability in case of a defined contribution plan. But in case of a defined benefit plan, like a gratuity plan, a medical reimbursement plan, pension plan, you will have to measure the liability amount, and that measurement happens using the projected unit credit method, where you might need actuarial valuation and help of actuaries. So there is some theory part where you have the various types of plans, like state plans, which are usually government plans, which are defined contribution typically, multi-employer plans like mutual funds or finance companies taking money from multiple employers. These are decided depending on the terms and conditions of each plan. If nothing is clear, you will account it as if it's a defined contribution plan as per the institute's guidance. Next, you have multi-employer group share-based payment plan, where there's a group company which is having a share-based payment plan. Typically, the risk is within the group, and as a result, we will treat it as a defined benefit plan. And lastly, insured benefits. Typically, insurance company bears the risk, and hence it is typically a defined contribution plan. However, we will have to see the facts of each case and then decide. Okay. Now you go to the accounting for a defined benefit liability. A few important terms that you need to remember is, when you try to find the defined benefit liability, how will you find the defined benefit liability? If a service is rendered in the current year, does a current year service give rise to one additional unit of entitlement? If yes, you will create what you call as a current service cost. So you will create a current service cost if a current year service increases an entitlement to the liability. However, what happens is, as time passes, each year of obligation comes one year closer. So if you are expecting that the employee will render service for 5 years, you create a liability with a current service cost for the first year. But then when one more year passes, you come one more year closer. Your opening balance is one more year closer, and hence there is something called as an interest cost. The increase in liability that arises due to passage of time, this is called as interest cost. Okay. However, what will happen? Let us say, is there a possibility that there is a change in the plan? Yes, there's a possibility that the plan itself gets amended. The entity amends the plan, in which case there is something called as a past service cost. But sometimes the entity does not amend the plan. However, the actuary changes the estimates, in which case this is called as an actuarial gains or losses. These actuarial gains or losses are going to be taken into the other comprehensive income. Okay, for a post-employment plan, the remeasurement gain or loss on account of actuarial gains or losses will go in the other comprehensive income, and sometimes the plans get curtailed. So there is a curtailment or a reduction. This curtailment, gain or loss due to curtailment or reduction, will also go to the P&L. Now, there is a fairly detailed example that we have explained in our concept book, but if I were to kind of briefly explain to you based on a numerical, hopefully that should make it a little clear. You will go to, so there's one question. Okay, there is another question over here. There's question number 2. Which we can use for kind of figuring out this guidance on what is a past, what is current service cost, what is interest cost, how do you measure a liability, etc. So this is question number 2. Over here you have the first 2 paragraphs, which are general paragraphs, which is just a generic thing. It is not really important. The main question starts from the 3rd paragraph. One of the employee benefits involves a lump sum payment to an employee on termination of the service. Okay, this is on termination, so this is post-employment, which is equal to 1% of the final salary for each year of service. So you have promised to pay a benefit that is 1% of the final salary. So this is a defined benefit plan. Consider the salary in year 1 is 10,000 and it is assumed to increase at 7% per annum each year. Taking a discount rate of 10%, you are required to show the benefits attributable year on year and the obligation in respect of the benefit year on year. So obligation is a liability. For an employee who is expected to leave at the end of year 5. Acha, for that employee, the current salary is how much? Well, it is 10,000. But when that employee leaves, what will be the salary? Well, the salary escalation seems to be 7% per annum. So that is 1.07 raised to 4. Students sometimes make a mistake of raising it by 5. You can raise it by 5 if the salary of year 0 was 10,000. The salary of year 1 is 10,000. So the first escalation will happen in year 2, then 3, then 4 and then 5. So there are 4 escalations. So 1.07 into raised to 2, 3, 4. So this is around 1.3107. So this is 13,108 approximately. So this is your last drawn salary. So for each year of service, you will get 1% of 13,108 into 1. So that is around 131 approximately for each year of service. So this is 131 that you are expecting to get for each year of service. Okay, so if the first year of service is rendered, the service will give rise to a benefit of 131, but this 131 is not going to be received immediately. This 131 is going to be received, let us say, after 4 years, and hence you will try to find the liability. So this is for the first year, you will say 131 into the present value factor at the rate of 10% for 4th year. So this is 0.683. So this is 131 into 0.683. 4 years are remaining. And hence this is probably 89. Now why is this 89 or 89 arising? It is arising because of the service rendered in the first year. Your journal entry will be defined benefit expense, which will go to the P&L to defined benefit liability of 89 rupees. And this defined benefit expense is in the nature of current service cost. So over here at year 0, there is no opening obligation, so there is no interest, but there is 89 rupees worth of current service cost, and hence your closing liability is 89. Now when the second year goes by, another 131 gets built up. But again, this 131, second year is over, is received after 5 years, of which 2 years are done, 3 years are remaining. So 131 to be discounted at the rate of 10% for 3 years. And hence that is 0.7513. And hence this is around 131 into 0.7513. If I multiply, I will get 98. So my opening obligation, that is 89. That opening obligation will also come 1 year closer. So 89 into 10%, that is equal to around 9 rupees. So that is defined benefit expense, which is interest account debit to defined benefit liability, and then defined benefit expense, that is current service cost to defined benefit liability, and so on. So if you keep on doing, at the end of 5 years, slowly your obligation gets built to 655, which is nothing but 1% into 13,108 into 5. And this 655 is not just built in the 5th year, it accrues over 5 years. So this is how you will recognize that in each year the benefit attributed to each year of service is 131, but when you recognize the current service cost, interest cost, the liability that will be recorded will be 89, 196, 324 and so on for your overall workings. So considering this, there's a fairly detailed illustration that is given over here. You can refer that for a detailed understanding. But an important point that you have to remember is, in case of a plan liability, if we go to see over here for plan liability, this is a summary for the P&L remeasurement reserve. So if you have an opening liability, why should it increase? Well, because of interest. Like you saw, 89 opening increases by interest, let's say 9 rupees. The second effect of interest will go in the P&L. It will increase due to service rendered, current service cost. So that will also increase current service cost. Second effect will go to the P&L. However, there can be other things like past service cost, whether they are vested or unvested, does not really matter. That will also increase the liability and it will go to the P&L. Further, there can be certain curtailment. Curtailment is reduction of liability that can result in a gain. The gain will also go to the P&L. However, an important area over here is, what if the actuary changes the assumptions? How will we know that? Well, usually this is a balancing figure. You will be given the closing valuation and we'll say that, well, these are the changes. If benefits are paid, you will deduct it. But if there are no benefits paid, then why should the balance not tally? Well, the balance may not tally if actuary has changes his assumptions, and changes in actuarial assumptions on the liability will be taken against the remeasurement reserve, which is a part of OCI. Rather, this is a part of a non-reclassifiable OCI, which means if the employee retires and you were to pay, then the balance in this remeasurement reserve will be transferred to the retained earnings and not through the statement of profit and loss. So this is your detailed working. Let us say for the liability, we will do that. in another question as well for this detailed working. But before that, we need to understand what happens with the plan assets. What do you mean by plan assets? Now these are earmarked. Earmarked means dedicated assets which are used for the purpose of settlement of liabilities. Earmarked dedicated assets for the purpose of settlement of liabilities. This can be in the form of assets or bonds, etc., that you have purchased through a trust which is dedicated earmarked for employees, or this can be qualified insurance policies as well, in which case you will recognize the plan assets. How? At fair value. Here 109 etc. will not apply. You will always recognize the plan assets at fair value only, because these are assets which are used for the purpose of settling liabilities, and for that we need to know whether more contributions are needed or not for settling the liabilities, and hence you will measure it at fair value. Further, typically the assets are shown on the asset side of the balance sheet. Here you will net them off from the liabilities and only show the net amount. Like when you show debtors, you subtract the provision for bad debts and show the net amount. In a similar way, over here you will subtract your liabilities, you will subtract your plan assets from the liabilities, and only the net liability will be shown. So if there's 1,000 liability and assets are 800, 200 is like the deficit which you still have to meet. Or if the assets are 1200 and the liabilities were 1000, then 200 is a surplus over and above the liabilities. So over here the two important things are assets have to be measured at fair value and they will be netted off from the liabilities, and only the net amount will be shown. Now while you are measuring the plan assets, we'll say that why should the plan assets change? So if the plan assets are measured at fair value, this is the opening fair value, why should it change? Well, it will change if there are new contributions made during the year. You had some assets, the company contributed something more during the year, so it will increase due to the contribution. But if some employees retire, I'll have to sell these assets and pay off the employees, so it will reduce due to the benefits paid during the year. But apart from that, these assets will change due to the return earned during the year. Now this return can be made up of interest, can be made up of dividend, can be made up of realized gains. It will also include the unrealized gains. Why? Because you have to show the balance at the closing fair value. Further, if there are certain expenses like taxes or administrative charges which are specifically and exclusively incurred for these items, then you will deduct these expenses as well. And as a result, over here when you go to this working, you will say that this is your actual return. However, so ideally if you add the actual return, you should get the closing fair value. However, what institute requires you to do is, institute says that, well, you know what, the interest rate cycle may be different. In some of the years the interest rate may be 10 and 12%, in some of the years it may be 5 and 6%. Actuary usually takes the average. So if the actuary's return is the expected return that you take, which is the discount rate, remember the expected return on plan assets is nothing but the discount rate on the liabilities. So over here, in some of the years when the expected return is 8, you might be earning 10. In some of the years when expected return is 8, you might be earning 6, because the interest rate cycle keeps on changing. And hence they say that the smooth stable return is a 8% return. So what you will add over here is the expected return plan assets account debit to what? Well, like an asset is used to finance a liability, this is an income to finance an expense, and as a result the second effect over here for the expected return will go in the, you will not show it as other income, you will rather deduct it from the interest expense that you had recorded. However, your expected return may be 100 into 8%, that is 8 rupees. However, your actual return might be 10. So that 2 rupees is changes in return. 2 rupees current year is more, in some other year it may be less, and hence this 2 rupees is a change in return, which is the second item which will go in the OCI. So your changes in return will be taken into the other comprehensive income, changes in return on plan assets, which will, let us say in this case, go to the other comprehensive income as a part of the remeasurement reserve. Once you have done that, you will find the assets and liabilities. Closing liability minus closing assets will give you the deficit or surplus. If it is deficit, that is the net amount to be appearing in the balance sheet, but if it is a surplus, you might have to see a concept of asset ceiling. What do you mean by asset ceiling? For example, your liabilities is 1000, your assets are 1200, in which case there is a net surplus of 200 rupees. However, let us say the terms of the agreement are such that you cannot withdraw that 200 for your own purpose. You can at max withdraw 50 rupees. So the company, I cannot show 200 as an asset because I cannot utilize it. So my net asset appearing in the balance sheet is 50, and hence 150 for the time being will be parked inside the remeasurement reserve. Why remeasurement reserve? Because at the future date, maybe I might reduce my contribution. So if in the next year there's a further liability of 500, I don't need to make another contribution of 500. So I'm not saying that the money of 150 is lost. It is not a loss for me, but I cannot withdraw it as of today, and hence I will show this as a part of remeasurement reserve. This is changes due to the effect of asset ceiling. Now, this is something which is a little tricky as well as important. So when you present it in the balance sheet, you will do plus or minus changes due to asset ceiling, which will apply only in case of surplus and if there's an asset ceiling, and this will be the net amount appearing in the balance sheet. Based on this, you have one sum. We will try to discuss this to understand this presentation better. So you'll have question number 1, and institute asks you a lot of such questions on similar lines. Let us review this. So you'll have a company who's preparing financial statements for 31st March each year, operates a defined benefit retirement plan. It's a defined benefit, again retirement, which means post-employment plan, on behalf of employees, receives advice from actuaries, and on 1st April 17, this is, let us say, for the year 17-18. So 1st April 17 will be the start of the year. The actuaries advise that the present value of the defined benefit obligation would be 6 crores. Now what is 6 crores? It is the opening balance of the liability. So if I go to see the liability, opening balance in my liability is 6 crores. On the same date, the fair value of the assets of the plan is 5 crore 20. What is this? This is the opening balance of the plan assets, 5 crore 20. Okay, opening balance has one effect only. On 1st April 17, the annual yield on the bonds was 5%, and during the year 31st March 18, we made a contribution of 70 lakhs into the plan and paid out benefits of 42 lakhs to the retired members. Both were paid on 31st March 18, which means on these benefits, or at least on these contributions, you will not further earn any interest, and benefits, because they are paid at the end of the year, they will not affect the interest. Your interest will be based on the entire opening balance. So on the opening liability of 6 crores at the rate of 5%, there will be a 30 lakh interest. So that will be P&L account debit to liability. You will increase the liability, let us say, by 30 lakhs. Second effect of this will go in the P&L. Again, the expected return on plan assets is 5%. That is the same as the discounted on the liability. 5 crore 20 into 5% is 26 lakhs. Asset account debit again to P&L. Rather than crediting it as other income, I'll reduce the expenses. So over here you will add 26 lakhs and reduce 26 lakhs over here to show a net interest of 4 lakhs. You can also do the net amount, that is 6 crore minus 5 crore 20, that is 80 lakhs into 5%. That will also give you 4 lakhs net. The actuaries advise that the current service cost is 62 lakhs. That's it. So you will debit the P&L and credit the liability. So this is current service cost of 62 lakhs, and it will be debited into the P&L. Acha, further, just I missed this, contributions of 70 lakhs. This will increase the plan assets, and 42 lakhs will reduce the plan assets because I'll have to sell that to pay the employees, and it will also reduce my liability. So if I go to see, due to this contribution, my plan assets increases by 70 lakhs. The company's bank balance will fall by 70 lakhs, and 42 lakhs over here will be the benefits paid. Okay. On 20th February, the rules of the plan were amended with retrospective effect, and the amendments meant that the present value of defined benefit obligation was increased by 15 lakhs. So this is amendment done by the company. So this is something like a plan liability, amendment done by the company. So this is past service cost. It is not actuarial gain or loss. So this will increase your liability. So over here your liability increases by 15 lakhs. The second effect goes to the P&L worth 15 lakhs. Okay. Again, during the year 2018, A was in negotiation regarding planned redundancies. Redundancies means you are trying to probably curtail or reduce the benefits under the plan. Negotiations were completed before the year end, and due to this, you have been told that the impact of these redundancies was to reduce the present value of the defined benefit obligation by 80 lakhs. Your liability will fall by 80 lakhs. But against that, do I have to pay something? Okay, before 31st March 18, we had to make a payment of 75 lakhs to the employees affected. These were made out of the assets of the retirement benefit plan. So basically, my entry over here will be liability account debit, let's say 80 lakhs, to let us say plan assets. I'm paying 75 lakhs, and then the benefit of 5 lakhs will be gain on curtailment. So if you go to see, my liability falls by 80 lakhs. My assets fall by a further 75 lakhs because I have to pay for this. This is over and above the benefits paid. That was only 42 lakhs. And then 5 lakhs will be a gain, and hence you will reduce it. Okay. After all of this, you have been told that the closing value of the liability is 6 crore 80 and the fair value of the asset is 5 crore 60. So if I go to see, your closing value of the liability is 6 crore 80 and that of the asset is around 5 crore 60. So ideally, if I were to make this statement, my closing balance should tally if I've taken everything, but it does not. So the difference over here is 95 lakhs. That is increase on the liability. Why will it increase? Because probably actuary must have changed his assumptions. So this is loss due to changes in actuarial assumptions. The second effect of this will go in the OCI. This is loss due to changes in actuarial assumptions. Further, my plan assets were actually coming to 4 crore 99 lakhs, but it is actually 5 crore 60, so 61 lakhs is a gain. So plan assets is debited, OCI will be credited. So this is 61 lakhs gain due to changes in return on plan assets, and hence the net effect in the remeasurement reserve is 34 lakhs. That is a net debit in the remeasurement reserve. In my PNL, I will show the expenses at 76 lakhs, all said and done. In my balance sheet, 6 crore 80 minus 5 crore 60, that is equal to net 1 crore 20 will be the value of my liability. This is in my balance sheet, the net amount of liability. Okay, so this kind of takes care of your presentation for the post-employment plans. An important area where institute asks some small questions is the attribution of current service cost. Hello. Okay, the attribution of current service costs will be done if a year of service gives rise to additional entitlement. Then you will create a current service cost. But if a year of service does not give rise to additional unit of entitlement, you will not record any further current service cost. So basically, you will start recognizing CSC from the time frame where you believe that you are rendering 1 year of service and that is resulting in 1 additional unit of entitlement, and you will stop when, let us say, an additional unit of service does not any further give rise to any further entitlement. So there are a few questions pertaining to that. Then there is something called as other long-term benefits. The accounting for other long-term benefits are exactly the same as that of post-employment benefits. The only difference is that there is no OCI created, which means the changes due to actuarial assumptions, changes in return on plan assets, as well as the asset ceiling effect, all of this will be going to the PNL. The significance of this is, if the same question over here, instead of giving a defined benefit retirement plan, if it was told an other employee benefit plan, other long-term employee benefit plan, not a post-employment plan, in which case this remeasurement reserve will not come. In fact, all of these items will go to the profit and loss account. So there would still be actuarial gains or losses. There would still be changes in return, but that will not go to the OCI, that will go to the profit and loss account. So other long-term benefits, gains or losses go to the profit and loss account instead of taking them into the OCI. That is the only point of difference. Otherwise, everything remains the same. And termination benefits, this is like VRS or retrenchment. You will record termination benefits once the obligation to terminate arises. Once the obligation to terminate arises, you will create a provision for the termination benefits. But while you are creating the provision for termination benefits, you need to be very careful that you include only those items in the termination benefits which actually give rise to an additional obligation on termination. If a part of it is linked to future service, that will be recorded as service cost, not as termination benefits. So that is something that you need to be a little careful about. So that is regarding Ind AS 19. Next, you can go to another important standard, a very important and tricky standard, that is Ind AS 12 on income taxes. So over here, this is a tier 1 category standard. Especially it has a lot of weightage that the institute gives in chapters like business combination, etc., where the weightage from Ind AS 12 also does come in. Okay, so when you look at income taxes, Ind AS 12, there are a few concepts. There is current tax. Current tax is the tax that you calculate as per income tax laws. So whatever is the income tax profit into the tax rate will be the current tax. Second is deferred tax, that is arising due to differences which are temporary differences on which you create a deferred tax impact. We will study how to calculate the deferred tax. Income tax expense is the total of current and the deferred tax. The total of current and deferred tax together will give you the income tax expense. Carrying value is a value as per Ind AS. So that is as per the Ind AS balance sheet, whereas tax base is, loosely speaking, you can say is a value as appearing as per a tax balance sheet for an underlying asset or liability. The difference between the Ind AS balance sheet value, that is the carrying value, and the tax base, ideally they should be the same. But if they are different, why are they different? The reasons can be two. It can be a temporary difference, or it can be other than temporary difference. If it is other than temporary difference, like for example, you might have a donation to a unregistered charitable institution or a weighted deduction, in which case there's no deferred impact, and hence there is no deferred tax calculation. If it is other than temporary difference, there is no deferred tax. In fact, you might show a reconciliation between the tax as per accounting profit and as per, let us say, income tax records. Because of this is the reason for a difference. You might need to create a reconciliation over here. But if the difference is, let us say, temporary, like a depreciation, 43B item, etc., then you will see whether it is a taxable temporary difference. A taxable temporary difference refers to a difference which will result in an entity having to pay a higher tax in the future years, in which case you will have to create a deferred tax liability, or a deductible temporary difference, in which case an entity can claim a deduction and thereby pay a lower tax in the future years, in which case you create a deferred tax asset. So there can be a deferred tax liability or there can be a deferred tax asset. Now, identification of deferred tax liability or asset is linked to a few steps that we will discuss. But whatever the current or deferred tax, where will it go? Well, typically it goes to the P&L because the underlying incomes and expenses arise in the P&L. However, if the underlying incomes and expense arise, let us say, in the OCI, like a fair value reserve, if there's a deferred tax impact or a current tax impact on that, which is recorded in OCI, then the deferred tax impact will also go in the OCI only. So, items in OCI, tax in OCI, items in P&L, tax in P&L. In fact, if the items are taken directly in reserves, then the tax impact will also be taken directly in reserves or other equity. The steps for creating deferred tax. Now, this is the most important. Standardized steps at this point from an exam perspective. First step, you will identify whether it is an underlying asset like a PP or a liability like a loan, and then find the carrying value. Carrying value is a value after applying all Ind AS principles at the balance sheet date. Compare it with the tax base. That is, if you were to prepare a tax balance sheet, what will be the value as per the tax balance sheet? The difference between the two, unless given otherwise, you will assume is temporary, and then you will have to create a deferred tax. The deferred tax over here is the difference into the tax rate. The tax rate over here will be the tax rate which has been enacted or substantively enacted till the balance sheet date, because deferred tax is usually a tax impact which will arise in the future years. You can't estimate the future tax rates, and hence you will take the tax rates that have been enacted or substantively enacted, let us say, till the balance sheet date for the purpose of deferred tax calculation. Now, whether this is a deferred tax asset or a liability, generally we remember certain rules. That is, you will identify whether it is an underlying asset like a PP. If it is a PP, that is an underlying asset whose carrying value is greater than the tax base, in such case the answer will be opposite. Or even if it is an underlying liability, if the carrying value is greater than the tax base, your answer will be opposite. So an asset will create a deferred tax liability, a liability will create a deferred tax asset. I'm not going to do the logic and rationale at this stage. This is the rule from an exam perspective. And if the carrying value is lower than the tax base, the answer will be in the same direction. So basically, if the carrying value, that is the Ind AS value, is greater than the tax base, the answer will be in the opposite direction. Whereas if the carrying value is less than the tax base, the answer will be in the same direction. That is, the asset will create a deferred tax asset, a liability will create a deferred tax liability. If there is no difference, there is no deferred tax impact at all. Offsetting principles. While preparing the balance sheet, you will typically offset the deferred tax asset and liability and show the net amount, as long as the underlying items can be offsetted and shown net. However, if the deferred tax liability arising out of the Indian tax laws cannot be offsetted against the deferred tax asset arising out of a US tax laws, in which case you will have to show them separately. Okay, as we discussed, the tax rates for current tax will be the prevailing tax rate, whereas for deferred tax will be the tax rates which have been enacted or substantively enacted, let us say, till the balance sheet date. If the tax rates change during the year, you will have to remeasure the deferred tax liability or deferred tax asset in line with the revised tax rates, and the effect will go to the P&L or OCI depending on where the underlying items are being recorded. Okay, usually you will always create a deferred tax liability, subjected to a couple of exceptions on deferred tax liability, like a goodwill or like a goodwill, or let us say, we'll study that. But what about deferred tax asset? Should you create a deferred tax asset? Well, in general, yes. However, deferred tax asset, if you pass the entry, it's deferred tax asset account debit, let us say, to P&L. So over here you are recording, in a way, an income or a reduction from an expense, and hence it is kind of against prudence and conservatism. So the standard says you can do that only if you believe that it is reasonably certain that you will earn sufficient benefits to utilize this deferred tax asset. How do you calculate benefits? The first way in which you calculate benefits is, you will see that if there are sufficient taxable temporary differences whose reversal pattern matches the reversal pattern of deductible temporary differences. Okay. Second, do you have sufficient profits? Do you have sufficient profits against which these deductions can be claimed? And third, can you implement tax planning strategies or opportunities whereby you can utilize? So if any of these or total of these three is sufficient to cover the deductible temporary differences, then you will create a deferred tax asset for the amount of deductible temporary differences. However, if it is not sufficient, then you will create a DTA only to the extent the benefits are available. Okay, then you have deferred tax on business combination. The principles are same on the net assets. If the carrying value is greater than the tax base, carrying value is a value as per Ind AS, that is a fair value. Tax base is typically the old carrying values. If that is the case, you will create a deferred tax liability. If the carrying value is less, then you will create a deferred tax asset. While creating that, one needs to remember that you will take the tax rates of the subsidiary for the purpose of this calculation. Sometimes it might happen that there is a carry forward loss. Carry forward loss typically creates a deferred tax asset. However, at the stage of business combination, if the selling company did not create a deferred tax asset because it did not expect the losses to be utilized, or the new company also believes that the deferred tax asset should not be created because it does not believe that the profits will be earned, then there will be no DTA created on the carry forward losses. However, if the new company believes that it will be able to generate enough profits to kind of utilize those losses, then DTA can be created. Okay, an exception over here is you will create a DTA and DTL as a case may be on the net assets taken over. However, goodwill is something where Ind AS says you do not need to create any separate deferred tax liability. So goodwill will not be considered for the purpose of deferred tax calculation as per Ind AS 12. Okay, usually we do not create a deferred tax asset on deductible temporary differences if we believe that you do not have sufficient benefits. However, such a provision is not there for deferred tax liability. Generally, you will create a DTL on deferred tax liabilities in general, except if it is deferred tax liability on goodwill, in which case you are not required to create it. If, let us say, you are creating deferred tax items which do not create, let us say, any impact on the P&L, you will not create it. However, another point over here that you need to know is that if there is, let us say, a case where let's say there is a parent subsidiary relationship or a parent and an associate relationship, the dividend that will be received, on that dividend the parent will have to pay tax, but that they will have to pay only when the dividend is declared. But that dividend, whether declared or not, is within the control of the parent. And if the parent believes that it is not going to declare dividend in the foreseeable future, there is no need to create a deferred tax. So a deferred tax asset or liability as a case may be, your deferred tax liability need not be created in case the parent controls the timing of dividend, that is typically the holding subsidiary case, and it is estimated that this dividend will not be distributed in the foreseeable future. If both of these conditions are met, you will not create a deferred tax liability. If one of them is not met, like in case of an associate, you do not control the timing of dividend, then you will have to create a deferred tax liability which is arising on the investment. Okay, a special case is deferred tax and share-based payment. Now, in case of a share-based payment, you will not apply the general rules and guidance. You will say that in case of a share-based payment, the carrying value, that is the Ind AS value, will be taken as nil. Why? Because the Ind AS value is based on the fair value as on the grant date. That is not the base for income tax, and hence the deductions as per books are irrelevant, and hence the carrying value as per Ind AS will be taken as nil. Second, if you look at the tax base, the Income Tax Act gives you deduction based on the intrinsic value at the time of exercise. I don't know what the intrinsic value will be at the time of exercise. However, I can gauge that as by taking intrinsic value at each balance sheet date. So you will take the tax base as the intrinsic value at each balance sheet date, prorated into 1/3, 2/3, 3/3 as a case may be. That will be the tax base, and the difference between the two will always create a deferred tax asset. Why? Because you are going to get a deduction in the future years in income tax. When the exercise happens, income tax will give you a deduction, and hence it's a deferred tax asset. So long story short, in case of share-based payment, carrying value, that is the Ind AS value, will be taken as nil, not your balance in the SBP reserve. Second, tax base will be taken as the intrinsic value, not based on the fair value, intrinsic value prorated. Third, the difference into the tax rate will give you a deferred tax asset always. Okay, then there are a few other special cases, like in some cases you will be asked to prepare a reconciliation between the tax appearing in the books and what you are actually paying, or the effective tax rate. That reconciliation largely is arising due to other than temporary differences, because temporary differences have already been considered in the deferred tax calculation. Secondly, sometimes there can be a deferred tax on ROU asset or lease liability. Income tax does not recognize ROU asset or lease liability, so you will calculate the ROU asset, you will calculate the lease liability, and then based on that you will try to calculate the deferred tax by comparing it with the tax base, which is 0, you will find the net asset or the net liability, ROU asset minus liability, and compare that with the tax base to find the deferred tax asset or the liability. MAT is actually not really a tax, but it is a prepayment of tax because you can get MAT credit. So against MAT, you will pay lesser tax in the future years, and hence MAT is a classic deferred tax asset. So whatever is the MAT amount will be shown as a deferred tax asset. And lastly, if there's a deferred tax and revaluation, and you have also been asked to show the impact in the P&L or OCI, then you will calculate the opening balance, the opening deferred tax liability. Then you will take the difference by considering the depreciation but ignoring the current year revaluation. Whatever is the change in the difference is arising due to depreciation. Depreciation goes to the P&L, and hence the deferred tax impact should also go to the P&L. Then you will consider the current year revaluation. Current year revaluation goes through the OCI, and hence the deferred tax impact should also go to the OCI. So these are the steps that we have mentioned over here for these special cases. So based on that, if we were to do a few important problems, so if you go to Ind AS 12, so over here, X is preparing CFS for 31st March each year. During the year ended 31st March 18, the following events affected the tax position. So X has a wholly owned subsidiary Y, which made a loss for tax purposes of 30 lakhs. So if there's a loss which is made for tax purposes which is worth 30 lakhs, on this loss you will create what you call as a deferred tax asset. Ideally, you create a deferred tax asset of 30 lakhs into whatever is the tax rate. At the end, you have been told that the tax rate is 20%. But you will create a DTA only if you have sufficient benefits against which you will utilize. So Y is unable to utilize these losses against the previous tax liabilities. Income tax does not allow Y to transfer the tax loss to other group companies, so that's fine. Further, however, Y can carry forward the loss and utilize it against future taxable profits. The directors do not consider that Y will make taxable profits in the foreseeable future. So if you expect that the profits will not be made in the foreseeable future, there will be no DTA to be created. So over here, there will be no deferred tax asset. Second, you have on 31st March 2018, X committed to closing a division after the year end, making a number of employees redundant. So you recognize a provision for closure cost. Remember the provision for closure cost, if you go to see, this provision is an underlying liability. If I look at the carrying value as per Ind AS, the carrying value as per Ind AS for this liability is 20 lakhs. So let us say this is 20 lakhs. Income tax allows tax reduction for closure only when the closure actually takes place. So if I were to find the tax base over here, the tax base is, let us say, nil. In the year 31st March 19, X expects to make taxable profits which are in excess of 20 lakhs. And on 31st March 18, X has the taxable profits which are greater than. So you have enough benefits against which you can utilize. So over here, if I take the difference is 20 minus 0. This is where carrying value is greater than the tax base. Carrying value greater than the tax base. So if your carrying value is greater than the tax base, your answer is opposite. That is, if I were to calculate deferred tax, this is 20 into 20%, that is 4 rupees. This will be a DTA. Why? Because it is a liability, and if carrying value is greater than the tax base, answer is opposite. It will create an asset. Logically, it is an asset because income tax will give you deduction in the future years, and hence it is a DTA. Next, you capitalize development cost which satisfied Ind AS 38 intangible criteria. The amount capitalized was 16 lakhs. So that is your asset. The development project began generating benefits on 1st January 18, and the directors estimated the project would generate benefit for 5 years, which means there will be amortization over 5 years. So 16 lakhs divided by 5, that is equal to 3 lakh 20 per annum. But in the current year, from 1st January 18 to 31st March, only 3 months have gone by, and hence you will have 80,000 of amortization. So as per Ind AS, intangible asset will be shown at 16 minus 80,000, that is 15 lakh 20. But development expenditure was fully deductible against the taxable profits for the year 31st March. Income tax said development expense account debit to bank, P&L account debit to development expense. So income tax has a tax base of 0, and hence 15.2 is a difference. This is a difference again where carrying value is greater than the tax base, and hence the answer is opposite. So it will create a DTL. 15.2 into 20% comes to around 3.04 lakhs. This will be a DTL. And fourth, we borrowed a loan of 1 crore. Cost for arranging the borrowing was 2 lakhs, and this cost qualified for a tax deduction. So in income tax, your entry will be bank account debit to loan 1 crore, and then P&L account debit in income tax to bank of 2 lakhs. So income tax, the tax base is 1 crore. In books, your entry is bank account debit to loan 1 crore and then loan account debit 2 lakhs to bank, because as per financial instruments, transaction cost is to be deducted, and hence this is 98 lakhs to start with. The loan was for 3 years, no interest was payable on the loan, but the amount was repayable on 31st March 20 at 1 crore 30. This equates to an EIR of 10%, and income tax will give you deduction of 30 lakhs directly when the loan is repaid. Okay, so for income tax, if I look at the loan, which is an underlying liability, even at the end of the year, the loan appears at 1 crore only, that is 100 lakhs. In the books, if I prepare the amortization table, the opening balance is 98, on which if I record an EIR at the rate of 10%, this is 9.8. There's no payment, and hence if you look at the closing, this is 107.8. So if I look at the loan, in the books, this is 107.8. In the books, I have claimed a deduction of, I think, 9.8 in the current year. Income tax has given me only a processing fee deduction of 2 lakhs in the current year, and hence books has given me a 7.8 extra deduction. Income tax will give me in the future when I claim the entire interest as a deduction in the third year. So there's a difference of, let us say, 7.8, and this is a case where carrying value is greater than the tax base, and hence the answer is opposite. So over here, this will be 7.8 into, let us say, 20%, that comes to around 1.56. Again, over here, this will create a DTA, because this is going to give you a deduction in the future years under income tax. So if you go to see, there's a 4 lakh DTA, 3,04,000 DTL, and you have, in the last case, 1,56,000 DTA. This is for X, and hence you will create a DTA. If it was for Y, you will not create a DTA. Then you have this question 2A, 2B and 2C, which is a fairly detailed question which has been added in the institute study material. As an example, we have discussed a fairly detailed video on this separately. You can refer the Ind AS 12 new questions added. This is one of them, and this is also come in a miniature version in the RTP, so you can refer that. But if you want to discuss it at length, refer the Ind AS 12 detailed question video. Over here we can do a brief discussion for this question. So over here, what is happening is, you are a manufacturing company and you want to calculate taxable profit. So this is like a income tax type of a question. You want to find the taxable profit. You have been given that the current rate is 30%, but going forward the rate is 32%. So if you want to calculate current tax, it will be based on 30. Deferred tax, it will be based on 32 for the year ended 18-19 and beyond. Okay, so you have been given the entire balance sheet, a fairly detailed balance sheet, and there is an extract of profit and loss. Now over here, what is happening? You have been given a depreciation expense. Okay, as per income tax is 7210, and for financial reporting, depreciation is 5950. Okay, so your current profit must be after deducting 5950. So you will add it back and subtract 2,10,000 for calculating the taxable profit. The cost of PP is 5 crore 60, and H has deducted 1.45 crores in its tax returns prior to the year ended 17-18. Further, H has revalued the property for the first time to 4 crore 20, and there's a revaluation surplus. So if you have to calculate, let us say, your income tax, you will say you will add back accounting depreciation and you will deduct the tax depreciation. Whatever is the tax, I think the numbers have been, the alignment is just going up and down. So tax depreciation 72,10,000. While you calculate your carrying value, that is a value as per Ind AS. So over here, that will be 42, and the tax base, you will say that, okay, I started at 5 crore 60. From 5 crore 60, I will subtract whatever is the tax depreciation. So your tax depreciation subtracted is 145,600, and in the current year, you will subtract the depreciation of 72 lakh, and hence you will get the tax base of 342.30. The difference between the two assumed to be temporary, and hence this will give rise to a deferred tax liability. Okay, so that is like the first point. The second point is, you have been told that there is some product development cost of 35 lakhs. This is in the year 14-15, 3-4 years back. These costs are recognized as an asset and amortized over a period of 10 years for tax purposes and deducted in the year 14-15. They have been deducted. So in income tax, there will be no further deduction, but in books, there must have been deduction of 35 lakhs divided by 10, that is 3,50,000. That will be disallowed. So you will add back this 3,50,000. In income tax, it has already been claimed. Acha, when I prepare the balance sheet, I will say that in income tax, there is no such intangible asset, but in your books, 35 lakhs minus the accumulated depreciation for around 3 or 4 years. So that will come down to 21 lakhs. This will again create a deferred tax liability. Carrying value is greater than tax base. Answer is opposite. Okay. Then you have some trading investments. which are acquired at 80 lakh 50, income tax they will be shown at 80 lakh 50 only. At FVTPL and the fair value adjustments are not allowed by the tax authority. So if I open my balance sheet, I will see the investments at 72 lakh 80. So maybe this is a difference. Okay, so this is 72 lakh 80 and you had acquired this at 80 lakh 50, and hence the difference over here is 7.7 lakhs. This is loss which will be disallowed, and hence you will add back 7 lakh 70. When I do the deferred tax calculation, the difference over here between 7280 and 8050, this will be a deferred tax asset. Okay, this bad debt provision is a very complicated working, so you should do this at length. So the bad debt provision is 4550, relates to two debtors, A at 28 lakhs, 100% provision was recognized. B at 1750, receivables originate, and again 100% was recognized. So in books you have recognized the entire 28 and 1750. But in income tax, you are allowed deduction for 20% of the provision overdue for more than 1 year, 30% for overdue for more than 2 years, and the remaining 50% for overdue for more than 3 years. Now, if I look at books, I have allowed a deduction of entire 14 lakh 50, out of which in the current year, I think I have claimed a deduction of 17 lakh 50. So I will add back the 17 lakh 50 bad debt provision that I have created in the current year and deduct the current year additional provision as per income tax. Further, when I prepare, let us say, the working for bad debt provision, I will say that A has been overdue for, I think, about 2 years, whereas B has been overdue for only 1 year, and hence for A the total provision that you will create is 30, whereas for B the total provision that is created is only, let us say, 20%, and as a result you will find the bad debt provision to be recorded as per income tax, and you will deduct the bad debt provision. There is a slightly detailed working, you can refer that separately. Whatever is the tax provision as per income tax, you will deduct it, and the difference in the debtors after adjusting for bad debt provision will be taken as a base for deferred tax working. Okay, then you have a provision for inventory obsolescence as per Ind AS 2. New provision during the year is 3 lakh 78. Income tax will not recognize it, so you will add it back. And total provision is 6 lakh 30. So if I go to see, being the general provision, it is not tax deductible. If I look at my inventory currently is appearing at 1 crore 6 lakh, which will be after the provision. So you will add back the provision of 6 lakh 30. That will give you the tax base. So if I go to the tax base working, you will have inventory added by 6 lakh 30, and that is the difference that will create a deferred tax asset. Income tax will give you deduction in the future. Okay, again you will add back inventory obsolescence of the current year. Next, government grants are not tax deductible. If they are not tax deductible, they will not create any deferred tax impact. Full government grant received is included in the balance sheet, which means nothing has gone in the P&L account, and hence there is no adjustment in the P&L as well. There will be no deferred tax calculation as well. Over here in 1718, you increase the liability for product warranty costs by 1 lakh 75. Product warranty costs are not tax deductible until the claims are paid, and claims paid of the year 1718 are 2 lakh 17. So in income tax, you will get a deduction for 2 lakh 17 for the product warranty claims paid, and you will add back 1 lakh 75,000 of the current year. In your balance sheet, as per income tax, there will be no provision, so there will be 0 tax base, and in your books, there is a provision for 5 lakh 60. So difference between 5 lakh 60 and 0 will be taken for the purpose of your product warranty cost working. Okay, next you have again same healthcare benefits are introduced in the current year. These expenses are allowed for tax purposes when these benefits are paid, but in line with Ind AS 19, they are recognized when employee provides service. So if you see your books, there is in the current year a healthcare benefit of 24 lakh 50, which must have been created in the current year. Income tax does not allow a deduction, so you will add it back, and then for calculating deferred tax, we will take that into our working healthcare benefits, and 0 tax base is 0, no entry must have been passed. Okay, penalties towards violation of laws included in operating expenses 63,000. They are not deductible. There is no deferred tax impact if they are not deductible, but you will add it back for the purpose of calculation of profits. Tax laws allowed to deduct petrol expense of only 1 lakh 40 per vehicle. It has 4 vehicles, and hence 1 lakh 40 into 4, that is 5 lakh 60. But your total expenses are 7 lakh 21. So you will add back, if I go to see, 7 lakh 21 of petrol expenses and deduct 5 lakh 60. So if I go to see, the difference over here is around 1 lakh 61 which is getting disallowed. 63,000 disallowed. None of these will have any deferred tax impact, and hence you will calculate the taxable profit, and 30% of that will give you the current income tax. Whereas when you look at the deferred tax working, this deferred tax working is at 32%. So it's a very, very detailed question. What we will try to do is we will try to kind of review this. If you want a detailed review, you can kind of look at the Ind AS 12 additional questions. The deferred tax working is what is more important from an Ind AS 12 perspective, which is asked in the RTP as well if you go to see, and it is important from an exam perspective. This entire case study may be relevant when it comes to an IBS type of a paper where you have an integrated case study of income tax as well as Ind AS 12 appearing. So these are the three crucial standards which are pertaining to liabilities: Ind AS 37, Ind AS 19 as well as Ind AS 12. So I guess I will do the remaining standards which are pertaining to, let us say, the disclosures and presentation etc. in a separate video if time permits. But these kind of cover a large majority of your important standards. I hope this video has been helpful to you. I will try to upload another video where the remaining standards like Ind AS 1, 7, 10 etc. 8, disclosure related parties, segment reporting, EPS, even foreign exchange, accounting and technology etc. If possible, I'll try to upload a separate video in the next day or two. But otherwise, this kind of helps you in the important revision for the important standards linked to assets and liabilities. I hope you have liked the video, and please do press the like and subscribe button. I'll see you soon with another video. Till then, study well, good luck, goodbye, and take care.